it on the back rows to just move forward. You can leave those seats empty for people who will come in a little later. I'm sorry, I know I said we'd commence shortly, but it seems that the rains have delayed certain parties, but we should still be mostly on schedule. The chairman, Sebi, is about to be with us shortly. I believe he is somewhere in the pavilion now, so about in another minute. Sebi is at the Ignite Square and should be with us shortly. Ladies and gentlemen, please welcome Mr. Tuhin Kanta Pandey, Chairman, Securities and Exchange Board of India. Good morning, members of the audience, distinguished guests. Welcome to the 4th edition of the Business Standard BFSI Insight Summit. The 2025 iteration is bigger and better than ever. A gentle reminder for all audience members, please settle down before we commence with the first session. I now invite Mr. Tuhin Kanta Pandey, Chairman Sebi, to join us on stage, along with Mr. Shailesh Dobhal, Editor of Business Standard.
Good morning once again, everyone. On behalf of Business Standard, I extend a very warm welcome to Mr. Tuhin Kanta Pandey, Chairman of Securities and Exchange Board of India, on this third and last day of the Business Standard BFSI Insight Summit 2025. which has over the last 4 years become the destination and platform for almost the entire Indian financial sector to come together to discuss, debate, and deliberate on a host of issues that the India and the world faces at this critical time. Mr. Pandey took charge as chairman of Sebi in March 2025 and has since then driven reforms to improve ease of doing business and reducing the compliance burden on market intermediaries. Mr. Pandey is a retired officer of the Indian Administrative Service and has more than 3 decades of administrative experience, having held several key positions in the Union and Odisha government. Mr. Pandey has served as Union Finance Secretary, Revenue Secretary, Secretary of the Department of Investment and Public Asset Management, Secretary of Department of Public Enterprises, and Secretary of Department of Personnel and Training. He also briefly served in the regional office of the United Nations Industrial Development Organization. Mr. Pandey's experience spans economic policy, finance, industrial development, taxation, and public administration. Mr. Pandey has made 4 T's, which is trust, transparency, teamwork, and technology, as guiding principles of Sebi's policies. Mr. Pandey leads Sebi's initiatives to strengthen investor trust by curbing misleading social media content and fraudulent market activity. He has also led awareness and investor education campaigns, working with market infrastructure institutions to promote safe and informed participation. These include measures such as verified UPI handles for registered intermediaries, the Sebi check facility to authenticate market players, and Sebi versus scam outreach to warn investors against fraudsters. From Niveshak Shivir events for unclaimed assets to outreach programs promoting municipal bonds, Mr. Pandey is expanding Sebi's relationship with investors beyond big Tier 1 cities. For listed entities, he has championed reforms to streamline disclosures on related party transactions and simplify norms for initial public offerings, enabling easier and more transparent fundraising in the Indian capital markets. Mr. Pandey holds a master's degree in economics from the Punjab University, Chandigarh, and an MBA from University of Birmingham, United Kingdom. Many thanks, Mr. Pandey, for joining us today. May I now invite and request Mr. Tamal Bandyopadhyay, Consulting Editor, Business Standard, to please come up on stage and start the fireside chat with Mr. Pandey. Over to you, Tamal. Thank you very much.
Thanks, Elish and Mr. Pandey, or shall I call you Mr. Deepam? Because in Delhi, everybody call you Mr. Deepam. I thought Shailesh will use that. But anyway, you are Sebi chairman. So before chat, I'm sure the entire industry is here. They will probably want to hear you, a solo little bit of thing, a few minutes that you start, and then we'll have our conversation. That's all. No grilling, no interview, just conversation. But before that, over to you, sir.
Thank you, Business Standard, for this invite. A very important summit, building a resilient financial ecosystem. Distinguished guests, industry leaders, ladies and gentlemen, a very good morning to you all. It's a pleasure to join you today to reflect on the evolving role of India's capital market, how it has become a key pillar of our economic growth, and how recent reforms are helping making it more efficient, inclusive, and resilient. India's growth journey is deeply intertwined with the strength of its financial markets. A sound and efficient financial market comprising banking, capital markets, insurance, and pensions forms the foundation on which enterprise, infrastructure, and innovation stand. Over the years, the financial sector has evolved from being a facilitator of credit to a key enabler of growth and inclusion. It's through this system that household savings turn into productive investments, that entrepreneurs find support for their ideas, and that risk is shared across institutions and investors. Today, as India stands among the world's leading economies, remarkable both for its scale and its pace of growth, the role of our financial system extends far beyond traditional intermediation. It now embodies a broader mission, fostering inclusion, ensuring stability, and building resilience across the entire economic landscape. Our financial sector today functions as an integrated ecosystem. Banks, corporates, mutual funds, insurers, pension funds, fintechs, all are connected through an intricate web of transactions, exposures, and innovations. An equity issued by a company might be held by mutual funds, institutional investors, or individual shareholders, while its bonds might be subscribed by pension funds, insurance companies, or NBFCs seeking stable returns. Banks may have extended loans to the same company and may have held its equity within their investment portfolios. Such overlapping exposures create a tightly woven web of financial linkages. These linkages are beneficial. They bring efficiency, lower cost, and expand access to capital, but they also make the system more complex. A disruption in one segment can transmit rapidly to another. This interdependence underscores the importance of coordination among regulators. Mechanisms such as FSDC subcommittee, and bilateral coordination channels enable continuous dialogue on issues relating to financial sector stability, its development, and inter-regulatory coordination. These mechanisms bring together the financial sector regulators to monitor systemic risks, ensure regulatory harmony, and address emerging challenges collectively. Such coordination helps anticipate stress early and ensures that the system responds cohesively rather than reactively. Recent years have tested financial systems globally. Rapidly changing trade policies, rising public debt, and geopolitical tensions have created uncertainties in markets everywhere. Yet, India's financial system has remained stable and resilient, and this resilience reflects a shared commitment by entire financial sector stakeholders, including regulators, to safeguard stability while enabling growth. Within this broader financial ecosystem, the capital market stands out as a dynamic and fast-evolving segment today. Over the past few years, India's capital market has expanded both in scale and in reach. Participation has widened remarkably, with a number of unique investors rising from around 4 crore in FY19 to more than 13.5 crore today. This growth has been supported by tech-driven, simplified access, rising financial awareness, and the credibility built through consistent regulatory reforms. Market capitalization has also risen in tandem, rising from 69% of GDP in FY16 to about 129% today. A large number of companies are using public markets to raise long-term funds. In the current financial year till September, around 7 trillion rupees, that means 7 lakh crore, has been raised through equity and debt issuances. Today, the investor participation is no longer limited to major cities. Tier 2 and Tier 3 towns now account for a significant share of new investors. Around 18% of mutual fund assets now come from beyond the top 30 cities, signaling that the benefits of market participation are reaching India's smaller towns and new savers. These strides represent more than just statistics. They symbolize confidence of investors and stakeholders in a transparent, efficient, and resilient market ecosystem. Resilience is not built in a day. It's built through foresight, structure, and discipline. It's about building guardrails, anticipating risk, strengthening systems, and ensuring market recovers quickly with minimal disruption when faced with shocks. Over the past few years, Sebi has undertaken several measures to make the market structure more robust and investor-friendly. Let me touch upon some key such reforms. The first, infrastructure oversight. Sebi has strengthened the governance framework of stock exchanges and clearing corporations, including periodic independent evaluations and enhanced accountability of key directors. Mutual fund resilience. Regular stress testing and tighter liquidity norms today ensures that funds are better aware and equipped to manage sudden redemption pressures. Corporate bond market reforms. By expanding the electronic book mechanism, introducing tighter disclosure requirements, and enhancing transparency, Sebi has improved price discovery and investor confidence in bond market. SME IPOs. To ensure that only credible companies access capital markets for SME IPOs, we have strengthened the eligibility criteria in terms of profitability, cap on offer for sale, restriction on the use of IPO proceeds, and introduced phased release of lock-in on promoter contribution. Equity derivatives. We have prescribed a range of measures to strengthen the equity derivatives framework. These measures were taken to address the heightened market activity on expiry day and to manage the risk better. These steps ensure that the foundation of market operations remains strong even in times of stress. Let me come to some of the ease of doing business and efficiency measures. Simplified IPO and listing frameworks. Digitization and process simplification. From online filings to a unified KYC system, we have made it simpler for investors and intermediaries to operate across segments. Further, to simplify digital onboarding of overseas investors, recently we have proposed to ease the requirements for NRI clients to be physically present in India during the re-KYC or KYC modification process. Faster turnaround times, clear timelines for approvals and improved grievance redressal systems have brought predictability, efficiency, and enhanced confidence among stakeholders. Let me come to a few things that we have done in case of market development and innovation. On REITs and InvITs, we have expanded the scope of strategic investor for REITs and InvITs and reclassified REITs as equity for investments by mutual funds. Corporate bonds, we have introduced new liquidity window for non-convertible securities by allowing issuers to offer put options. Mutual fund, to promote financial inclusion in mutual funds, we have revised the incentive structure for distributors for new inflows from beyond top 30 cities and introduced an incentive structure for mutual fund distributors for onboarding first-time women investors. Alternative investment funds. We have provided additional relaxations and operational flexibilities to accredited investors-only schemes of AIFs, and further steps are being taken to promote adoption of accreditation by investors. Collectively, these reforms have simplified operations, improved business conditions, strengthened governance, and reduced systemic risk, laying the foundation for a marketplace that's both resilient and welcoming to long-term capital. The role of regulator is often seen as balancing two sides of a scale, development and risk management. But in reality, they may not be the opposing forces. Regulations can enable growth just as much as they can contain risk. A simple example is the shorter settlement cycle T+1 we have adopted. It increased efficiency and reduced systemic exposure simultaneously. Similarly, the emphasis on disclosures and governance has made Indian listed entities more credible in domestic as well as global markets, thereby attracting investments. Sebi's approach has been to encourage responsible innovation, allowing markets to evolve, but within guardrails that protect investor trust. So what are our priorities for the future looking ahead? Even as we take pride in progress, the journey is ongoing. Technology will continue to redefine market functioning, from algorithmic trading to investment decisions. But innovation must walk hand in hand with accountability. Our focus will be on promoting the responsible use of emerging technologies such as AI in financial markets, strengthening cyber resilience, and encouraging quantum readiness among entities in our ecosystem. True resilience lies in foresight, the ability to read trends early, anticipate risks, and prepare the system to withstand shocks. Building such capability both within Sebi and across market institutions will remain our key priority. At the same time, we are reviewing our regulatory framework to make it more contemporary, clear, and easy to navigate. Over the years, SEBI's regulations have expanded significantly in line with the market growth and innovation. While this evolution has been necessary, it has also added layers of complexity. To simplify and consolidate, SEBI has initiated a comprehensive review of its regulations. For instance, the Sebi mutual fund regulations, first introduced in 1996, have seen multiple amendments over nearly 3 decades. The ongoing review seeks to bring these provisions together in a cohesive and structured manner, reducing redundancy and improving clarity. This will help stakeholders comply with greater ease and enhance the overall transparency of the regulatory framework. The surge in retail participation brings new energy, but also new responsibility. Investor protection is not only about regulations, it begins with understanding. SEBI's investor awareness campaigns and the widespread use of regional languages in outreach will continue to expand. An informed investor is the best defense against market misconduct. As we look to the future, our focus must remain to build a financial system that is strong yet agile, innovative yet responsible, and inclusive yet resilient through optimum regulation and effective collaboration. Because in finance, as in life, resilience is not the absence of shocks. It is the capacity to recover, to learn, and to keep moving forward together. Thank you.
All my homework is now meaningless because you have answered everything. So, okay. So let me try to reorganize my thoughts and what to ask. Okay. Mr. Pandey, in your first board meeting, you spoke about building public trust, and you also referred to conflict of interest. And I still remember you made it your regulatory philosophy very clear, and that quote market guys, all the people sitting here often say, Sebi is not here to play hero. Here we are to build trust through lawful regulations. And of course, you spoke about repeatedly about this internally, how do you settle all the issues and the conflicts and all. So I'm talking about not the market, within the regulators also. So can you give us a sense, where are we?
So I think an important thing is to understand that SEBI is an institution which has been nurtured and developed by several of our predecessors and industry participants, market participants together in a very effective collaboration. Today, SEBI as an institution has a name not only in India, but abroad. Everywhere I go, SEBI's name is there. In the organizations of security market, ISCO, which is an international organization of security market regulators, SEBI plays an important role in their deliberation at the world stage. So we have to just keep going together, identifying new opportunities, addressing our challenges. So trust is extremely important, and how to get the trust internally as well as externally is not through one specific measure. There is no one magic wand, but a series of things. It comes also from the body language of how we want to, how we want to communicate. and also the regulations and the applications of those regulations fairly, judiciously is important. So I think both internally in Sebi and externally along with market participants, we want to create, and trust actually goes with other 3 T's that I had narrated, the very first day I joined. And the trust comes with also the transparency. It also comes with teamwork, and teamwork is internal as well as external, and also the technology, because technology also today plays an important role in building trust. Now, some concerns were there earlier when we joined in terms of whether we have a robust conflict of interest management internally or not. And we created a high-level committee on conflict of interest issues, and this committee has been deliberating, and they have actually interacted with several of the participants, different players, internally, externally, and I hope that in a few days from now, they will be submitting the report, possibly by 10th of November, and then we will be taking up the further steps on how we do that.
Thank you. Thank you, Chairman. Typically, trust, the word is associated with the banking sector. When you are talking about banking, it's all about trust. But here is a market regulator, you are talking about trust. Now, tell us, sir, you are the right person to answer this question, because I still remember the newspaper headline, Maharaja returns home. You auctioned Maharaja. So you have that capability. Now, we have never had any 5-year period in which the foreign investors have been selling so much India. What is the reason? Is it valuation only or something else? Because you have been interacting with them in India and overseas.
So in all my interactions with FPI investors and other players foreign, both internally and externally, and I have extensively traveled through major markets. Actually, the sense I am getting is that the confidence of the foreign players, the FPIs, is very, very high so far as India is concerned. They have not only interest in not only the long-term story of India's growth, but also the short-term stories. Now, if you really look at it, the type of investments they have, the market cap is around, of the FPIs, in this is a tune of $900 billion. And they would be, of course, operating like as FPIs in different markets, and they would be also evaluating, how they will be, getting the best returns. So from that point of view, if we have $4 to $5 billion of, outflows in the last, year, and then also in between, there are months where their FPIs are positive, and again, they may turn positive and negative in terms of that. In fact, much is appreciated of India's depth of India's capital market in ease of entry and ease of exit. And that's very important for any long-term flows and long-term confidence. So if you really look at it, an outflows of $4 billion over, $900 billion of market cap, it's not very significant. So, however, since we, I think, probably give the best of the data to the market, our data is so transparent every day. Very next day, how much of domestic institutional investors have invested, how much of it has been invested by the FPIs. So the people get a real sense of what's happening on day-to-day basis. However, if you look at the trend, we would see that it is not there. Now today, India's PE ratio is roughly around the mean, which is 10-year mean level. At times it has been higher. So I think they have to really look at the comparatives in other markets as well in order to see different opportunities and different arbitrage opportunities that may arise. So therefore, I'm not unduly worried about that. However, the interactions with the FPIs has, given us feedback in terms of how we can also improve our access provisions, improve our registration process, and some of the pain points that we can do. And right now, I think we're working on that because I think that is very much better both for us and for them to really have simplified things and have completely digitized processes for the FPIs.
Yeah, that the ease of doing business, you have been repeatedly saying that. Now get back to the market now, what's happening, the IPOs, it's raining. LG India market cap is higher than its parent company and all. So in this context, I just want to understand one thing is more a sort of clarification. Now India has one of the largest primary markets and all, but that's the one side of the story. But you, meaning Sebi, reduced the minimum public offer size in IPO, minimum public shareholding requirements for listed companies. So is there sort of disconnect between the two?
So let me clarify. We have not diluted the minimum public shareholding norms, what we call MPS. That remains as 25%, and that's not been changed. What we have looked at, because what we are looking at the minimum public offers, and then what's the time period within which they have to achieve the MPS norms. And then we did have the certain scale-based thing already. But we had to create some more stages in between because the markets have now expanded. Because post LIC, we have at least we have started talking of the 6 lakh crore company to come to the market. LIC came with a 6 lakh crore market cap. So normally such a thing doesn't happen. The people come much earlier and then build up and market cap while they, through the market and raise money through the market. So here, if you really look at the kind of recommendations we have made in case of IPO reforms, it's practical, it's pragmatic, it is also driven from the point of view of minority shareholders. Because when you get in there in any company as an investor, you expect to get return and not to get stuck up in an MPS exercise, which may actually, like a Damocles sword, will be hanging also on the head of minority shareholders because of the price overhang. So therefore, we have taken a practical view what the market can handle, and we had an extensive consultation on this, and we received excellent feedback. So therefore, MPO and MPS, and how to reach MPS also, different pathways have been provided.
Thank you for the clarification. One more clarification, sir. It's about related to mutual funds. All the gentlemen, CEOs and CIOs sitting here, so they'll be keenly listening to you. And as an observer, what do you see? First, it's an advantage mutual fund. Now, you look at that way. You have allowed mutual funds to launch SIF, minimum 10 lakh investment tax advantage. Okay. PMS has a minimum 15 lakh when it comes to tax. AIF has minimum 1 crore. So mutual fund is an advantage when it comes to the investments. That's a good story and they're very happy, and we're always curious then why are sort of stepmotherly statements to others, and mutual fund is your sort of dear boy, dear child. And then day before yesterday, that little bomb was blast in this area only, expense ratio. Everybody talks about that. Mutual fund, their cost. Now, we are seeing a bank, Reserve Bank of India is releasing, and another regulator, they're allowing them to a lot of other things, M&A financing, etc., so that their interest income can goes up and all. And here you are restricting their income sources. Is there any contradiction, sir, or what is it?
There is no contradiction. First, the type of examples which you gave, they are different. The mutual funds is a vehicle, is a pooled vehicle. PMS is a personalized vehicle between X, and one can choose whichever way you want to go. The AIF industry is also quite different in terms of that it is still, a lot of to do with a little riskier investment in terms of relatively illiquid things and unlisted markets. Mutual funds are important from the point of view of very large 5.6 crore investors, unique investors in mutual fund industry today. The industry has grown rapidly, but it is still about 20%, 25% of GDP of the country, where some of the advanced economies have got 80 to 85% of GDP as mutual funds. So the mutual funds has to grow, and they will grow very rapidly and in size, because that is one good way of entering the market for the investors, rather than trying to retail investors trying to get into the market directly always. It's not easy. And it also encourages long-term investing. So therefore, I think the tax status, etc., is really reconciled to that. Basically, it's like pass-through status. Now, the second thing you mentioned about the mutual fund industry, how are we saying that whether this is some of the new consultation papers?
Yes.
Now, mutual fund industry also needs more flexibility, because it has grown in size, it has got a lot of professionals, and therefore we cannot really tie their hands up, and we have to also give them flexibility. That is how SIFs came, and there are other reforms where they can do many more activities which they would do, subject to their maintaining certain level of segregation across to manage risks. But so therefore, simplifying regulations has been one of the important objectives in the consultation paper. This particular thing is pretty long. I think it's run through several pages, several hundred words, several thousand words. So if we can reduce it to half of those words, saying the same thing, communicate better, and remove overlap and redundancies, so I think it's in everybody's interest. Some of the measures which are otherwise, say, relating to fee structure also emanate from the point of view of clarity and removing ambiguities. Many of the things have to be made clear. The question of a cost. It's a big industry. It affects a very large number of people, and potentially it is a very large number of people are going to enter every year. So therefore, what has been indicated in the draft is actually a practical way of reconciling the interest of the industry and the interest of the investors. And I think we have a certain balancing work to do. And of course, the paper is still open to public consultations, but we have done some preliminary thought on this in a manner where we are saying that we need to be more transparent about costing. People should know better, investors should know better how the costs are coming up. Some of the tax elements which are getting into needlessly, there was ambiguity. Should it be a part of it? Should STT be inside the TER, or should STT be outside the TER? This is not a debate now. This has been earlier. We have grappled with these issues. So we want to make things clear, crystal clear for everyone. This is where it will there. This is what will be the ratio. This is how the taxes will come.
Thank you. So you got your answer. There are so many. My phone was flooded with WhatsApp messages. You must be asking this. You must be asking this. I've done my job. So, sir, tell me, and this is interest of the industry and interest of the investors. Your research papers periodically talks about the losses that individuals in the FNOs, 90%, 93%, they are losing money for trading and all. And then, of course, the center always, of attention is that your weekly options. It's quite an old story, but still, I can't afford not to ask you. The Padmanabhan committee, it's just about almost a year old, this recommended about easing out and all. You have also answered it, but at the same time did not answer it clearly. So, is there any time frame you have in mind? That is one question. If at all you are easing out the weekly options, and then if at all you are saying yes, what's the time frame? And second is this, will you see abruptly going away, or from weekly gradually to fortnightly and then going to monthly? Whatever you wish to say, sir.
This is a very sensitive subject, as also has a lot of nuances. It's not an easy thing, again, to see how do we really grapple. There is a problem, and the problems is being highlighted by the Sebi itself also, in terms of several of those studies, and which we have put it out transparently in the public domain, what is happening. We have taken a series of measures, we have followed a calibrated approach, series of measures in order to improve the market after wide consultations. And if you had initial consultations, we were proposing something, and then we had variety of views, and we reconciled them, and those measures were taken. And those measures, some of them have kicked in, some of them are going to kick in as late as 1st December as well, and something in October, something in July. In May 25, we had the guidance. We had the choice of, at least only 2 days in expiry, only one index. So basically trying to see that the irrational exuberance from the investors who are not so fine-tuned with the market is somehow contained, including the statutory warning on the F&O when you are wanting to do that. But we have to also see the other side of that, what is the right way to approach this problem, because this is also has many participants, market participants have actually using this as their. So how can we just shut down the market just like that? So this is a very important question. How we will go for that? We will actually said that any further development, we will put it out in the form of a public consultation so that everyone can then chew on that. And we will also do a further data crunching on that.
Thank you. So I tried my best, but I couldn't get it. So that's the way of saying. One more question that everybody wants to ask is this NSE IPO. Will it ever see the light of the day, at least during your tenure and all? Any comment as a Sebi chairman?
Unless you want my tenure to be too short,
Okay.
it will see the light of the day.
Because you could do, as I said, Maharaja auction you did, so you sort of can do wonders. So we would expect NSE IPO, right? Okay. We have, time is running out, but I have a few very quick questions is this. Can you just take us through, so all of us are not very familiar about that Sebi 30-second check, that cyber security, in a very quick way, if you can tell us.
Well, I think through your viewers and theirs, I would like to highlight this is an extremely important development, which Sebi and its thanks to all the market participants, banks and everyone, we have worked out a very unique system in the world. You know that in UPI, we are the leaders in the world in the DPI structure, in the payment structure. But when we are taking care of these 50% of the digital transaction, India accounts for today in the world, 45 to 50%. We also have, facility for the cyber criminals, cyber fraudsters, also to have ease of their business. So therefore, how to really curtail their ease of business so far as the fraud is concerned on investors has been our objective on more systemic basis, because we have to talk in terms of scale, millions of them. And this particular tool will enable people to really be watchful, because I think they spend a lot of time picking their vegetables up and down. They would look at bangan or a bindi, उसको अच्छी तरह से देखते हैं. But उतना टाइम यदि हम एटलीस्ट 30 सेकेंड्स हम यही देखने में कर लें कि किस अकाउंट में पैसा जा रहा है वो ठीक है कि नहीं. सो ऑल व्हाट वी वांट इज वी गिविंग अ 30 सेकेंड टूल कि सारथी ऐप जो है सेबी का, उसमें उसको आप डाउनलोड करें, उसमें सेबी चेक की फैसिलिटी है. जब भी आपको कोई कहता है कि आपको एक अकाउंट चाहिए, आपको QR कोड दिखाया है या बैंक अकाउंट दिया है, सिक्योरिटी मार्केट से लिंक्ड है, यदि वो स्टॉक ब्रोकिंग है, चाहे वो म्यूचुअल फंड के लिए है, चाहे वो एडवाइज़र इंडस्ट्री इन्वेस्टमेंट एडवाइज़र के लिए है, चाहे वो ब्रोकर्स के लिए है, तो उस समय आप उस चेक से या तो QR कोड को स्कैन कर सकते हैं और वो बता देगा कि ये वैलिड नहीं है. दूसरा, UPI हैंडल यदि कोई आपको दे रहा है उसमें वैलिड है कि नहीं, वर्ड वैलिड है कि, उसको देख लें. या फिर कोई कह रहा है कि आप NFT या RTGS या IMPS से ट्रांसफ़र करें, तो उस बैंक अकाउंट नंबर का IFSC कोड और वो देख लें, उसी में करके 30 सेकंड्स में वो भी बता देगा कि ये वैलिड है कि नहीं है. तो ये 30 सेकंड चेक से आप ट्रांसफ़र करने से पहले कम से कम ये कंफर्म कर लेंगे कि जहाँ मेरा पैसा जा रहा है, चाहे वो यूपीआई के माध्यम से जा रहा है तो यूपी वैलिड में हो, या फिर बैंक के माध्यम से जा रहा है तो बैंक के हो, वो सेफ है, ये वैलिड है. So this is, I really see that this is an important systemic effort, unique in the world, that we have adopted. And the whole aim is that it should seep through, this message should go through each and every one, present customer as well as a potential customer who are coming to the securities market, so that they don't lose their money. Market risk होता है stock market में, लेकिन ये fraud risk जो है ये बहुत बड़ा होता जा रहा है और इसको कर्ब करने की जरूरत है.
Thank you, sir. We are running, I mean, we just stop. Time is up, but just with the permission of the House, a few minutes, a couple of quick questions is this. One is that your stance on financial influencers or finfluencers. Is it over, like whatever needs to be done, you have done it, or something more to be done? Quick answer, sir.
ये तो we are doing about 5,000 takedowns every month. So far we have done more than 100,000. 1 lakh से ज़्यादा takedowns हमने किए हैं.
Meaning you prohibited them?
Yes, taking down the content from the platform providers with the help of platform providers like Google, Meta, X. So this is an ongoing thing, and now with the more improvement of tools and with the platform providers also providing reasonable help in terms of their own work on this through AI tools, we should really strike back more forcefully in the near future about those people who are, crossing the line. Financial education is fine, but the things which are prohibited in terms of, misleading the investors will not be tolerated.
Thank you, sir. One potent tool you have in your arsenal is the ex parte order. I'm not getting into which are the orders and what and all, but do you think that there is a scope for using it more judiciously? That's one. And secondly, is there anything else left? Like over the years, Sebi is getting more and more teeth from the government. Anything else you need more power? Very quick answer, sir.
We have enough power. We have to use it judiciously and sensibly and continuously. And we have to own surveillance tools, which we are constantly doing it. We have much better than before, but we will do better. And if we keep using these powers, we will continue to maintain public trust on the capital markets, because as a watchdog, it's our duty to do it.
I know you don't believe in status quo. If I'm not mistaken, I think last week only you started e-office now in Sebi. Is that correct?
That's correct.
But your standard, you're a little late. Should have been done even before.
Sebi was, I admit, Sebi was late in adopting it, but we have, once I came and we sat down and said we should do it, we have done it. But and that will actually increase a notch of efficiency to all our staff. I can say here that we are endowed with some of the best human minds in Sebi, and the teamwork, and with all these 4 T's that we are talking, which we internally will equally apply within Sebi itself, I'm sure that we will come to the level of the trust which the public wants us to perform. We are accountable to people, to Parliament, and I hope we would be able to do it. I can say with confidence.
But sir, my last question to you is this. It doesn't happen often that all 3 key regulators in India, Reserve Bank of India, IRDA and Sebi, relatively fresh IS officers. So is it an advantage that you are actually gelling well, because you are multiple forum, FSDC and all, where all of you working together and all. So I'm sure this is a big advantage for you, 3 IES, know the system so well and working together. So that's actually, we can see the pace of reforms in the overall financial system in India will be now much faster because of this architecture? Or is it a disadvantage because people say that IAS people are very status conscious in the sense hierarchy, who is junior, who is senior, etc., etc. Bahar mein dikhayenge bahut, everything is final, but internally, no, it's not. What is the correct interpretation?
I think it will not be good for me to comment on either a service or to this. To me, I think what's important is we should be able to be, coordination is extremely important, whosoever it might be. So we just can't, the things are too complex now and too important, in my opinion, to be left to anyone's ego. It's very important to really gel along well with others, come to a common purpose, both internally, externally, with multiple participants, fellow regulators is extremely important. So if we are able to have this attitude of, going around and working together for our country, I think it will be fantastic.
Thank you, Pandey sir. So, BS editor, do you have no time for any question, right? No time for it. One question we can take. Yeah, this lady, I think somebody want. Yeah, let's have a gender thing. Just this lady, only one question you have time, sir.
Sir, I'm Nidhi Singhania. I wanted to know the status of sachetization of mutual funds, like where it is right now and how you are seeing that, sir.
I think it's a very important question, and I must admit that we haven't really made much progress with our Choti SIP, because this is where the 250 rupees that we were talking about, we have to see, and we will sit together with the industry to see what is the level where sachetization which will help, bring in savings from multitudes of people who are first entrant and even a small way. And this is one area where we'll definitely like to focus on going forward.
Thank you. One more and the last question. Please introduce yourself and very quick.
Good morning, sir. I'm Praveen Dwivedi from Abokandia Foundation. We work in financial literacy and investor awareness. First of all, compliments for opening the regional offices. That's a wonderful step, I think. Second is that what's the next step in terms of bringing the workforce for education and awareness, which was, I think, very limited for a state like UP and Punjab and all these north states. So that's the question I have. Thank you.
Sir.
Thank you for a very important question. And I think given the scale of our country, we have to really see where our ambition should lie in terms of education. So one is that the regional offices, opening offices, local offices, state offices will help us, bring people on the ground, and so that they can help coordinate better. The second thing is scientific surveys are important. How do we approach the awareness issue? So the first large survey that Sebi and along with its market ecosystem, we conducted that survey, the large investor perception survey, which was released, that has given an enormous amount of information as well as guidance as to how we should approach this subject. People have commented what is the level of awareness. People have commented about what mode of communication is required, what language of communication. Incidentally, only 5% people have said that they want to be communicated in English language. And 47% have communicated that they want to be communicated in Hindi language. And then, of course, 7% in Tamil and so many languages. So therefore, regional languages are extremely important. And now, we have more and more tools to actually reach out with regional languages. We have technological tools where very cost efficiently we can reach. But digital is only one method. Of course, digital video, short videos were created as one major things that people want to engage with. But some of the elder generation would like more of seminar and one-to-one there. So there is a segmentation, the age segmentation, the segmentation on towns and cities and their expectations. We have also initiated a project along with Ministry of Panchayati Raj to involve the block level representatives, public representatives in the exercise of investor education. Because in panchayats and blocks, when they talk about this increasingly, so this will require another very massive projects, because if you have to reach out to 600,000 panchayats and more and the blocks, obviously it will require a scale which will have several those projects will be required in order to reach out.
Thank you, Mr. Pandey. I'm not going to waste our time by summarizing all this thing. I just said big thank you for your patience and for your absolute candidness in giving all the answers. You have exceeded the time. Just one small anecdote I hear from your junior colleagues in 2024, when you are juggling multiple 4 portfolios and all, and running from here to there. I'm talking about Delhi. And somebody asked you, sir, how do you do it? I mean, what kind of energy? What is your source and all? You did say that you have to be at the right time and the right place. And I think we all know, the market knows, all these people, that here is a gentleman at the right time, at the right place. Sebi could not have a better chairman than you. And I'm sure it's the runway, that Maharaja that you auctioned, now Indian market is that Maharaja will take off. Thank you, sir. Thank you for everything.
Glad tidings for the mutual fund industry, with a strong indication in the fireside chat that their hands will not be tied. However, an unambiguous reminder for all that innovation must walk hand in hand with accountability. The next session, a panel discussion with the country's leading mutual fund CEOs, is about to commence shortly. I request all audience members to remain seated. In the meantime, at the Narayanan Vaghul Hall downstairs on level 2, another panel discussion will be commencing on the theme, Has Gift City IFSC Truly Arrived? Those interested should head downstairs for that panel discussion. For everyone else, I would request that you remain seated as our next session will commence shortly. Our next session will commence in about a minute. I request all audience members to remain seated and for the distinguished panelists to stay with us. I request everyone to settle down. The next session will commence shortly. Coming back to the panel discussion in this hall, assets under management stand at 75 trillion rupees, with the investor count at 50 million. Our panelists today will tell us how soon the mutual fund industry could double from here. I now invite Mr. Sami Modak, Business Standard's Senior Markets Editor, on stage. And may I also invite the panelists to join us as well. We have with us today B. Gopkumar, MD and CEO, Axis Mutual Fund. Mr. Gopkumar, please join us on stage. We have with us Navneet Munot, MD and CEO, HDFC AMC. A round of applause, please, for all our panelists. We have with us Mr. DP Singh, Deputy MD and Joint CEO, SBI Mutual Fund. We have with us Vetri Subramaniam, CEO Designate, UTI Asset Management Company. Mr. Subramaniam, please join us on stage. We have with us Mr. Sid Swaminathan, MD and CEO, Geo BlackRock AMC. Please join us on stage. Members of the audience, please settle down. The session will now commence. Over to you, Sami.
Thank you, Bhaswar. Good morning and warm welcome to the panelists and those in the audience. Over the past decade, the mutual fund industry has evolved from a niche saving vehicle into one of the strongest pillars of household investing. With its growing retail participation, with the rising SIP flows, mutual funds have truly become instruments of democratized investing, bringing market-linked wealth creation to millions of Indian households. Today, the industry AUM stands at more than 75 trillion, and the number of investors, unique investors, are more than 50 million, about 5 crores. So here we will discuss today what would the next phase of growth would look like. So I'll start with Mr. Singh. Sir, how did we get here and where do we go from here?
I think, as Chairman Sebi has rightly said, we have been growing at a very, very rapid pace. The growth has been more than good double-digit, 24% growth. It's a very, very, very good growth, and we foresee that the trend will continue, and the industry is going to grow very fast from here on also. And the great success of SIPs, which has been there, will continue, and it continues to be a sunrise industry.
Do you have any internal targets as to when do we hit the, say, 100 million AUM milestone or the 150? Have you set any targets as such, or?
Actually, see, we need not set any target with the growth rate which is happening. If we grow from, say, not from 24%, if we grow by 20% also, it will double from here in 4 years, right? That's the compounding works. So putting a target of 100 trillion from here on is anybody's guess. It will happen sooner than later.
Fair enough. We heard the Sebi chair today say that the AUM is just less than a fifth of the GDP, whereas markets like the US have more than 80%. Mr. Munot, is that a metric which one should look at to judge whether the industry has matured or there is a long runway ahead?
Sure, Sami, so it was very inspiring to hear Sebi chairman acknowledging the role of mutual fund industry and also encourage us to do a lot more. We need to do a lot more to increase the penetration of mutual fund industry. The industry has done a phenomenal work over the last several years. He talked about 4T in the context of Sebi, but I've been talking about 4T which are responsible for the growth of our industry so far. One is the track record. You have many funds which have been delivering for last 20, 25, 30 years. You have the transparency. We take deep pride that this is one of the most transparent industry in the world. It's a technology which has played a big role in increasing access, awareness, and it's the training
training is basically the investor education, the effort industry has been putting together, and individually all of us to create more financial literacy, more investor education. And I think we need to continue to work on all these four to build the fifth, which is the trust. And I think as long as we keep building the trust in the market, trust in the industry, trust among the investors, and work with our partners, I'm sure we have a very long way to go. And over the last 30 years, my experience has been that any number that we projected for the industry ended up doing better than that.
Yeah, fair enough. Mr. Gopakumar, you have been on the broking side, now you're on the mutual fund side. What is the sense that you're getting? Are we on a secular growth path, or has the best played out?
I think when I look at, when I hear DP and Navneet on their views, I'm still 2.5 years old in this industry, but interestingly was the other side of the business where I used to recommend funds. In that sense, last 25 years, I've worked in the industry so closely with AMCs. I think one thing which maybe a bit of argument here to get an understanding in the sense that industry, large amount of AUM today, it looks like is also contributed to mark-to-market. We should thank the markets being where it is. Second point is that when you look at the India population and see that number of unique customers in India is only 5 crore 60 lakhs unique customers, unique PANs. So if you had to do some multiplication, it can be much more, division can be much more lesser. It gives an opportunity in terms of the headroom, in terms of the growth, what this industry has is unbelievable growth. If you look at last 20-year data also, if you look at, you will have 18-20% CAGR growth in terms of industry. The industry also grown because of mark-to-market. Let me come back to again my favorite topic. I think a lot to do. I think we need to do much more in terms of investor education. And one of the audience asked the question to the chairman of Sebi in terms of Choti Sip. Interestingly, say if you look at most of us, I think 4 seats here, also have a SIP at 10 rupees and liquid funds. We have gone to that level saying that we need to get customers, but from an AMC perspective, it may not be profitable, but interesting is to get this set of customers who are on the bottom of the pyramid to come to AMC or using mutual fund as an instrument of saving. I think long way to go. I think my view is that it's a huge opportunity for India in terms of mutual funds as an opportunity. And when you compare to the competing products, which I called about insurance products, I think mutual fund has to do long way to go. I think we see as a large opportunity for us to grow. And it's still a long way to go.
Thank you. Mr. Subramaniam, if you have to wear the hat of an analyst or a fund manager, do you think the industry is something to bet on?
Well, as they say, don't back your own stock or industry. But just to sort of take it back, I think to a more longer term trajectory, I think clearly there is, strong runway for growth. But at the same time, when you draw the kind of comparisons that you do to GDP, etc., we have to be careful because you can't just draw a single point correlation. You have got to look at, where is per capita income, how many people have a reasonable amount of disposable savings. So I think the task in front of the industry is really to kind of make sure, as the chairman said earlier, how do we, sachetize more efficiently so that we can take the ticket size down in terms of reaching larger number of customers. And the other point that I would make is that, I think we have to keep in mind that in terms of the growth of this industry, we've obviously seen a lot of growth coming through from the equity side over the last 5 years. The fixed income portion has not grown. But when you look at India, at an aggregate scale, equity markets are 4 to 5 trillion. The size of the lending book of banks, NBFCs is about $3 trillion. The size of the debt market is 3 trillion. So that market is underrepresented in mutual funds. Multiple changes which have caused this, but I think that will further be a significant avenue for growth at some point of time. Perhaps it will require some intervention, some changes. So I'm very optimistic about the growth trajectory being there. But the one thing, since you've pointed to investment background, I'll point out is that in everything that I have seen in investing, there is a secular trend and there are cycles around the secular trend. So never ignore the fact that there will be some cyclical trends along what is the structural story.
Fair enough. Sorry, sir, to come to you last, but you just starting. So when you go to the drawing board, how do you see the growth of the industry? Do you think the kind of growth that we have seen over the last 3-4 years would continue, or there will be some moderation?
Yeah, thanks. And, absolutely right. We're just getting started, but that's also to your point earlier on, would you bet on this industry? Well, we have, because we're getting started in this industry right now. And, we see, firstly, if you just look at let's say the international part of the joint venture, BlackRock, from a macro perspective, the potential that India has to offer is immense. Whether you look at it as overall GDP growth, increasing productivity, the demographics that are in play here, all of those macro trends are very, very strong for India. And then you combine that with all of these micro trends that we've talked about just here in terms of investor participation at a low level growing. I think there's a huge, huge opportunity here, which is why we're getting started. And, in terms of the numbers, just the last 5 years alone, we've seen a tripling of the assets, almost a tripling of the investors. So even if you take a more conservative stance and say it'll double from here, that's going to get to all the numbers that you're talking about. So very, very bullish on this.
Thank you. One request to everybody, just speak into the mic because the audience at the back is not able to hear us clearly. Somebody talked about how the market has been a tailwind, like post-COVID, the market has seen a phenomenal rise. But the industry also has done a lot to, deepen the reach. So, Mr. Singh, if I can come back to you and tell us what the industry has done and is plans to do to take the mutual funds to even more households.
I think what has been earlier talked, that we are having only 5.6 crores investors. That is something, a big challenge. We need to increase the number of people who are to come to the mutual fund industry. Even if we talk about the SIP numbers, we said, you said post-COVID, we were having around 3 crore kind of SIPs. Today we are having 9.7 crore SIPs, SIP accounts. So that has gone 3 times. But what we have seen is the growth has come in a big way because of the mark-to-market, as Gop has already talked about. But the ticket sizes of the SIPs still continue to be very, very low. In 2021, the average ticket size of the industry was 2,300. And today, though the number of SIPs have gone 3 times, it is still 3,200. That needs to be taken to the next level because the incomes have increased, the level of prosperity has increased, GDP has grown manifold. Even the growth is not in the CAGR growth of the GDP also, per capita GDP as well. So this is a big challenge. We have done a lot, but we need to do much, much, much more. I think the 3,000, taking this 3,000 average ticket size to 5,000 itself in like 3-4 years will do the wonders.
Absolutely. I think 3,000 is still a small number, and I think given the size, the income growth, I think the number can definitely go up. Mr. Mona, do you share the same view? What will it take to increase the average ticket size?
The growth will come from both sources. One is getting the new investors. We still have only 5.5 crore investors. A large number of investors are yet to join. And second, the investors who have already invested, they need to do the right financial planning. They need to do the right allocation. Maybe they have tested the market, they have tested the product, they have invested some money in some funds, but they need to do holistic planning, and over a period of time, in line with the growth of their income and wealth and aspirations, I'm sure they will allocate more. So average ticket size of SIP over a period of time should go up, and of course the average allocation from every wallet needs to go up. And on the other side, there are a large number of investors who are yet to invest. Sebi chairman talked about 13 crore unique investors in capital markets, but mutual funds are still 5.5 crore, which means there are 7 to 8 crore investors who have invested in the market. They might be doing F&O, they might be doing trading, they might be investing in direct stocks, they might be investing through IPOs, but we have a better product, more diversified, professionally managed, more convenient, efficient. I'm sure this is another cohort of investors where we need to reach out over the next couple of years.
Right. Mr. Gopakumar, you said you are about 2 years old in this industry, and often an outside view helps. So do you have any ideas to expand the reach of the MF industry at a macro level?
I think what is quickly changing is that how digital is helping mutual fund distribution, because I call digital as Bharat. And today, the ease of doing business for a distributor is much more easier compared to our days, because I was a distributor, so it was much more easier because the onboarding is much more easier, KYC is much more easier. So that is working pretty fine. And also you will also see a lot of investors are adopting fintechs as a platform to invest in mutual funds. I think the digital leg is what will change and get more customers here. And it also will help you to increase what DP and Namni spoke about, average ticket size. I think one of the areas which I think about is that the fintechs and the digital interventions will help you to improve, because when you look at the most of the dashboards of even a simple MFD to a fintechs have largely improved, because they are able to give a customer an intervention in terms of what does the mutual fund portfolio looks like. And that's one of the areas which I think that if a customer has to increase his ticket size, you need to ensure that there's a transparency in reporting. In our days, it was paper, pencil, where we used to go in Excel sheet to a customer and explain. Today, I think the client engagement at the distributor level is much, much higher than what it was 20, 25 years back, because there is a large amount of transparency. You can see a live his portfolio looking like. So my bigger bet is that. Second intervention, which I think I touched a bit, which was my favorite topic, is that how do you get the bottom of the pyramid of people coming here? Because India has large amount of people at the bottom of the pyramid, and how do they come to a mutual fund because they are largely investing in FDs and put money on chit funds, they put money on typical credit cooperative societies, which we see every day when you go to a dukan or come out of the house, you'll see that. I think there are a lot of work is happening. Let me tell you that fintechs are doing a lot of jobs. Industry is supporting these fintechs by reducing the ticket size and getting this set of investors. So I'm pretty hopeful that maybe 3 years from here, I think we'll have much more customers, unique PANs, unique customers coming to the industry.
Yeah, thanks. Mr. Subramanian, if I can come back to you. UTI is a legacy or a traditional fund house, and how do you look at these various channels that are available to as touch points to go to the investors, and which one could sort of be more efficient?
Sure. Thanks, Annie. I'll just take that in a slightly different thought process. You're right, UTI has been an institution which helped sort of create the investment culture, goes back to our legacy more than 60 years. And, we've talked a lot about where to get new customers from. But I think from our vantage point, when we look at customers over the last 60 years, we ask ourselves the question, why do we exist? And we exist for a very simple reason, which is to enable our customers to meet their goals and aspirations, the financial side of that. When I look at that and I look at the client data, there are two things which strike me significantly. As much as there is scope to grow the industry, we will fail in our objective of enabling customers to meet their goals and aspirations if we don't make sure that they stay for a long period of time with their investments with us, right? So I think as much as it's very exciting to talk about, the new avenues and mediums and products through which you can bring in new customers, really it will be rewarding for my customers, for all our customers, only if they stay with these products for their entire financial journey. And I have been a part of this industry where in 2010, 2013, we saw the actual folio count drop by almost 20% during a difficult 2 to 3 year period. So I think as much as we look to grow the industry, we as an industry have to take the responsibility for educating our customers, the investors, the partners, the distributors, and everybody who's part of that ecosystem, to continuously remind them that they will get the benefit of the financial products that they have come to us, they have invested with us, if they stay there for the length of the entire journey, and that's a 10-year, 20-year journey. So as much as it's nice to talk about growth, I think as an industry, we carry the responsibility of what I call N, which is the period of time for which they stay invested in our products, because that is when the magic of compounding actually happens.
Yeah, this is a very important point, and we'll come back to how the market volatility, has impacted our investment behavior. But before that, Sid, there is this buzz that, we'll have a geo moment for the mutual fund industry. And given the reach of one of your parents, do you think there is a scope for disruption in this space?
Sure. So I'll answer it in two parts, right? So firstly, it's a very different industry, right? So the players are different, the rules are different. So I think comparing mutual funds to telcos is probably not the right thing to do. But I do think in terms of how we are approaching this industry right now with our go-to-market strategy, there are several, let's call it micro disruptions that can happen, which over the multiple years could lead to a bigger change. Now, we talked a little bit about the digital ecosystem, right? And I think that's one that we've clearly leaned very heavily on. And to the points made earlier, that's super encouraging even in our early days. So we have roughly about 7.5 lakh investors right now. Almost 10% of them are completely new to the industry, right? So that's a very good stat for us to see that through digital means, we're able to reach people and we're able to bring more people into the industry. That's a very early encouraging stat. Now, the key, obviously, to keep this going is education, right? So that has to amplify. So we have to do more. We have to do a lot more in regional languages so that people can understand. So we need to meet the people where they are. And again, technology is enabling that. And to the point that the chairman made earlier, with AI, you can easily deliver bite-sized content in many languages, in many styles across the country. So I think that is a huge, huge enabler with digital. And once we do that, once we educate people about the importance of investing, staying in the markets, and with SIPs, we're seeing some of that behavior coming through already, and then build the trust, then the phone becomes like the biggest liberator there is, right? Because no matter where you are, you're able to access it, and we're seeing more and more people in many, many parts of the country do that. And even in our early days, we're seeing nearly 40% of our retail AUM come from the B30, which is actually above the industry average. So these are all very positive signs that we are seeing in our early days in the market.
Yeah. Now let's sort of understand from you what has been the, how has the market volatility impacted investor behavior? We have seen last 1 year, the benchmark indices have not gone anywhere. So is that something which is worrying investors, or do you continue to see them remaining for the course of, say, 5 years, 10 years? Mr. Singh, if you can take that.
I think volatility is part and parcel of the market, and we have to live with that. As Chairman Sebi rightly said, it's not that we cannot ignore the shocks, we cannot ignore the volatility, but our ability to come back strongly is there. So I think our markets are very, very resilient. And today, when the industry is reaching almost 35 lakh crores in the equity assets, with the average 5% cash also, we'll be sitting on 1.7 to $2 trillion of cash at any point of time. So any shock which comes, the volatility, the industry is able to take care of that. I mean, any fall is seen as an opportunity. That gives a lot of comfort to the investor. But while saying so, yes, our markets, volatility plus the valuations. Valuations are definitely stretched as far as Indian market is concerned, and but the growth is also here. So we have so many pluses, so many minuses, so all put together. The industry is very resilient, and I think Navneet and Navneet and Vetri from the investment side also, they'll be able to respond better. But from the market point of view, I think volatility will continue to be there. We're going to have its phases every now and then. Different cycles will come, but the long-term story will remain intact, and that we have seen the small investors, the retail investors, have seen a very good cycle. They have not, we have seen a very positive side of the behavior, that as and when market falls down, more and more people are coming into the market. So why we are talking more about the SIPs? Because in the net flow in the industry, the major part today is being played by the SIP flows, which is almost 30,000 crore now. So going by these volatilities, I don't think there's any challenge. We'll continue to grow with the kind of potential which is there. So we'll continue to grow with the volatility.
Mr. Munot, Mr. Singh just said that volatility so far has not been a concern for the industry. Do you also echo the same sentiment, or you have a different take on this?
Now, I mentioned earlier, we have funds which go back 30 years, and investors have seen that there have been like many periods of volatility. That's the nature of the beast. It's inherent part, integral part of the equity market. I think over the last couple of years, the good work industry has done, and a lot of credit to our distributors and advisors who have been handling the investors, mentioning the point that take advantage of the volatility and don't get swayed by the volatility. Volatility can be your friend. I mean, if you are investing in a disciplined manner, if you are focusing on patience and consistency rather than getting swayed by it. And I think that has been keeping us in good stead so far, and I remain confident that if we continue to remain on this path of the investor education that all of us put together have been doing, I'm sure there would be more resilience, there would be more discipline among investors. I think that's one of the biggest challenge as well as the biggest opportunity for the industry.
Right. I'm sure most of us often think about this, that the markets are not doing well. One should.
So our SIP book was 4,000 crores in 2017, and it is 29,000 crores now. During this period, we have seen a big, I would say, boom and bust in mid and small cap in 2017 to 19. We have seen the COVID period correction in 20. We've seen a lot of volatility in 22. We have seen a lot of volatility in last 12, 13 months. But that SIP book has continuously been growing, which is a reflection of maturity of individual investors, which is a reflection of resilience of individual investors.
That's true. But then this is the first time that we have seen an extended period of volatility. I mean, post-COVID, the markets were on a secular growth path. But right, as you rightly said, patience is something that investors should follow. Vetri, I mean, do you think this is a stage where somebody should, there's a case to increase your investments in the markets, or how does one sort of look at the consolidation in the market? Does it call for more investments, or one should, I mean, take a step back and wait for more correction?
Sure. Honestly, the way I would answer that is, there's no point when you're trying to achieve your financial goals and aspirations to keep second guessing and reacting to the market. So really, the only way I always answer this question is stick to your financial plan. Stick to your asset allocation. As long as you're doing that, that will get you to your destination. Leave it to the fund manager to figure out how they want to deal with the challenge of volatility, how they want to deal with the challenge of valuations, how they want to deal with the 101 challenges that will happen. See, the market is a very surprising place because unexpected things always happen. Sometimes they're good, sometimes they're bad, sometimes they're difficult. Leave that to the fund manager. I think my message to investors would be stick to your financial plan, stick to your asset allocation. That is what will get you through to the destination. And, I think on the point Navneet made, without doubt, I think, the kind of steadfastness we've seen from investors at this point of time in terms of the SIP, the pipeline. Yes, there have been some cancellations, but at the same time, I would say net has been a very positive trend. So I certainly take heart from that. But all of that should fit into a financial plan. I think as an industry, what at least certainly at UTI, we always lead with on the front foot is that don't just go to investors and sell returns. If you at the outset explain to them risks, if you are able to highlight the periods of volatility that they are likely to experience during their journey, then they are better prepared to tackle that volatility during their journey. If you have never prepared them and you've only sold them the 5-year historical return on the fact sheet and they haven't understood that that journey involved volatility, then they will be underprepared when that occasion actually happens. So I think if you can prepare the investors for the journey appropriately, then they will be able to, continue through the journey for much longer periods and get the benefit of compounding. And believe me, as an investor, I've been doing this for 30 years. There are some things in the markets that you learn only by experiencing. It cannot be taught to you. And I think, therefore, everything that we can do to handhold the investor during that journey, give them that experience of coming through a slump, that's when they really start to appreciate the product and the investments that they've made.
That's a very powerful message. We have just 2 or 3 minutes before we can open the floor for questions. Sid, I would like to ask you about passive investing. Last year we saw the number of account additions on the passive side were more than the active side. So is that space which will continue to grow faster than the active, or how do you see both active and passive? I mean, what would be the investor preference between these two?
Yeah, I think firstly, it's never about active or passive. It's always active and passive. So I think both play a very important role in an individual's asset allocation. And I 100% agree with Vetri. Like, asset allocation is the most important thing in terms of individuals achieving their goals. In terms of the growth, yes, I think there is a lot more scope for the passive business to grow here. We're still at about 17, 18% of the market. If you look at other sort of developed markets, Europe is at over 30, 33%. The US is over 50% right now. So as more and more people think about their asset allocation and say, okay, what part of it do I want to allocate to just a passive portfolio, and where do I really want to focus my efforts on doing something active? I think you're going to see more and more of that. Obviously, there's cost benefits as well to doing that. So yes, is the short answer, is that there's a lot of room for growth from here.
Right. Mr. Manoj, before we let you go, I mean, you're the largest listed AMC. Two things. One, how is the rising popularity of passive funds impacting your margins? And two, Sebi recently came out with some measures which we saw the markets react negatively to. So do you think that as the industry grows, there will be more pressure on costs?
I mentioned about the track record of our active funds for 30 years, but we are also one of the oldest player on the passive side. Several of our strategies have been there for 20, 23 years or so. For us, more important is how are we serving our investors. And we want to be a one-stop solution for each and every investor in India. Our mission is to be the wealth creator for every Indian, And if they want to have a passive in the portfolio, we have the full product range, be it index fund, be it ETFs, be it market cap based indices, smart beta, sector thematic funds, so on and so forth. And of course, we have an active funds as well. So for us, it's up to distributor and the advisor to create the portfolio and for the end investor to choose. And we don't look at like, how it, for us, it's important is that wherever we have the investment capability and the risk management and product capability, we would offer that product to the investors, and it's up to the investors to choose. Also, I think while globally there would be a higher proportion of passive for a variety of reasons, I think very few fund houses in the world can boast of the track record that we have for 25, 30 years in India in terms of the outperformance. A lot of people look at the number of schemes outperforming or underperforming. If we just flip that to the AUM outperforming or underperforming, we'll be positively surprised to see that in India. On that note, if you let me go.
Yeah, please. Mr. Manoj has to be somewhere. Thank you, sir, for being. Thanks a lot. Thank you, sir. We'll just quickly have another round of questioning, and then I'll take some audience questions. Mr. Gopakumar, Sebi has brought in new avenues for AMCs to increase their profitability. SIF is one such thing, and also Sebi has proposed to relax certain clauses which will allow fund houses to get into advisory and other kinds of related business. So do you think what do you think of these new avenues from a AMC point of view?
I think SIF is a good move because even though there's 7 categories, helps us to innovate, because most of the time when you look at innovation in mutual fund industry has become restricted because largely straight-jacketed by the regulator that what you can do, what you can't do. I think in terms of that, I think SIF is going to be a large category. That's our view. We are very clear that it can impact a couple of categories in the mutual fund, and that will help us to grow in terms of industry as well as we as an AMC. So that's one category which we do believe it is going to be a large category and huge opportunity for the industry. It will play out from a 12 to 18 months perspective because now the products are getting launched in different categories. I think it will take time, but I think you will see that this is going to be a very important category, and it's also going to be an important category from a customer asset allocation perspective. I think my view is that a couple of categories like arbitrage, hybrids, you will find this product to be very, very competitive, giving the similar risk levels. You will find that opportunity. Second area is on the advisory side. I think there are opportunities on the advisory side which industry is looking for, because there are opportunities where large family offices want to look at customized portfolios, which today we can do, but we can't do in some categories for the restrictions. I think this allows us to relook at it. I think that's one more opportunity. I think the last thing which I want to talk about is that everybody refers to 3 days back, whatever time bomb, whatever called as. I think it's a great change because there are a lot of clarifications the industry is required. I think that is done. My view is that more and more we become transparent in terms of charges, what we charge to customers. I think the industry will grow further because a lot of trust will come into play. I think that's one thing which I want to make a remark about.
Mr. Singh, very quickly, you are one of the first entrants to the SIF space. Do you think SIF will sort of eat into the existing AUM, or it will create fresh opportunities for the industry?
No, definitely, see, the category-wise it may have some polarization, but overall the category will grow and the whole industry will grow. This is a new innovative product, and some of the things which were not available to the mutual fund investors, that is being made available. As Chairman Sebi clearly said, the PMSs, etc., are the personalized accounting and personalized taxation. On these things coming on the mutual fund platform and giving the different kind of solutions, I think it was a need of the hour, and it will grow and grow very, very fast. This will help in growing the industry. Yes, we have launched one fund initially. Being the leader, it's our responsibility to do it. We are taking the baby steps, we are learning, and I think we have done a very, very good job. We targeted a lesser amount, lesser people, because number of distributors who have cleared the exam is very, very minimal. Right. In my knowledge, in Pan India, there are around 2,000 people who are certified people. And you will be surprised to know that 30% of the investors who came into SIF category, 30%, are new to the industry investors.
Okay, interesting.
Which is, otherwise it was being perceived that the people, evolved investors, people from mutual fund will go to there. Right. 30% of the new investors and 70% of that have come under the direct category.
Okay, interesting.
So that's the kind of the role of digital, role of say media, role of education which is happening in there. So those are some of the trends which we need to work on. That is telling us something. We have to create more number of intermediaries, more number of distributors who can get themselves certified. Right. And I think we have of the firm view that this will be a new growth trajectory for the industry.
Yeah, thank you everyone for this stimulating discussion. We'll take a couple of questions. We have time only for 2 questions. If you can pass on the mic.
Sirs, you are doing excellent job on the customer education. There was one question which was raised in our community. Why do you use the bank name in your company name? Because people at the rural side, they get confused whether it is a bank or it is an asset management company. They don't even know whether it is annual maintenance contract or there is a asset management company. So that kind of profile of the people is there. So do you think if you remove the bank name from your company, there could be a great education which can get passed on and they don't get confused between guaranteed income fund and the mutual fund?
I think we have passed that stage. It would have been relevant 20 years ago, but not today. Anybody and everybody who is putting in money, they know that where they are putting in money. SBI or Axis or HDFC or ICICI, they are the sponsors, and this is something. That's why, especially in the SIF, they said you have to have a different brand. And you would have seen in all our, when we came out with the funds, we have never talked about SBI too much. We have talked about Magnum SIF. And same has been done by the others. So, but where the sponsor is coming out, they are in the business, they are sponsors. Why it should not be? And we are doing enough. People know that this is different business. Those kind of naive investors are very, very few who are going to the bank. And wherever they are putting in money. I mean, if you talk about today about us or HDFC or ICICI or Axis, I mean, only 20% of my business is coming through SBI, 80% of the business is coming from other channels or the direct channels. So that's no more a threat. This is just a perception in some people's mind, but that's not a correct perception.
Yeah, one last question, please.
My name is Yasser Pitalwala. My question is about the longevity of SIPs, particularly in direct plans. You have all talked about the contribution of fintechs, but we've seen that the longevity of SIPs in direct plans is even lower than that of the traditional SIPs. And as Vetri pointed out, in both cases, they are less than 3 years, which is not the optimal time for equity. What can the industry do to improve the longevity of SIPs, particularly on the direct channel, as the contribution of the direct channel increases further and further?
I think that I agree with your challenge. I think one of the things which I would have commented about is that when we compare mutual fund industry with the insurance industry, you will see that difference in terms of longevity of the SIPs. More and more when I look at this whole issue about direct, I think when you look at these fintechs which looks at direct, in the direct model, their job is not to sell mutual funds, their job is to acquire customers through mutual fund. And I do see that their education in terms of building a stickiness of SIP with this set of customers are very limited. Having said that, this set of fintechs today open up with us and say that you can do the job. So a lot of work has happened in terms of building the customer engagement of this set of direct customers. I think it's a long way to go. I agree with you that industry has to work hard. And when you look at this category, very important to look at age category also. If you look at from the younger population who comes from fintech, the persistency levels are pretty lower than the normal. You look at 40 plus, the persistence is much higher even in the direct. So industry has that challenge compared to different channels. Fintech has been a bigger challenge for us in terms of the persistency, but the agenda of the fintech is different. They're getting customers and they're cross-selling broking and a loan product. So in that sense, they've allowed us to engage with the customer. I think a lot of work has to happen, but I think work in progress in that sense. Did you want to have something on that? Because you'll have much more insight on that.
No, I agree with you what you said, but see, longevity is something which is definitely required. If you compare it with the bank accounts also, if you open a fixed deposit or open an RD, and if you withdraw before time, there's a penalty. But unfortunately, in our business, the exit loads have vanished. Exit loads, sometimes people see that this is more to keep the money for a long period, but definitely, I will definitely advocate that if you are putting an SIP or to remain disciplined, there should be something along with that. But unfortunately, because we are the capital markets and mark-to-market happens, people have to take their view. So the regulator is also of the view, if the markets are not doing well, we should give the opportunity to people to exit. But at the same time, the fintechs are playing a role, and the longevity is very less on the direct plan. This is a challenge. I think on this also, more of investor education is required, that rather than putting any guardrails that you should not withdraw. Maybe we'll be able to work on that.
Thank you. We have exceeded the time. As we heard today, the domestic mutual fund industry is not just growing in scale, but also in purpose. And I'm sure the journey ahead will positively impact millions of lives. Thank you very much, everyone.
I request the panelists to stay with us a bit longer for the presentation of the mementos. A reminder for the investors, the virtue of patience and discipline. The mutual fund CEOs advise that stick to your financial plan and asset allocation and let the fund manager deal with volatility and other challenges. Next up, we have a fireside chat with Mr. Ridham Desai, Managing Director and Chief India Equity Strategist at Morgan Stanley, on what makes him an India bull. I request the audience to remain seated. Our next session with Mr. Ridham Desai will begin shortly. I request Mr. Desai to join us on stage. And may I also invite Mr. A.K. Bhattacharya, Business Standards Editorial Director and the moderator for this session to join us as well. Over to you, Mr. Bhattacharya.
Thank you very much, Vasper. This is a session that will be, I think, very exciting session in my view. And with Rhythm Desai on my side, you can very well assure yourself that it will be even more exciting. This session is about why you are bullish on India. Let me ask you a completely contrarian question. Have you ever been bearish on India?
Yeah, I have been actually.
When and under what circumstances?
No, so in January 2007, I had written a report called Skating on Thin Ice.
Okay.
And I had predicted that the Sensex will go down to 11,000.
What was it then?
It was about 15.
Okay.
However, of course, I went totally wrong because in the subsequent year, it went to 22,000.
22,000.
By the end of 2008, it was down to 11.
Okay.
So my call was a bit early, but in 2007, I was very worried about the incessant appetite for IPOs, about the valuations of the market, and also the excesses in earnings. Because profit share in GDP had hit a peak, so margins were peaking out. So the view was that earnings will slow down, that the IPO boom will cause a technical issue, and then the valuations will give. But it took a little while because the world was in a tearaway bull market, and it wasn't.
All boats were rising.
It wasn't until January 2008 that played out.
Yeah.
But yeah, I was bearish then. I was a little bit concerned in 2013, but that was a very short cycle. I have to say I've been bullish since 2014.
Okay, that's right.
So
that's
this
right.
is the 11th year of my bullishness. And that doesn't mean that the market will deliver absolute returns every single year.
That's right.
Because I keep reminding people that equities is the longest duration asset class in the world. And you have to have a longer term view. It's not a fixed deposit. It's not a bond. Minimum 5-year view has to be had. If you can't afford a 5-year view, you shouldn't be less than 3. If you want to do equities for 12 months, good luck.
Okay. So, from being bearish to being bullish for the longest duration of time, what has changed? What made you bullish? What are those macro variables, as they say, which underpin your constructive view right now?
See, there's a fundamental change that has happened in India, and it is not what people in this room are thinking.
Yeah.
The fundamental change has happened on our saving deficit, or what we call as current account deficit. The current account deficit technically is the gap between our saving rate and our investment rate. And India has historically always had a higher investment rate compared to saving rate, so we've had a higher current account deficit. And behind this, the reason is because we had very little to sell to the world, and we had to import our energy requirements. And it was very large quantity of energy that we had to import. So at any point in time, we ran current account deficit, which would be between 2.5% and 5%. Now, historically, this current account deficit was largely funded by flows from the capital markets, because we didn't really attract much FDI. See, putting up manufacturing units in India for a multinational company is a nightmare. And therefore, multinational companies preferred not to do it. If they wanted an operation in India, they would go and acquire something that was already on the ground. So we always struggled for FDI. So we would get funded with capital market flows and largely equity capital market flows, because our fixed income markets were close to foreign investors.
Correct.
Now, equity market flows tend to be very cyclical. And in fact, they hit a trough exactly when it goes against India's cycle, which is during US recessions. So when we most need it, they actually vanish. So in 2008, as an example, India had nothing to do with the global financial crisis. Our banks were absolutely fine. And I was discussing this with Tamal before this session that, the RBI was already anticipating problems, so had already tightened up. Our banks were in very good condition, but we were the second worst performing market in 2008. And that was largely because the global capital market cycle turned and we lost access to flows. Now, I'll come to this point a little later, but I'll still make it today. And this happened at a time when oil prices were going up because there was a supply shock in the oil market. And people in this room may not recall, but in July 2008, for reasons that were completely separate from financial markets, oil price hit a peak of $148 a barrel.
And Goldman Sachs was talking about $200 a barrel.
You've got good memory. And by the way, we have never gone back to that level since.
Yes.
Okay, so since in the last 16, 17 years, oil has never gone back. It threatened to go back during 2022, but it never really went back. Now just, I'm going to digress a bit and keep this math in your head. India had just become $1 trillion economy then. And how much oil were we importing? On a net basis, we were importing 900 million barrels of oil. Now at $148 into 900 million, that is $140 billion was our annualized import bill in the month of July 2008. Nobody on the planet will fund 14% of your GDP.
Yeah.
Because that was 14%.
Yeah.
And so we crashed. We had to. The rupee had to go down, interest rates had to go up, and stock markets had to react to this. So that was our situation then. In the last 10 years, we have completely transformed this. And it's a story that even the government doesn't advertise, which is that our oil dependency has gone down by almost 60%. Trailing 12 months, India imported 1.7 billion barrels of oil net on a $4 trillion economy. So our economy has quadrupled since 2008. Our oil import bill is up 80%. Now, oil is, of course, at $60, but let's assume it goes to 140.
Yeah.
Right? 140 into 1.7 billion barrels will get us to about an oil import bill of $330 billion, which, in a really worst-case scenario, will still only be about 6% of our GDP. So even if oil went back there, which it is not going, oil is no longer consequential to our current account. And this fundamental change means that we are now not running such a large saving deficit. Now, on the other side, something quite good has happened to India in the last 5 years. And this is the silver lining of COVID. So COVID was bad news for everyone. But one of the good things that happened was that typical MNC CEOs realized that it's okay to work from home. And if you're going to work from home, you might as well work in Mumbai. It's a whole lot cheaper than working in Florida. A lot of Americans went back to Florida and to warmer places during COVID. But Mumbai tended to be much cheaper and you could hire talent at scale. So what we have seen in the last 5 years is a big boom in what we call as GCCs or Global Capability Centers. They exported circa $70 billion of services last 12 months. And this is a secular shift that has happened on the planet, AI or no AI. And if you want, we can investigate this later. But this 70 is probably going to double in the next 4 or 5 years. Now, this is unlike IT services. IT services are also cyclical because they depend on US growth in large part. And when US growth goes down, IT services growth also goes down. And that happens exactly at the time when India most needs the money. So as a consequence of the lower dependence on imported fuel and the emergence of a secular export for India, this has meant that our current account deficit now is largely less than 1%, probably 0.5% of GDP. And 0.5% is about $20 billion. And $20 billion is loose change in the global markets. Fundamentally, we are no longer as dependent on FPI flows because FDI has become more viable. And so this has completely altered India's external dynamic. Now, the consequence of this on the stock market. So what is the consequence? Now, also something else happened in 2015, which is that we migrated to flexible inflation targeting. And the consequence of that 10 years on is that our inflation volatility, forget headline inflation rate, certainly gone down, but inflation volatility is the lowest in the world. Now understand what this means for the stock market. When inflation vols go down, your growth, interest rate volatility goes down. If interest rate volatility goes down, growth volatility goes down, because all growth cycles are produced from interest rate cycles. And if your growth volatility is lower on what is a pretty good headline 10, 11, 12% growth that we're doing, it means that the numerator, which is what drives equity valuations, is looking very attractive for equity investors. In the denominator, which is basically the discount rate, I would argue, and I won't be surprised if this unfolds in the next 2 or 3 years, given the lower saving rate, saving deficit that we have, the lower current account deficit that we have, it means we can actually fundamentally run lower real rates. So historically, we have had to run higher real rates for the fear of our current account deficit widening. Now we can run lower real rates, which means interest rates in India will be lower than they have been historically. And for anybody who understands equities, PE is a very bad way of judging valuation. You judge equity value by discounting future cash flows. The discount rate is falling. The future cash flows are more predictable. What happens to the PE multiple? It goes up. At 20 times, India is cheap. And who knows this best? Our domestic investors, which is why domestic flows are strong. It is not the other way around. It is not because domestic flows are strong that the PE is elevated. The PE has gone up because fundamentally India has changed, and that is why domestic households who are probably much smarter than foreign investors are making this fundamental shift in their balance sheet. In 2015, they had just 3% of their balance sheet in equities. Today, that number is 7.5%, 8%. I won't be surprised if it goes to 20. The number is 50 in Europe, 40 in America, 20 in a conservative society like Japan.
So that's possible.
Oh yeah, easily possible. So when people ask me, when will the domestic flow stop? I say, not in my lifetime.
Okay. May you live longer.
Yeah, I do worry about living longer, but I think it's not changing in the next 20, 30 years.
You made a very interesting, gave a very interesting equation from a macro point of view. What you are saying is that we are becoming less dependent on the FPI flows. We are more dependent on a little bit of FDI. I mean, whether it is net or gross, let's not get into that debate. But remittances have also done very well in this period. So haven't remittances also played a big... India is the largest remittance recipient country in the world right now, which it was not.
But remittance is part of the current account. So that number is already netted off in that 0.5%.
Yeah.
That is, including remittances. So that is not funding. What funds the current account deficit is either FDI or FPI. And FPI now comes in both equity and debt.
That's right.
But the material point is that the absolute number that India needs is about $20-25 billion, which is really nothing.
Nothing.
So we are not so dependent on global capital market flows like we used to be. And when you're not dependent on global capital market flows, what happens is the beta of the market goes down. So India in 2013 was a 1.3 beta. So I don't know if everybody in this room understands beta, but it was far more sensitive to global conditions than it ought to be, because we didn't have such exposure to the global economy, but we had exposure to the global capital markets. Today, India's beta is 0.4. It's a quintessential defensive market. So when you're searching for explanations as to why India has not done well this year, the most proximate reason is because we've been in a raging global equity bull market. And India is not going to do well. It's a consumer staple stock. Consumer staple stocks don't do well. When the next bear market arrives, India will flourish. It's a 0.4 beta market. It will be so defensive, everybody will want to own India. So that's one of the reasons. Of course, there are other reasons why India has not done well on a relative basis. And just to, this audience may already know this, but if you look at the top 20 markets by market cap, trailing 12 months, India is the worst performing market in the world. And the second worst, I will leave it for this audience to guess. You can go and find out. But you'll be surprised when you learn which is 19th on the list.
Okay. Let me ask you that you are bullish, but what can go wrong?
Lots of things can go wrong.
Yeah. Why don't you list at least 3 of them?
Yeah. So I think most of the things that can go wrong for India are outside India's control. And that makes matters worse for us. Because when things are in your control, then you can fix them in advance. So, for example, our corporate balance sheets are very pristine. I disagree with the common narrative that the household balance sheet is stretched. Far from it, it is not. It is actually quite okay. So there's no problem on the balance sheet. We have a massive reform tailwind. You know, one of the things I tell foreign investors is that in India there's such low-hanging fruit. We just have to stretch our hand and pluck it. And suddenly, you will get an unleashing of growth opportunity. It's like what the government yesterday, I think, day before yesterday, proposed on the utility sector. Yeah. It's such low-hanging fruit. Suddenly, the entire sector can get reformed. Or what it is proposing for PSU banks. Or what has happened in the private banking sector, where, a couple of large FDIs have happened. So this is also easy to do in this country. We don't have to do some earth-shattering legislation. These are very easy steps to take, and we are taking them right now. So given that low-hanging fruit, I think India is pretty secure on its growth outlook. But the world is looking very messy. And this is not a comment for the next 6 or 12 months, so don't misunderstand me. I have said this even 2 years ago, and nothing has happened so far. But the world is sitting on record debt and is aging. And that's not a pretty combination. I kind of agree with Elon Musk when he says that the world has a population problem which is much larger than climate change. Yeah. Because we as a race have not really figured out how to reverse a declining population. And we may get there before the end of this century. And after that, it is going to be problematic. What is India's biggest moat? It's all of us. It's people. See, the world talks about robots, but robots don't wear clothes. They don't need drive cars. They don't eat food. They don't take vacations. All they need is metal and electricity and some circuits. So they are not consumers. And if robots start running our factories, who are they going to make things for? They're going to make things for human beings. And this country has more human beings than anywhere else on the planet. So it is the most attractive market, which is why multinationals are queuing up to access this market. Some of them will put FDI, will say, I need a factory in India. Some of them will not do that. Later on, I think they will change their view. But this is the reason why India is the most attractive place on the planet. Our estimate, Morgan Stanley's estimate is that for the next 10, 15, 20 years, India will be one-fifth of global growth, 20%. So depending on what product or service you sell to your customer when you're a multinational company, India could account for between 10 and 100% of your revenue growth. If you're not in India, good luck to you.
Absolutely.
So I think India is fine. But the world is aging. The world has an indebtedness. Some point in time in the next few years, this will unfold in the form of a problem, a crisis.
Any other problems?
Yeah. So the other issue I think is the shifting nature of geopolitics. And I think this is going to be a difficult ship to navigate. We don't choose our neighbors, but most of our neighbors are either bankrupt, both politically as well as financially, or at least bankrupt in one form or the other. So it's a very harsh neighborhood we live in, and we can't change our neighbors. So that always, threatens India in some way or the other, and will have to be addressed, and it'll be a difficult thing to address. Internally, if I were to say, one thing which I think needs fixing is the farm sector. We have approximately 200 million farmers, and the farm reforms that were proposed a few years ago, I think, were extremely bright and necessary. And we need to lift our farmers out of poverty. Otherwise, what will happen is the remaining 1.1 billion people who don't depend on farming will race ahead. And these 400 million people who get left behind will become a problem for society. So I do hope that at some stage we start implementing some durable farm sector reforms to lift this. Now, there is a huge upside potential. India has about 350 million acres of farmland, which is approximately half the country. Nowhere on the planet, I think, any large country has 50% under agriculture. And the reason why we have so much of land under agriculture is because we never got industrialized. So we have preserved a lot of our farmland, but productivity is very low. If we operated at Chinese levels productivity, I reckon that our farm economy could be $2 trillion. We could end up feeding half the world. With that, that's the potential of our farm sector, but it needs to be unlocked.
Let me turn to the non-farm sector. Corporate earnings, is that a cause for concern for you because they have not been doing too well? Is it because of internal factors or is it because of external factors? You talked about farm sector reforms. There was no labor reforms in this country for several years, although the government has been talking about it. So how do you look at the corporate earnings in a larger context?
See, this cycle for corporate earnings started with profits at 2% of GDP. And this 2% came from the previous peak of 7%, which we hit in 2009-10. From 2, we climbed to 5, and then there was a mid-cycle slowdown. The mid-cycle slowdown happened last year. I think the two reasons that would have contributed were A, RBI is running a very tight ship, and B, because of various idiosyncrasies around the election cycle, government expenditure slowed down. So we arrived in September quarter last year where the fiscal deficit had gone down from 6 to 3.4%, and real rates were high. And that became the proximate reason why growth slowed down. And you know, all this affects earnings with a lag, so the next 2 quarters tended to be bad. In February, the RBI made a pivot, and that pivot has gotten stronger and stronger. And in fact, let me state here that in April, when the RBI cut CRR and cut interest rates, double rate cut, that was very unique. In the last 25 years, it's only happened twice. One was during the global financial crisis, and then again during COVID. April 2025 did not represent any such situation. It wasn't a crisis of any sort, and yet the RBI chose to do this, which tells you the RBI's mindset has totally changed. The deregulation that they have followed up with since, I think sets us up for a very strong growth cycle. And then the government backed it up with GST rate cuts in September. So I'll be surprised if growth doesn't turn and turn really powerfully in the next 12 months. So corporate earnings, I don't think will be a problem. I think this 5 is going to go past 7, probably 8 or 9 in the next 4 or 5 years. So if share of earnings in GDP goes from 5 to 9, nominal GDP is say 10, 11%, you're looking at 15 to 20% earnings growth. And that there is another 3-4 years of that to come. So corporate earnings will recover, I think, in the ensuing months.
But the capacity utilization is still very low.
It's in the high 70s, and I think with the type of nominal growth that I'm sensing, we'll be into the 80s, so there will be capex also that will come in. Yeah. Also, you know, see, people are searching for more capex, but the fact is that private capex to GDP is at over 31%. Yeah. Now, the previous cycle peak was 39, and I don't think that is a good benchmark for many reasons. One reason is that India's productivity has improved a lot in the last 15 years. When productivity improves, you need lesser capital for every unit of growth. So the next cycle peak is unlikely to be 39. I reckon it will be more like 35, 36. The second is that the nature of capex has also changed. I mean, think about all the tech companies. They incur capex, but they don't capitalize it on their balance sheet. They recognize it as, revenue expenditure. But it is still capital assets that are being put on the ground, which have got ability to generate recurring revenue. That's the meaning of a capital asset. So some of that has also happened. But this 31, I think over the next 3-4 years will probably go past 35.
Okay. Okay. I'm sure that this audience is raring to ask you many more questions. So we have around 5 minutes time we have kept. But let me ask you one question before I turn to my audience. So please, mic should be made available. If indeed, and I largely agree with you, that the scenario looks quite bright going forward. If that is so, what is stopping the FPIs from investing in India? Are they fools? Don't they see what you see?
No, they're not. They're not.
Yeah,
You see, let me make 3 points here.
Yeah.
So first of all, every morning 9:15 there is a domestic bid, 100, $200 million. Now, unless issuances exceed that bid, foreigners have to sell. It's a technical point because there are only 3 cohorts in the market. There is a domestic buyer, there's a foreign buyer or seller, and then there is a corporate issuer. So the fact is, in the last 12 months, the corporate issuances have been less than the total domestic bid. So if the domestic bid is so much, corporate issuance is so much, this is FPI selling that has to happen. Otherwise, trades will not take place in the market. Now, the key is in the next 12 months, the domestic bid, I think, remains like this. Corporate issuances will go like this.
Okay.
And then you will get FPI buying. So that's the first thing. The second thing you must remember that FPIs evaluate everything on a relative basis. So the fact is that last September, while our economy was looking very tight and was going to slow down, China was stimulating. And China actually announced its first round of fiscal stimulus exactly on 25th September, the day India peaked on a relative basis to China. And since then, China has been stimulating its economy and its growth cycle turned in a relative context, whereas India's growth cycle went down. FPIs make relative bets, and that matters in the context of this discussion. The second thing is that the last 6 months in particular have all been about AI. Okay. So everybody is searching for the next AI trade. Now there is an AI trade in Korea, Taiwan, China, US obviously. I haven't found one in India as yet.
Okay.
So that I think is also bugging foreign investors. At some point in time, the AI trade will fade and it will become less relevant. India's growth has turned. And the third thing is the relative valuation. So India was trading quite expensive versus EM last year in September. Today, it is trading well below 1 standard deviation. So the valuations have turned. So I think a lot of the factors that impeded foreign investors from buying stocks in India are now turning the other way. So I won't be surprised if you'll see a bigger bid from them. But to accommodate that bid, either domestics have to sell, which I don't think will happen, or corporate issuances will rise, which I think will happen.
So we'll become more expensive.
On a relative basis, I think there's a lot of room. See, China was at 9 times earnings in September last year. India was at 20. Today, China is at 16. India is still at 20.
20. Okay.
So the gap has narrowed. Now, I would argue that China needs to trade at a bigger discount because India has terminal growth. China doesn't.
Wonderful. I think we should take some questions. Please ask a pointed question. Identify yourself.
Mohan Pangsale, former banker. Last 3 days have been so positive about our financial sector. But I am very keen to know that when exactly the credit to GDP ratio will be able to cross 100%. Because there is one thing which pulls us back. We are still in 60s. Please.
No, it will take time. It's not going to happen overnight, but the ship did leave the shores a few years ago. You see, I always say this, and I've said this many times in public. My father never borrowed money. I have not borrowed money. We as a society don't believe in borrowing, but the 20, 30 somethings in my office are all living off borrowed money. And as their share in the population rises, our credit to GDP will also rise. I know you're very enthusiastic about it, but remember this will all end very badly in 40, 50 years. But yeah, it will go to 100, I think, in the next 10 years or so. It will take time. It's not going to happen overnight.
Any other question? Yeah, please identify yourself.
So thank you so much, Rhythm. I think it's wonderful to listen to you always and record and show it to a lot of people who have pessimism and negativity, but are so much enthusiastic. So just one question in terms of the euphoria around gold and silver, which has really risen that sector. So where do you see now that going and what's happening there? Thank you.
It's beyond my expertise to give you a view on gold and silver, so I'll skip that. But you made an initial comment about optimism, so a warning to everybody here, if you're not optimistic, don't come to the equity markets. because equity markets all are about being optimistic about the future. So if you're pessimistic, then go to fixed income. It gives you guaranteed returns, and your capital remains safe. Equities are very different asset class.
One question from that side, I think.
I'll also add one more thing, is that I don't treat gold and silver as assets. To me, fundamentally, an asset is something that yields an income. So equities give you dividend, bonds give you coupons, fixed deposit give you, regular interest, property gives you rent. Gold and silver yield nothing, so they're not assets. They are stores of value, like Bitcoin. So they should not be compared with assets which yield income. So they are a completely different ball game.
I think that's that's the right, absolutely. Yeah.
Yeah. This is Navneet. I'm an investor.
Yeah.
An excellent presentation, Rhythm. Just one question. You talked of AI and disruption. In the next 5 to 7 years, which sectors do you think face the least disruption risk? From an investor point of view.
Very, very good question.
See, I think the jury is still out on what AI will do. I don't think LLMs are where the disruption lies. So everybody's focused on large language models as the source of disruption. I think the source of disruption is embodied AI. And again, as I said, I'll caveat this by saying it's still early days, so things will evolve in the next 12 to 24 months. But what I'm seeing in embodied AI, I think does present a threat to India, for example. And where does the threat come from? It doesn't come to the manufacturing sector. Robots are not going to start stitching shoes and clothes anytime soon. And they are not going to be assembling iPhones. These are jobs which are intricately require human skills. But they could replace the domestic helps in our homes. And this is a big threat because the domestic help industry in India is a thriving industry which produces a lot of income for a certain class of society. And I have seen robots that China is making which are currently priced at 18 to 20 lakh rupees, which can do everything that your domestic help does. And these robots, you can abuse them and they will not react. They don't need a vacation. And most importantly, they will not ask for a loan. So I think that is a bigger threat. Now, the only reason I'm not panicking over this is because I still don't see the scale. I reckon there are maybe 20 million domestic helps in India. And China is still not ready to supply 20 million robots to India. So it may take 10 years for us to get there. But that is where the threat is. I don't think it's happening in manufacturing. It is certainly not happening in IT services. Okay, because India will build all the front-end customer-oriented applications when AI gets monetized. So there I feel India is going to experience another wave of export boom in services when that happens. I can tell you that a lot of AI work that global multinationals are doing right now is happening here in this country. So we are not at all behind as the common narrative is. Yes, we don't have the chip manufacturing, we're not doing the LLMs, but these are the early trades in AI. Later on, when the real stuff starts happening, India will be right there.
Thank you. I think time is up. Unfortunately, we would have gone on and on. But I think what my takeaway, Rhythm, from your excellent presentation was that you actually have given an explanation for your bullish sentiment by pointing our eyes to a structural shift in India's economic balance sheet, which I think is something that we should not lose sight of. And as long as that structural shift remains where it is and it gets stronger and stronger, I think you will remain bullish, India will remain bullish.
I'll make a closing remark. Equity returns come from balance sheets, not from income statements. Corporate balance sheets, government balance sheets, household balance sheets. You look at all of these three in India, they're very pristine, probably the best in the world.
On that optimistic note, Bhaswar.
I now request Mr. Bhattacharya to present the memento. So a clear message to the MNCs of the world: if you are not in India, good luck to you. However, also underscoring perhaps a sector which requires more urgent focus, that the farm sector of the country needs to be unlocked. We now move on to a fireside conversation with Mr. Mark Matthews, Managing Director and Head of Research for Asia at Julius Baer. I request the audience to stay seated for what will surely be a riveting conversation. May I invite Mr. Matthews to join us on stage? And may I also request Mr. Puneet Wadhwa, Senior Associate Editor at Business Standard and the moderator for this session, to join us as well. Please give them a big round of applause. Over to you, Mr. Wadhwa.
Thank you, Mark, for joining us today. Mark is the Managing Director and Head of Research for Asia at Julius Baer, based out of Singapore, and has very graciously consented to fly down from Singapore to Mumbai at a very short notice. So let me begin the conversation, Mark, by asking you, how do you assess 2025 year, as for the global financial markets? This is excluding India. How do you describe how the year has played out till now?
In one word, surprising, because truth be told, if you had asked me how the global markets would be this year in January, I would have said that there was an over 50% chance they would be down. And here we are with the bellwether equity index, the S&P 500, up 17%, which of course is much better than the long-term average. Sorry, and hope you can hear me better. So it has been a surprising year. Now, if I could rewind the clock, why did I think it would be a challenging year? Well, the most simple explanation is that the S&P was up 25% in 2024, and it was up 25% in 2023, so I just thought it deserved a break. And so here we are up 17%, and I know that sounds great, but what's even more incredible is the emerging markets as a whole are up twice that much. They're up over 30%. So Puneet, to answer your question, it's been a really surprising year, and that makes me somewhat uncomfortable forecasting next year, because I was thinking this was going to be a down year.
Okay. So, as you rightly pointed out about the US markets, Mark, they have made consistent highs all through 2025, whereas the Indian markets have done it just once, the Nifty at the benchmark level. So would you say that the Indian markets have somewhat decoupled from the mothership, which is the US?
No, because what is did you say how much the Nifty's up? It's up about, I think, 6 or 7% in dollars. I mean, I wouldn't be displeased with that. I think if you annualize it, it's sort of about, I guess, 11 or 12%. To me, that's a perfectly good return. So it's not like India's gone down, but clearly it's underperformed the US, it's underperformed its peers in emerging markets. And I think there are two primary explanations for that. The first is China, and every Indian fund manager's worst fear a year ago was that China would become investable again, and it has. And so I think that largely explains the selling by foreigners of India this year. I don't think it's because they dislike India, it's just that they see more upside in China. And then the second thing is that the earnings have clearly disappointed, and I think we're getting close to an inflection point with the earnings, not in this current quarter, because the GST cuts only really kicked in the last week of September. But going forward, the combination of those, the monetary easing, the income tax cuts, and a decent base, I think means that fiscal year 27 will get us back into double-digit earnings growth again, and then make India interesting for foreign fund managers once again.
So for 2025, what's your assessment of the Indian markets? Would you say that they were boring as markets such as China, Brazil, offered better risk reward, or were they disappointing because of tepid returns, or they were challenging given the lack of investment opportunities here?
So, I'm not really that old, but I've reached a certain age where I don't try to pretend that I know things that I don't. So I haven't really been following India that closely this year because we all only have so many waking hours a day, and like most other people, I've had to do a lot of catching up on China. All of a sudden, China's back on the map. And many of us, I must confess myself included, we haven't been regularly looking at China. We kind of wrote it off. And now it's come back. We've got a lot of homework to do. What's going on in China? Because they're making huge strides that none of us saw coming across the board in many high technology sectors. And so to answer your question, I mean, the honest answer is I haven't really been looking at India that intensively this year because I've had to do a lot of work catching up on China. But if you wanted a descriptive, yeah, I'd say it's been a rather boring market this year.
So in other words, you're saying that nothing much happened in the Indian markets to make you, wake up and take notice?
No, in fact, this has been, in my small career, something I've noticed that India actually tends to progress and take 2 steps forward when it's had a setback. Most obviously, back in 1991, but subsequently, every time something bad has happened, India tends to respond, in my mind, very positively. So I think that the tariffs will end up being a positive for India because they have resulted in significant monetary easing and significant fiscal stimulus. And so those are important things. I don't know how many rate cuts have there been this year, 5, something like that. And these big cuts in consumption and GST taxes, those are very meaningful. But if I have to put it in relative terms to what's going on in China, then I must confess it's just not as exciting.
So how would you compare a market like US and China? So is the US market nearing a bubble? Because we have seen multiple highs this year, and especially the Mag 7 stocks, the IT stocks. How do you compare US and China on this IT thing? Spending by companies on AI and the valuations that some of the stocks that they're trading?
Yeah. So, you could define a bubble in valuation terms or in technical terms. And I know it sounds hard to believe, but in neither of those could you qualify the US stock market today as a bubble on its own. Just look at the chart of the NASDAQ 100, which is the sort of technology sector there in the US. And where we are, we have not really substantially deviated above the long-term trend. The way the dot-coms did in 1998 and 1999, the dot-com bubble was something like 3 standard deviations above the long-term average price trend for the NASDAQ 100. And today we're less than 1 standard deviation above the long-term price trend for the NASDAQ 100. So that's the technicals. Now, of course, there are standouts like NVIDIA, which is up something like 15 times in the last 5 years. So clearly there are some stocks that look different from the NASDAQ 100. But then on the valuations, the Mag 7, their forward price earnings ratio is around, I'm going to give you numbers that aren't precise, but I'm going to say the 12-month forward PE for the Mag 7 is somewhere around 33 times, and the forward 24-month PE is about 23 times. So you compare that to the big 5 technology stocks back in 1990s and up until March of 2000. So that would have been Microsoft, Cisco, Oracle, Nortel, last one I can't remember. But anyway, doesn't matter. Those were on about 50 times PE. So we're not in a bubble. I know it sounds hard to believe, but if you just look at those two basic things, the chart and the price earnings ratio, I don't really think you can. We're getting toward one, but we're not really in one yet.
Okay, we're talking about AI, US stocks. So investment in AI by US tech, tech majors is quite huge, and India is still at a very nascent stage. So is that a worry point for you? Let's keep the trade deals, the tariffs, etc. aside, and the stock valuations. Is investment in AI or the lack of it by Indian IT companies a worry point for you?
No, to the contrary. The danger in the AI story is the amount of money that the hyperscalers are investing, which this year is, I just saw the numbers this morning, $375 billion that the big 5 hyperscalers will be investing in AI. And over the next 3 years, $1.1 trillion. So if you add those two numbers up, it's more than the German stock market in investing in AI that 5 companies alone are doing over the next 3 years. And the danger is that they don't get the returns. The AI will be very accretive for the entire economy, and many companies will benefit from it in enhanced efficiency and productivity. Their margins will go up, their returns on equity will go up. I would, but the companies that are doing all of the big investment up front, those are the ones where actually you have to worry if they're going to get the returns. For the broader economy, it's going to be great. We're going to ride on the coattails of this huge investment that these companies, hyperscalers, are making. For the hyperscalers themselves, it's very risky, but I can understand why they're doing this, because in any major technological transition, you go back and look at history, without exception, the legacy companies, if you want to call the incumbents, are very seldom do they make it to the other side. Just look at, I don't know, what can I use as an example? When we moved from trains to cars, how many of the companies that made the coaches and carriages and, in the railroads were able to transition into making cars? And the answer is none. Look at when we move from cellular phones to smartphones. Who uses a Nokia or Ericsson anymore? So I understand why these big technology companies are spending money like drunken sailors, because they can see, the history shows, the incumbents never make it to the other side. So they're going hook, line, and sinker to make sure they've got a place at the table in what Sundar Pichai calls, as I'm sure you know, AI, he says, will be bigger than electricity.
So where does India fit in the entire world order in terms of pecking order for you within the emerging markets and a broader global context?
Yeah.
Would you say, is it a safe haven buy, or have we lost out to US and China?
No, you certainly haven't lost out. As I said, I think a lot of the benefits of AI will come to economies and companies just organically. You don't have to make the big upfront investment yourself. You can benefit from it, just like so many of us have benefited from the internet without having to make huge capex into it. And so for me, India is very special because I don't want to bore you with my background too much, but basically my entire career I've only done Asian stock markets, which is 33 years. And they've been terrible. They've been really, really bad compared to the S&P. I mean, $100 invested in China 20 years ago would be about $300 today. $100 invested in the S&P, compounding, the dividend would be close to $3,000. And sorry, I want to just say $2,700, so not $3,000. But anyway, $100 invested in India would be about $1,800. So it's been not as good as the US. That's because the US is very special in that it has technology as its biggest sector, and technology has an ROE of 30%. That's something no other country in the world has. But India has been, relative to the other Asian markets, relative to other emerging markets, really a standout. I mean, $100, 2005, $1,800 today, that is an extremely good return.
So $100 invested now, a year from now, would be how much? Yeah. What kind of returns are we looking at?
Well,
if you can segregate across, let's say, large cap, mid cap, and small cap, because mid and small caps is where the money is made. Do you expect these two segments to outperform or underperform the large cap peers over the next 1 year?
12 months, I can't make that forecast. But
2 years?
Long term, I do believe that small and mid cap will outperform simply because they're smaller, so they'll grow more. But I would guess that India can return around 15% over the next 12 months, because my guess is that fiscal year 27 earnings growth will be about 16 to 18% for the Nifty. And so ballpark, I would expect the return to be about that much, because you know, the market, it is up this year, but it's not up that much. So it's not actually that expensive relative to its peers. So when you do see that inflection point, earnings growth starting to pick up again, then I think there is definitely room for a re-rating. And I'm already seeing, by the way, in the current quarter results, the number of misses is about half what it was in the previous 2 quarters. So I think about 20% of the companies that have reported so far have missed, compared to about 40% for the previous 2 quarters.
So your 15% return expectation largely would also mirror the kind of earnings growth we are likely to see in the 1 year, because earnings growth, I mean, markets typically mirror the growth in earnings.
Correct. Ultimately, I mean, there's a whole bunch of things that make share prices move, but to my mind, the number one thing that makes a share price move is the earnings of the company. And yeah, so if you get 15% earnings growth, as long as the market is not outrageously overvalued, which I don't think it is, then I think you could get 15% return. And maybe if you get some increase in the valuation that's assigned to India, it could be a bit more than that. But I wouldn't want to hazard that. So yeah, I think 15 is a reasonable
number to play with. Okay. So what is the next 3-year, 5-year driver for India? The earlier answers ranged from manufacturing to digitization to India's strength in services. Do you think it is hard to find a narrative now that can drive Indian economy and therefore markets higher from a 3 to 5 year perspective?
To be honest, Puneet, I hadn't really contemplated that. I will tell you simplistically, there's 2 things that I've found India has that are unique. And the one is something everybody knows, which is the very superior demographic profile. So now I got to get these numbers right, but no, I better not say any numbers. But for sure, there are more people in India who will enter the prime money-making cohort of 30 to 60 years old over the next 5, 10, 15 years than any other country by a huge margin. So it's just the fact that the working age population is larger than the dependent age population, and that happened in 2018 for India. If you look back in history at other countries, when you had that sort of golden demographic threshold crossed, where the the working age population was larger than the dependent age population. It was always led by very good economic growth in the countries that I've studied, which are Germany, Japan, in the 50s and 70s, and then Korea and China in the 80s. And so India did do that in 2018, and the working age population should remain larger than the dependent age population at least until around the year 2060. So this is a very long golden period I think we have in front of us, demographics. And then the second thing I like about India, if you don't, I have to butcher the Hindi language, I'm sorry. I think the word is jugaad. Jugaad, yeah. So I have no jugaad, by the way. That's why I'm always at the end of the line trying to buy a train ticket or something. As you know, I barely got my visa in time. Yeah, India has jugaad, and hard to quantify that, but we can qualify it. There's just there's a can-do attitude, which I'm sorry to say is absent from many other parts of the world. India has a can-do attitude, and that's very important.
So if the stock markets are a reflection of how the country's economy is doing to some extent, where are Indian markets right now? Have they overshot reality? Are they underplaying reality?
Well, obviously there was an economic slowdown last year, and so that I think in turn explains the single-digit earnings growth. And coming back to my earlier observation, earnings are ultimately what drives share prices. So I think that this relative underperformance compared to the US, for example, where they're going to clock in probably about 13% earnings growth this year and another 13% next year, it's trading where it should be. Yeah, I think it probably is.
So one aspect that has kept traders and investors on edge over the past few months actually has been the trade deal, which still hasn't come through. What's your base case, bull case, and bear case on how the tariffs will play out for India, one, and its implications for the stock market? Can this 13% or 15% growth in corporate earnings and therefore the stock market be lower if the trade deal doesn't come through, or the deal doesn't matter?
Well, first I want to say I'm very sorry for anybody who is in the textile business or the gems business or the seafood business. I understand they've been impacted, and I don't want to belittle that difficulty. But for the entire Indian market, and certainly, for the entire Indian economy and market, I really just think this is huge red herring and frankly irrelevant. I know it impacts. There are a lot of people employed in those sectors, but I just don't see the impact on the economy. I mean, exports to the US are, 2 to 3% of India's GDP? I think it's a lot of hot air. And if I was to make a forecast about it, I think it'll improve. Seems to be most other countries there are certain countries that had to buckle to the American demands because they rely on America for their defense in Europe and South Korea and Japan. So they basically just said, okay, we'll do it. But other countries don't need to do that, and they are negotiating. And so India is one of them. And what I can say, I'll say two things. Number one, Trump makes it up as he goes along, so it's really hard to forecast this stuff. Number two, I do believe the Americans want access to the domestic market here, in particularly agriculture, particularly dairy. And as we know, that's an extremely hot potato politically. But I think they're serious about it. And so, I don't really know how to finish that sentence, but they can
Give us a number.
They can see this is a huge market, and Americans, they like making money, so they obviously want access to this market, and I guess they'll just have to. I don't know how those two will meet. I can't answer it.
So on the policy front, Mark, do you think that the government has actually exhausted its policy-related ammunition, given the fact that we saw a lot of measures in the budget presented in 2025, and now with the GST slab rejig. That's one part. So looking ahead, can 2026 budget will not have much policy-related stops unless they are for stock market investors?
You know, Puneet, like I said earlier, I've gotten to the stage where I don't want to try to answer things that I'm not really qualified to talk about. So policy in India is not my forte, but if I could find a way around that answer, which is circuitous, and I apologize, I've always felt that the attention on the union budget was vastly in excess of what it should be. I don't understand why everybody's so focused on this budget every year. I understand, obviously, policy at the margin is important for an economy, but to my mind, this is a capitalistic economy that has a very long runway. It looks great to me. So, I mean, if the best thing is just if the government could leave the private sector to do what it does best, which is make money, then I think the rest takes care of itself.
Probably lower taxes for foreign investors?
Oh yes, for sure. That's a major issue that India has is the capital gains and dividend tax for foreigners. It's I don't want to say that they don't deserve to pay any tax, but certainly most other emerging markets they don't have to pay those taxes, or at least nearly as high.
So assuming valuations become a little more attractive for foreign investors to put in money in India, would the higher tax slab for foreign investments, will it be a prohibitive thing? Assuming that the kind of returns one can expect from, let's say, a China or a US or another emerging market?
Absolutely. You know, I can't deny this is a thing. Now, I don't want to say that I think the government should not tax foreigners. It's not my position to say that, but it does make Indian stocks look relatively less attractive. Absolutely, you can't deny that.
So are there any worry points, according to you, which the markets have failed to read correctly, the Indian markets?
Worry points in the Indian market? Well, it used to be everybody was worried about oil. Doesn't seem to be a problem anymore. I think job creation is a problem everywhere in the world, including India. Young people need to be employed, and finding gainful employment is a challenge. We know that. This is not something unique to India, but I guess that would be the top of my mind, is job creation.
Okay. You talk to a lot of companies also based in India. What are their pain or worry points? Is it demand not picking up? Is it taxation? Is it lack of inadequate infrastructure? Policy framework? Is India Inc. worried about anything?
You know, actually, I have to be honest with you, I don't really talk to a lot of companies. My colleagues do, but I don't. I wish I did. I wish I had the time to, but I don't. I stopped looking at single securities around 15 years ago, so I just look more at the
Would you have
macro
any thoughts on how the commodity prices have played out? Gold and silver, and crude oil, for instance.
Yeah, I mean, clearly they've moved in opposite directions. There is more than enough oil in the world, and more than enough most other commodities too. There's lots and lots of it, tons of it. So I believe that commodities are basically in a very long-term bear market, which is great for the consumer, great for industry. Now, of course, the precious metals are completely different because they're not industrial commodities or soft commodities, and I'm a believer in them. I mean, gold, if you just go back 100 years, I apologize to the people in the audience who've heard this probably 10 times already, but there's this famous, I don't know what you call it, the price of a fine toga in ancient Rome was the same in ounces of gold as the price of a good suit today. So gold serves its purpose as a hedge against inflation, and if you just look at it over the last 100 years, it's returned about 5% per year in dollars. So it has a good place in anyone's portfolio. Now, we've just seen this huge increase in the gold price, and that is actually not really that unusual. I mean, the long-term average return is 5% per year, but it does have these spurts. So you know, why has it just taken off? I think the war in Ukraine is the main thing, and not the actual war itself, which is horrible, obviously, but the confiscation of Russian assets was a terrible decision on the part of the Western countries. Now they're thinking about actually taking that money and giving it in loans to the Ukrainians, and that has deeply hurt the what you would call the reputation, I guess, of Western financial markets. You know, many people just don't want to get their assets frozen, obviously. And I mentioned earlier about young people being challenged to find meaningful work in India, and this is a phenomenon all around the world. And the more you get this disparity in income, you know, between the rich and the poor, and that is largely a demographic disparity too. I think the greater the temptation will be to impose wealth taxes, and the British are talking about a new property tax, which is a form of wealth tax. The French are talking about a wealth tax. In California, they're talking about a tax on billionaires, and all of these wealth taxes, it's been well proven, they just drive money away from those the jurisdictions where they're imposed. And one thing about gold is if you keep physical gold in a vault in Switzerland or Singapore or wherever it may be, then it's hard for somebody to take it from you. So I think, you know,
so in terms of price points, are we headed higher?
Okay, so we are, yeah. I mean, I think the maximum pullback in gold is probably $3,500 per ounce, which is probably around I don't know, 7% below where we are now, and then I think it'll be up around 4,500 within a year.
Some optimistic scenarios expect the gold prices to hit $6,600.
Over time, yes. Yeah.
You think it's a possibility?
Yeah, I do. Actually, I shouldn't say this, but I will anyway. Here, I'm going to take off my gold ring. So scientists have actually found there's something very special about this metal for us that no other metal has. When it touches your skin, it produces endorphins. It actually makes you feel good. No other metal has that quality. So there's something about gold that really goes back, I think, to prehistory. Our relationship with gold is special.
One last question. For somebody who wants to invest in India now, wake up, it's time, it's the right time now, or you can, or should they look the other way? To US, China, other emerging markets?
I'm not good at sort of trading, so I don't know. I've never been able to sort of tell people when is the exact right time. But I mean, I think India's priced right. I think the earnings growth is going to be good next year. It's fine. I think it's, I like to say it's really the only emerging market that a global portfolio needs. To my mind, you don't need Brazil, you don't need Indonesia, you don't need Turkey, but you do need India because it actually has proven, as I said at the beginning, to produce very good returns, which most emerging markets don't. And I don't see why that shouldn't continue to be the case.
Thank you, Mark. Now let's open up for a few questions. If anyone has, please raise your hand and keep it short and crisp.
Very good morning, sir. This is Vamsi, a co-founder of StatBiz Technologies. From the recent Global Wealth Summit, we got to know that there's a takeaway from the World Bank saying that asset building lending products are very much required to the world. So please give your sense of that.
I'm sorry, I didn't catch it. Can you please be a little more specific? And
yeah. So
what's the question?
There's a takeaway from the World Bank saying that asset building lending products are the future of the world. So
asset building lending products? Yes. I don't know what they are, I'm sorry. I'm sure they are something important, but I don't know what those are. Sorry.
Okay, thank you.
Yes, please. Can somebody please give the gentleman the mic, please?
Hi, I'm Bhavik Khandar. Thank you for the presentation. Mark, I just wanted to ask you, since you are bullish on India, amongst the other emerging economies, which are the top 3 sectors that you would bet in India for the next 3 to 5 years? And why?
Well, I mean, I've never been that much of a sector person. I've always felt the companies are first and foremost, because you could have a good sector and a lousy company and vice versa. So nevertheless, you know, an honest question deserves an honest answer. And I can't give you 3, but I would just say banks, to me, are still a very good proxy for this economy. Banks are the heart of any economy in the world. And so if an economy is doing well, banks should naturally follow. I like the banks. I think there is organic transfer of assets into the private banks. So I like them. I think the consumer seems to me a very obvious thing to invest in here. The question is pricing and the quality of the companies. But anyway, banks and consumer, those would be my 2 ones. And there's a whole bunch of interesting emerging sectors here that, to me, look really interesting. And I'll just pick one out of a hat, but hospitality seems to me to be a very promising sector here. So there's a lot. I mean, one good thing about this market is it's very deep and broad. There are lots of interesting sectors to choose from.
Just one last question, please. Yeah.
Hi, Mark. This is Balram. Nice, listening to you. I just want to have an, since you are very bullish, or rather you are very gung-ho about China, with reference to AI, we are hearing a lot about AI in USA and America, but we don't hear much anything in China. Since you have been observing it and closing seat from very close angle, can you update us what is happening on the AI front in China?
Oh, tremendous amount. There's a lot going on in AI in China. Maybe we don't read about it as much because the whole world seems to be so preoccupied with the Magnificent Seven. But it's a totally different architecture in China. And the difference is, in a nutshell, the Americans have extremely powerful chips, but they don't have enough energy, electricity to make them work. The Chinese have less good chips, but they have tons of electricity. So it's a different system, but the end result, I think, is the same. At the margin, I would say in China, you're going to get an even faster adoption rate of AI because their economy is already so much more digitalized and I guess, for lack of a better word, monitored. I mean, everybody's information is collected all the time in China, and if you go there, you just see cameras everywhere. So there's so much more data that they can use that I think, AI is a big thing in China. And the last thing I'll just say is that the Chinese have no problem with this. I mean, a lot of Americans or Westerners, they don't like the idea of their lives being digitalized. They think it's an intrusion on their privacy. So rolling out something like the Aadhaar card in America or the United Kingdom is not easy. Well, in China, they have no problem with it. They don't have any choice. So anyway, AI is a really big thing in China, and we just don't read about it as much because everybody seems to be obsessed about NVIDIA.
Thank you, Mark. That's the time we have for this session. We can continue this later. We can continue this later, please. Thank you, Mark, for a very interesting session.
I think that deserves another round of applause too. And I request Mr. Wadhwa to present the memento. So a ringing endorsement by Mr. Matthews. India is the only emerging market a global portfolio requires. And also a reassuring assessment that the tariffs won't affect the economy much. Ladies and gentlemen, that brings us to the close of the first half of the day. And it's now time for lunch. We have 5 more sessions ahead of us, 4 in this hall and 1 in the hall below. So please join us back at 2:15 p.m. for a fireside chat with Shankar Sharma.
पता है जब मैंने ऑफिस का कंफर्ट
Shankar Sharma, founder of Gquants, on how to invest in financial markets in an AI-driven world. The session will commence shortly. May I invite Mr. Sharma to join us on stage. Mr. Sharma, please join us on stage. And may I also request Mr. A.K. Bhattacharya, Business Standards Editorial Director and the moderator for this session, to join us as well. Can we have a round of applause? Over to you, Mr. Bhattacharya.
Thank you, Bhaswar. Very good afternoon. Session after lunch is always the most challenging session because we have to keep them awake. And I can very well...
I think that's why you kept me after lunch.
Absolutely, because I felt that the one person who can keep people awake is you, that's Shankar Sharma. And the subject is also quite interesting. The subject is that how to invest in financial markets in an AI-driven world. So, but before I get into that subject, let me first get the basics right. In a sense that, can you tell us your investment philosophy? You know, what drives that? How do you go about investing? I mean, you made this fantastic statement just a few minutes ago about the difference between China and India on the financial sector. What's your investment philosophy? How do you go about it? To what extent is data-driven? To what extent is it research-driven? To what extent it is AI-driven, or will it become AI-driven?
Yeah.
So give us an overall worldview of your investment philosophy.
Yeah, that's a very good question, AKB. And actually, my needle of investing has moved from being very traditional, because there was nothing else we could do back in the 90s
Absolutely.
or even the 2000s, to becoming actually almost 80–90% data and AI driven. That has been my transformation as an investor. That is primarily thanks to a person I got to know who's an IIT Comp Science person. He taught me a new perspective of how to look at the world from the lens of data, and not the old-fashioned touchy-feely method we were using.
How many years ago?
This happened in 2018, before ChatGPT started,
Okay.
actually. So I was a very early adopter of AI and quant-driven thinking. Okay, and again, to clarify, it's not that I use only AI, but where it is coming into play, I will tell you, AKB, is that it is giving me a breadth and scale of opportunity seeking, which I would not be able to do humanly, even with a team of people. What it is doing is, it is giving me filtration in a very intelligent manner. Dumb filtration you could get through Excel even 30 years ago. There was no big deal. Intelligent filtration is only available now. So in a sea of 10,000 companies, for example, how on earth do you find 5 or 10 or 15, 20 good companies? AI is giving me that today. Now, after that, the human part of me kicks in to further refine it down to the best 5 or the best 8 or the best 10. But getting to that, it was a needle in a haystack.
Okay.
Now the haystack has become much easier for me to understand. That's how I'm using AI.
But you need a Shankar Sharma, nevertheless.
I think it helps me to be me.
Yeah.
But AI is helping me become more data-driven as a human being. It is transforming me from inside. When less of my humanness is coming out and more of my purely analytical self is coming out. It's changing me too.
Oh.
Yes.
So I mean, so what's your philosophy then?
What's my philosophy?
Yeah, investment philosophy.
Well, my investment philosophy is simply that instead of taking a small number of large bets as I would when I was a human being, because of AI, I can take a large number of small bets and a small number of large bets simultaneously.
Wow. What a great option that you have now.
Exactly. I have created optionality. So let me give you this perspective about what do you mean by luck in life?
Okay.
And I've thought a lot about that. And I relate it to investing. Luck is nothing but the amount of returns you make on an opportunity multiplied by the number of opportunities divided by the variance which is risk. That is the definition of luck.
That's right.
Now, how do you increase luck? First of all, the amount of profit you make per transaction is in a way limited, is finite. You can't make unlimited. Variance, by and large, you know after a certain time you will have 10% variance, 20%, whatever it is. The only factor that you can control is the number of opportunities.
Absolutely.
Once you introduce that into your framework, suddenly your luck in life and of course in investing will multiply manifold. So what I said was, earlier it was a small number of large bet strategy because I'm a human being, I've got a bandwidth limitation. My analyst team cannot be 500 people, there'll be 30, 20,
That's
50
right.
people. They will have their own problems, so I have to further filter from them. Now I can do a large number of small bets, and then from that large number of small bets, I can filter out where I go to a small number of large bets.
Wonderful. How many of, in your industry, in your area, how many are actually following this principle?
We had a little conversation over lunch, which was, I think, one of the most entertaining lunches I've had, which was now.
Yes.
And one of the questions asked in the discussion was, will AI take over from humans and will it replace humans in the whole sphere of investing or financial services? And my answer was, I don't think that's going to happen.
Okay.
I don't think it's going to not happen because it should not happen. I think it will not happen because we human beings will prevent AI from becoming that important because it will take away our own jobs. So think of a mutual fund CIO.
Yeah.
If he introduces so much AI into his firm, tomorrow his job is in danger.
That's right.
You see, we all have vested interests. Because of that, AI will have a natural check and balance embedded in it. It will have a role, but to expect that everything will go away from human beings and go to AI, I don't think that's going to happen at all.
Okay. You know, this is about perception. You are seen by most people as a market expert who has contrarian views. And people will always turn to you to see is there another view on the same issue or not. Now, will the advent of AI, will that change this perception that you have of yourself? Or do you think it will further accentuate it? Or there will be many more people like you who will be able to have contrarian views with the help of AI?
AKB, I don't think AI will change intrinsically what you are.
Yeah.
At least I hope not. But here is where the danger lies, and which I am very mindful of.
Yeah.
And I definitely try and limit the use of AI in my day-to-day life. And I really mean that when I say that, because whenever you're confronted with something now, these days, you say, ki, let's ask AI. Back in the day, it was, ki, yaar, thoda aur sochte hain iske upar mein.
Okay.
Okay? Yeah, let's really research it, first principles, go to a library, or even go to the internet, figure out vast amount of opinion on it and then form my opinion. Now there is a fast food equivalent that ki yaar, why are you wasting time? Just like AI se pooch lo na, it'll give you the answer.
Correct.
Now the thing is, I have realized after using all these AI tools extensively in the last year or 2 years for getting perspectives or getting data, I find it will learn how you want the answer to be. So it starts to give you answers on a topic which actually it senses you want that answer.
So it actually presages you.
It presages you. It reads your mind on that topic and then starts to feed you answers which support your thesis, which is exactly what you don't want when you are trying to think differently.
And be a contrarian.
And be a contrarian.
So how does that work then?
I don't use it. I realize this is what it is doing. And then I stopped doing it because I realized ki yaar, this is going to make me a conformist rather than a contrarian, because it keeps agreeing with whatever I am saying.
Yes.
And I'm sure anybody in this room who has been using it can realize you can actually tilt its opinion to suit your opinion.
I think that's a takeaway which is $1 million worth in value, because it is trying to predict you what kind of response you want, and then it offers it.
Exactly right. So if I want the contrarian in me to be alive, the AI is definitely not my go-to place to keep it alive. In fact, it will do the opposite.
Absolutely.
In fact, it will tell me that, hey, you're right. While my being contrarian, by the way, AKB, is not an easy spot to occupy. It's actually the most difficult spot to occupy.
Yeah.
Now, when you're lonely in that opinion, whatever that opinion might be, the last thing you want is that to suddenly be told from AI ki yaar, you're damn right. Because then though it is going to actually make you question less your own opinion.
Yeah.
Because being a contrarian means you're questioning your own self very, very aggressively because you're against the tide. But when you find a nice, friendly guy who's supposedly great wisdom, then you say, boss, I am in a good place. That is a dangerous way to think.
So would it be correct to conclude that at least as far as the financial sector is concerned, the use of AI and the talk about AI being used as an instrument for making variety of things is slightly, we have gone overboard. We have sort of not been able to get the right mix of AI and your own intelligence to help you navigate this very difficult, complex world. I mean, will it be correct to say that we have not been able to understand the role of AI in the financial sector the way we need to be? And if it is so, what is it that, how you think as an expert, financial sector should use AI?
So to my mind, AI is too new for us to form conclusions on whether it will reshape financial services in a very big way. I mean, computers came and they reshaped it. AI will also reshape it. How much, we have no idea. Nobody can tell. What I do know is that AI itself is reshaping itself. It's still, even AI doesn't know where it is going to go 5 years from now. You know, there are many flaws in it. It gives you wrong information. It hallucinates. It fabricates. All of those things are confidence destroyers. Why we were looking at AI? Because it is better than a human to give me correct data. But I find it gives me rubbish most of the time. So now the process I follow is I check the same information on 4 different platforms. Now that means that I have 4 employees now to deal with. I wanted to cut all employees and I have only 1. You see, so it is not a, the holy grail that all employers or entrepreneurs are looking for. I think it is very imperfect right now. In fact, vastly imperfect. In some cases, dangerously imperfect. And I think we should reserve our opinion on being too forecasting in this, that it will take away, human beings' roles and in financial services. Because in financial services, you're dealing with money.
Yeah.
And mistakes there as human beings, you can say, sir, sorry.
Destroy people's trust.
Destroying trust, exactly right. And if trust is destroyed or dented because of your human error, it is explainable. You can go to your client and say, sorry, sir. Sorry, sir, galti ho gayi, sir. Main insaan hu. What are you going to say? That I trusted a bloody software and that thing has now, upset your portfolio or it did some crazy recommendations. That is indefensible.
So do you get the sense that since AI is evolving, and we all know it's evolving, at some point AI will reach a level where it is may not be perfect, but near perfect, and it can be used more extensively by the financial sector?
It will be, I mean, we know that, writing prospectuses, analyzing, or even doing that is being done in Wall Street.
Yeah.
We have read about that. All it will take will be a few blow-ups there, regulatorily. Like we found in Australia, a report was made by one of these big four, and that turned out to be they had quoted, non-existent research.
Yes.
There will be blow-ups in IPO prospectuses also, which rely only on AI.
Yeah.
And at least an employee, you can dress him down and you can fire him. What are you going to do with AI? How will you explain to a regulator there was a mistake made? I think we are getting excited. We should be, but getting hyper excited with this thing. And I'm a real user. I own an AI firm also. I know how much complexity goes in checking information that AI throws up. I can tell you, please do not trust it blindly. And once the trust is not there, human beings are required to fill the trust gap.
And since it is a matter of money,
precisely,
a disclaimer is not good enough.
It's not good enough. I gave money to a human being. I didn't give it to a robot. You see? So I think the rumors of our death are vastly exaggerated. I don't think human beings are going away.
Wonderful. That's very reassuring to hear. Now, coming to the broader, issues about investment and the financial sector, we are indeed in a world of flux. Uncertainties all around us. If you look at the US, you wrote a fantastic piece on trying to understand what Trump is doing, and I wrote it in Business Standard.
Yes, I did.
I often refer that piece to understand the same issues, same problems in a different way. What would be your considered view or advice to people who want to enter this uncertain world as investors? What would be maybe 3 things that they need to be conscious of, wary of? One, of course, is not to be over-dependent on AI. That's one. But are there any 3 other advices you would like to give to the investors who would like to come in this world which is complex, uncertain? You do not know which direction it is moving really.
So the one fact that is certain is that clearly your view of the complexity and the uncertainty, or even my view, is not supported by the market themselves.
That's right.
If you look at the data, global economic growth, as we were discussing over lunch, and global market returns this year have been off the charts. It's been one of the best years of my life as an investor, because I invest globally, and I have been spoiled for choice this year, which is supposedly the most tumultuous year on a policy basis. So clearly there is something markets are reading, and I think markets are reading it right. I don't think tariffs are necessarily bad for the global economy. I think what it is going to do is reset America to a more responsible fiscal policy, and that is good for the world. There is a short-term adjustment for sure, but I think a good, solid, robust, financially robust America is a good consumer. Let's say you are a bank lender. You want your borrower to be in good financial health.
Good financial, yeah.
Isn't it? I mean, if he's over-leveraged and got 5 credit cards, all of them are running debit balances, you don't want that kind of customer. So you want a good customer, and a good customer is America. It's a good platform. It's the largest platform in the world, as I wrote in my article. You don't want that platform to go bust. But on the path they have been on, it is a matter of a few years before they just cannot afford the profligacy. What they are doing is a great reset. They are going to become more responsible. In that process, the margin compression will be, and as we were discussing over lunch, right now 50% has been borne by the producers, 50% by consumers. This pattern might change in the future, but I think a fiscally responsible America is good in the long run for equity markets. in the short run, there are other markets and economies that are giving you a good living. So South Korea is doing fantastically well. China is doing well. Latin America has been off the charts. So US is no longer, in fact, I was talking to a hedge fund manager, 3-4 weeks back, and she was saying that, what do you think of the markets? I said, for the first time in 10 years, I have options. And as an investor, I like to have options. What do you mean by that? Earlier, it was the only game in town was America. If you missed the American bull market, you were pretty much dead. Today, that's not the case. I like it because I don't like all eggs in one basket. And that too, in that one basket, 7 stocks. It's a dangerous way to run money. So today, I'm very happy that America is slowing down a bit because of these policies. The rest of the world is restructuring, reshaping. It is opening up more opportunities for me as an investor. So I do not see that as a negative at all. If anything, it is better from a portfolio management standpoint to have 15, 20 good markets rather than have just one.
Okay. Any other learnings from this world of uncertainty?
I think the biggest uncertainty for an investor today should be the fact that if you are exposed only to a single market, and that market for whatever reason might have a very uncertain situation, I think you have a genuine problem. So for example, tariffs on India came out of nowhere. We were supposed to be America's friend. Suddenly it doesn't look like it. China was supposed to be a rival. Suddenly they look very friendly to America. The lesson here is that do not bet on continuing geopolitics friendship. Therefore, diversify your investments beyond just the comfort zone of, let's say, for example, India. Or let's say if you're an American investor, just out of focusing only on America. There is a wider world out there, but the challenge is, therefore, you need to build skills to be able to invest across the world so that your money at least is protected. Fortunately, tools today are available, including AI, to help you do that. So there is a challenge, but there are also things to help you overcome the challenge.
Absolutely. It's like when the tariff challenge comes, India starts thinking of domestic policy reforms also.
Again, an article I wrote in Business Standard, which was that when our food security was threatened in the 60s because of the PL 480,
we went
we did the Green Revolution. Then when the nuclear sanctions happened after Pokhran, we became very proficient in using plutonium. All of those things came out of crisis, particularly American-generated crisis.
That's right.
So in a way, this is good. The tariffs will force us to look for new markets, look for better products rather than the same textiles and the jewelry that we are exporting to America.
That's right. One critical element which is connected with the fate or the trajectory of the Indian markets is how the oil sector is behaving. The Indian economy is still predominantly dependent on oil imports. What's your worldview on how the oil will impact the Indian financial sector, the Indian stocks, Indian markets, and how should one look at it going forward?
Well, for one, the news item about Andaman, it's not a find, I believe.
Andaman, the exploration is going on.
It's an exploration, and we'll see. If it does turn out to be good, I think that has the chance to reshape our oil and natural gas situation. A decade down the road, but nevertheless, that can be a game changer. But in the interim, I don't think it's in anybody's interest, including the producers of oil, to have high oil prices. I think there is a consensus in the producing world that this is a good, happy price which keeps generally the world satisfied. And I always say this, and this is an important point which I have made repeatedly, that the world loves bull markets. Okay? Nobody likes a bear market, correct?
Absolutely.
The world loves bull market. We love bull market in equities. We love bull market in gold. We love bull market in silver. We love bull market in real estate. What is the bull market that we hate?
Bull market in oil.
Bull market in oil. That is the one bull market the world hates. Only 7 or 10 countries love it. Rest of the 180 countries hate it.
But even at $60, I think they are pretty
That's
well
what I'm
taken
saying.
care of.
That the world's let's say, bears on oil, I'm talking psychological bears on oil, vastly outnumber bulls. That's the only bull market we don't like. And because we hate it, we make sure the oil prices will generally remain in this range. There's been so much geopolitical tension in the Middle East. I can't remember the last time since the Arab oil crisis, early 70s, we had so much. What has oil done? Yeah. Nothing, like literally zero. So this is a good bear market for the world. The rest, all bear markets are bad.
Okay. You know, you refer to two commodities which so far we haven't discussed. We have discussed oil, we discussed stocks, and this is gold and silver. Yes, everything is bullish. Oil is not bullish. But gold and silver, they are also very, very bullish. So, I mean, you know, how do you explain this? Is it just uncertainty, you know, or are there other lessons to be drawn from this huge, big rally that is sustaining gold and silver for the last several months? How do you explain this, and how do you see it going forward?
So, we can attribute and ascribe reasons to the gold bull market, but silver bull market, I don't think there are very good reasons. Now people start to say there are industrial uses.
Industrial uses.
But that has always been the case.
Always
no?
been
It's never that we have discovered suddenly a great new thing. EVs have been around a long time. So we find reasons to justify a price move. The fact is that gold, and I have experienced it, that my father died in 1981 and I put all his savings into gold based on a bank manager's advice.
Okay.
And that turned out to be the worst investment advice I ever got, because for the next, till 2003, the price of gold...
Yes, it was depressed.
It was depressed. For like 22 years, it was the worst bear market in gold. And it's not that the world was very peaceful and, you know, there was nothing like that. And by the way, in the middle, the dollar also collapsed.
Yes.
After the Plaza Accord, the dollar... But gold did nothing. So now we are just reacting to a current price and we are ascribing reasons why gold is going to be in a permanent bull market. It is in a good place right now, but I am not saying the reason for that are because people are de-dollarizing and moving away. I think the opposite is true. Because gold is going up, people are moving from the US dollar to gold. It's not the other way around. That's my view. And then, of course, you know, who knows, like in diamonds, you found lab diamonds. I hear stories here and there. There's some startup in America has now found a way to do gold. These things are things which are imponderables. I am bullish on generally commodities, ex-oil.
Yeah.
And I think the reasons are aplenty right now, but the reasons will change at some point in time. So I'm not a big believer in making long-term forecasts on commodities. Because understand this, AKB.
Yeah.
In a stock, you can put a value to stock, price to earnings, price to sales, although I think after Lenskart, we're not even sure what's going to happen. but let's say there is a method and a metric we can follow. In commodities, what is a fair price?
That's right.
What's a fair price of gold? Who in the world can say what's a fair price for oil? What's a fair price for silver? We do not know. It's only a price. There is no value in commodity prices. While in stocks, you can have a price and there is an intrinsic value. So I'm not a big believer in long-term forecasts on commodities.
Okay, okay. But what would you advise young investors on gold?
So the example I recently posted was that in 2005 or 6 or 7, my security guard came and asked me that, sir, you're a so-called big guy in stock market. Please give me advice on stocks. And I told him, don't even think about it. You're an Indian. For Indians, we have the 2 best asset classes in the world, or rather 3 best asset classes in the world, readily available. First, the safety of a bank fixed deposit. We generally, over the last 30, 40 years, have given a decent rate of returns. At least you have return off capital,
okay,
if not great return on capital. And then you have real estate, and then you have gold.
Okay.
And if you look at a long-term history of real estate and gold, barring, let's say, brief periods here and there, they have generally kept the boat afloat for large parts of Indian population. The poorest so poor have some gold. They have a small patch of land. And I think that advice still broadly remains that equities cannot be your only allocation if you want to be a truly safe investor. If you're very young, you want to take aggressive equity risk, by all means do it. When you are a slightly more mature investor, there is a room, and this current rally in gold and silver have taught us that equities are not the only game in town in investing. The reason why it becomes the only game in town is that we all have vested interest as financial people to push equities because we make a fee from it.
Okay.
There is no fee in recommending gold.
Is there any ratios in which one should invest between equities, debt, gold?
There are many models to be able to say that. I'm not a big believer in that.
Okay.
For the simple reason that it depends on your own appetite for risk, your appetite for security. Most people have no appetite for risk. There are people I know who even if you give them best stock, they will still say, nay, I still want to stay with fixed deposits. I'm saying broadly, equity should not be more than 30% of your investable net worth.
Okay.
Broadly speaking.
Absolutely. And within equities, there is a segmentation of small cap, mid cap, large cap. Is there any view that you hold on such investments?
I have a different way to look at it.
Please go ahead.
In 1998, after the Asian crisis, I was sitting down with my analyst team and I asked them that, okay, we had nothing much to do because markets were so bad.
Yeah.
There was no business. Everybody was leaving India. So I said, yeah, let's spend this afternoon looking at India GDP. And I asked them that, what is the current composition? At that time, I think it was 50% was services and the rest was agriculture and manufacturing. And I said, how much is the same pie chart for the Nifty? Manufacturing was something like 60 or 70%. Services were only 20%.
Okay.
Or 25, 30%. I said, this pie chart is skewed. It will change in favor of services in the stock market because the country's pie chart of GDP has to align with the pie chart of the market cap of the market. Now look back today. Services dominate our Nifty earnings and Nifty mine.
Absolutely.
Hugely. It has now mirrored what is there in the GDP itself. Correct? I am saying today, your allocation, if you look at it, in the 2 or 3 or 4 biggest markets in the world, America, China, South Korea, Japan.
Absolutely.
Which are the biggest sectors there as an aggregate? Tech.
Debt.
In India, what is the percentage of tech in market cap? Zero.
Zero.
Zero. Let's exclude the Infosys. They are not considered tech. Zero. How can this anomaly last? This will and must and has to change. India in the next 5-10 years will produce, and I don't count Zomato as a tech company. They are more consumer companies with an app. Okay, I'm talking pure core tech companies, the Palantir type or stuff like that. This pie chart is too skewed in India against global trends for similarly large markets.
So you are looking at tech.
I am looking at only tech and only tech. There will be big failures there. We know it's a high risk thing, but there will be asymmetric returns available there. So as an investor, large cap, mid cap, small cap is probably a bit outdated.
Sectors.
I think it's sectors, like the bet I took in IT services in the 90s. It looks good. It will grow. I don't know which will grow. So take a portfolio approach or buy 10, 20 companies.
So which are the sectors you will take bets on today?
Tech.
Tech?
Tech.
Tech and tech.
Tech.
There is no second, third sectors.
Nothing else. The steel story, cement story, all stories are done and dusted. I'm not saying they're not going to grow.
Sure.
But asymmetric returns, autos, I don't think so.
Okay.
Can Mahindra go up 10 times in 2 years? It's
not even EVs.
EVs are still automobiles at the end of the day. And you can use a different method, but ultimately you're transporting people from A to B. So I don't think your traditional industries are going to. And by the way, that is the reason why the Nifty itself as a returns is struggling, because we don't have tech companies there. The market's doing well by and large. If you look at this year, have had a lot of tech in them. So Taiwan has done well, South Korea has done well, Japan is doing well, of course US, China.
Right. Yeah.
Big components of tech. India will mirror that trend.
Okay, wonderful. We have got around 7 to 8 minutes left of this discussion, which I didn't realize how we sort of times flew. We'll come to the audience, but I have to ask you one question. Whenever I sort of look at you and I see people interacting with you, I'm sure this question would be asked to you that, are there any learnings that you would like to share after, years of operating in the Indian stock market, the global markets. What are those learnings that you would like to share, which this August gathering would benefit from?
So there are many learnings, but I think the key learning for me has been that, which is that formula I use implicitly or explicitly, which is your luck. You have to increase your luck factor. And the way to increase it is that your return per attempt you make at something is largely fixed, but you can increase that by multiplying that over a vast number of opportunities. That, if you follow centrally as your philosophy of life, I think you will do very, very well. And I realized that I was lucky in the 90s. That's why we built our global business from 99 when we became members of the NASDAQ.
Okay.
We got RBI wholly owned subsidiary permissions to set up UK. We became a member of the London Stock Exchange back in 99, when most Indians were not even thinking of traveling abroad, let alone setting up businesses abroad. I think that has helped me as an individual to widen my thinking, widen my knowledge, and of course increase my luck in investing in a very, very significant manner.
I'm sure you are following the same principle while you are looking at AI.
Precisely right, precisely right. And of course, the final point I'd like to make is that if you're a young investor, of course, you will have more risk appetite. If you are a slightly older investor, your risk appetite and your food appetite both must come down. And you have to focus more on health, which is an underappreciated part in corporate India, in my view. And I think we really must focus on that a lot, because I have realized that when I entered my 60s, that I wanted to enjoy the wealth I have made, and the only way I can enjoy it is by really, really becoming fit and healthy. And that advice, I think, is beyond advice on which stock to buy and what sector to buy.
I think these are words, they're worth their weight in gold. Let us go to our audience who will ask. Yes, there are so many hands. Please go ahead. Identify yourself, ask a pointed question, and Mr. Sharma will answer.
This is Dhananjay here. My question is very pointedly about Indian banking, and in the context that you have actually talked about technology impacting sectors and all. What is the prospects of the Indian banking sector in the digital transformation that is happening? Does it sort of inhibit its progression in terms of growth? And how do you see that? There is a disintermediation and diversification that is also happening. So what's the prospects for Indian banking system?
Indian banking system.
So I want to remain friends with my old friend Tamal, so I will not criticize banks much. But I think the banking story in India, in reasonable part, is fairly well baked. It's a cake which has expanded to a decent size. And just to give you a bit of perspective, HDFC Bank was an investment, I made, or we as a firm also made back in '96, primarily because of which it was run by, a very good team, which were my ex-colleagues from Citibank, but also because of one main reason, that India was a very under-leveraged consumer market back in the 90s. There was virtually no consumer leverage.
Absolutely.
Right? That, unfortunately, is no longer the case. So private sector banks have made money not by giving loans to companies. Okay, if you look at the balance sheet, look at the credit pie chart, they don't like lending to companies. That burden has been left on the public sector and the state-owned banks. These guys have made money by avoiding the riskier parts of the market, which is the corporate lending, and they focus on the less risky part, which is consumer, but that no longer is as low risk as what used to be. So therefore, the growth for Indian banks will not be what it was. And if it is a fast-growing bank, I would be very, very circumspect, because your lending will be to retail, obviously, and largely unsecured, as we have seen in the last few years. Both those things don't give me a lot of comfort from an investment standpoint. And to say that banks don't go bust, we have had enough examples over the last 25, 30 years in India of very good names in banking, starting from Centurion Bank to Global Trust Bank to Yes Bank, and several others who have gone down and gone under. IndusInd Bank, not gone down, but I mean, they have had issues which we are well aware of. I think it's a sector to be cautious on, and not the same go-go years of bullishness that used to be 10, 15, 20 years back.
Yeah, please go ahead.
Hello, myself Keval. I'm working in Morningstar. I just wanted to ask, compared to last 2 years, compared to US market, European market, China market, Indian market, when we talk about Indian market, it's much more overvalued as point of investors' view. Because all the stocks or maybe indexes are more than 10x, 20, 12x, but defense sector 30x. So is it a good time to enter into long term as a compared to China market is really going very good in terms of flow and everything?
No, so India, by the way, has always been an expensive market. So I don't buy the logic that India has not done well because it's an expensive market. Go back to the 90s, India's P ratios used to be, I think, 20, 25, 30 times. And it's pretty much trended between that. It's never been 10 or 12 times. So let's not go into the P ratio game. India's problem is something different. It has had a good preceding 4 years from 2020 to 2024. Now it is a period in which those excess returns will be followed by period of very low returns so as to even out your total returns to a nominal number of maybe about 10%. Because broadly stock market returns mirror the nominal GDP growth. And these days, our bigger problem on a macro basis is a very low nominal number. Even though the real number looks very high optically, but the nominal number is what drives corporate earnings, corporate sales, and therefore stock market performance. So India's problem is a very low nominal GDP growth number, not the valuation thing that you're mentioning.
I need to come questions from the left-hand side also. Otherwise, it will be a right-winging question, Please, go ahead.
Hello, Abhishek Sharma from GYR Capital. It's always delight to hear you, Mr. Sharma. Well, my question is, between 2015 to 20, the global production of silver was around 15 crore kilograms. Out of that, 8% gone to the consumption of silver in solar panels, which is around, I guess, 20 grams per panel. So the way the world is gung-ho after renewables, including India, what you think? Can silver be the new gold?
Well, so far it looks like that, but again, maybe we are finding data points to suit our point of view. That can always happen. And remember one more thing, that we like a gold and silver bull market only as long as it doesn't affect our lives negatively. So if solar panels go up in price and because their solar power goes down, then we'll start hating silver also. And then we'll find different uses and different sources to replace silver. The world is very smart. The world will find ways to find a replacement for that. For example, rare earths. China is really twisting the levers on the world. Now, University of Texas has come up with a technology to actually really remove this stranglehold of China from the rare earth extraction process. World will find ways to kill stranglehold. So don't bet on silver because of this solar story. If it becomes too high, because of that, we'll find other replacements.
Thank you. The time is up, but we'll take this one question. Let it be a centrist question. Please go ahead.
Hi. Shankar, it is always a pleasure to listen to you, whether you write or whether you talk. So my question is, because you are one of the person who talks what is happening all across and what happening nowadays. So what you will advise to Ola, what you will advise to even the new IPO is coming up, and what is that missing? What is that, why the fear has come to the new investor that all the IPOs are unreasonably high? Okay. What is that missing? What is that the promoters they don't understand?
What is missing in today's market?
I don't think the fault lies with the promoters of this company. I want to put that doubt to rest. The fault lies in the funding pattern of these companies. You start out with a venture from angel funding. All these companies are angel funded. Then their VC round A, B, C, D, or whatever it is. Then maybe a private equity comes in. Then they go IPO. Those rounds are at crazy valuations. When those rounds are at crazy valuations, naturally the IPO cannot be at a more realistic valuation. So it's literally you're being pulled because of that initial overvaluation. It just keeps compounding up until the point of the IPO. And I've said this before, publicly, that all IPOs in which VCs and PEs are making an exit, please be wary of those IPOs. Because they are the insiders. If they are selling, Are you telling me retail investors knows more about those companies and their value than the smartest guys in the room or so-called smartest guys in the room? It's so obviously clear that smart money is leaving and dumb money is entering. So please don't be dumb money. That's all it is. But to say that those guys should become realistic, sorry, this is a capitalistic game. Okay? We don't want we don't want control of capital issues, pricing of 10 rupee par value for all kinds of companies. Free market hai. You don't want to buy, don't buy. But don't buy and then crib. Please, don't do that.
I think that's well said. We have come to the end of this wonderful session, Shankar. Apart from the subject matter of this discussion was India's financial sector and the role of AI in this. You created a sort of sui generis framework for the way we need to deal with AI in the stock markets. It was a big takeaway as far as this audience is concerned. And of course, your wisdom, your advice on what you need to look out for in the stock market, what are the shortcomings, what are the challenges, and how you need to look at it. And your final advice on that don't go and invest in something because you made a wrong investment and you crib against the system is well taken. Thank you very much. Thank you.
I request a round of applause, a louder one. Thank you. Mr. Bhattacharya, if you could please present the memento. Mr. Sharma takes the contrarian view, as is his forte, on the pace and scale at which AI could take over human roles. It is not, he argues, the holy grail, and there is a significant risk that a single misstep could erode trust, especially when money is involved. Next up, we have a panel discussion on where the market opportunities lie for those looking to invest in equities. May I request Mr. Sundar Sethuraman, Business Standard Special Correspondent, to join us on stage. Mr. Sethuraman, please join us on stage. And may I also invite the panelists to join us as well. We have with us today Pramod Gabbi, co-founder, Marcellus Investment Managers; Manish Gunwani, Head Equities, Bandhan MF; Gaurav Misra, Head Equity, Mire; Hari Shyam Sundar, Vice President and Senior Client Portfolio Manager, Franklin Templeton Asset Management, India. A round of applause, please, for all our panelists. Mr. Sethuraman, over to you.
Okay, that's it. Thanks, Baswa. Hello, everyone. We are meeting at a time when things are looking a little better for the equity markets. The benchmark indices, Sensex and Nifty, are closer to their all-time highs. Foreign portfolio investors are net buyers again after being net sellers in the preceding 3 months. And there is a lack of disappointment, if I can use the term, as far as the September quarter results are concerned. But things have been anything but rosy for equity market investors over the last 12 months. In many ways, the condition of equity market investors was similar to the protagonists of the film One Battle After Another. I'm sure some of us must have seen it. It was, if last 12 months were to be made into a film, I would call it one Truth Social post after another. And we were constantly in a state of shock and anxiety, and we were constantly looking for a way to reach a position of safety for better returns. If, in that film, Leonardo DiCaprio's character, he is constantly in search of a secret code, which he can't remember. He's in trouble, and he needs to remember a secret code to reach a position of safety. And the condition of investors, equity investors, is very much similar. So we were in the last 12 months, frantically searching for that secret code. And, earlier wars and central bank decisions and big policy disruptions used to rattle markets. We just need one Truth Social post to rattle us now. So we have these four gentlemen who between them hold the keys for that secret code for better returns, and we are trying to we are trying to understand a way for better returns. Jokes apart, we are trying to understand where are the opportunities as far as equity investing is concerned, and how things pan out in general. So to begin with you, Mr. Gubbi, so Sensex and Nifty has yielded single-digit returns. The broader mid-cap 100 has also given single-digit returns. The Nifty small-cap 100 is down 1.6% on a YTD basis. So, but valuations remain above their long-term averages over their 10-year forward. When you compare it is above. It's more steeper in the case of mid and small-cap indices. So, what is your assessment when you look at the market conditions? I want all of you to give your initial comments on this. Does it inspire confidence? Does it make you skeptical? Mr. Gubbi first.
Yeah, I think after pretty much the post-COVID 5-year period, we had 4 years of exuberance, and 1 year of return to some sort of normalcy. Like you said, even now valuations are pretty much above their historical average. Between caution and optimism, I think it's a cliche term to be cautiously optimistic. As equity investors, we need to be optimistic, but at the same time, the core of what we do is risk management. To that extent, there has to be a sense of caution as well. I reckon the point in time that we are in the markets defines that perfectly. There are no obvious themes to play. You talked about single-digit returns. Why not? The earnings growth also has been in single digits. But at the same time, valuations somewhat have time corrected, but still not at a level where you can say screaming buys. That makes our job easier in some sense, or our job's relevant, because we are at a stage where stock becomes more important. It's a pretty much a bottom-up market. The easy money that was there between 2020 and 2024 is over. To that extent, if you remind yourself that equities is a long-term asset class, you need to be disciplined and stay invested, focus on fundamentals. I think this is as good a market as it can be.
Okay. Mr. Gundwani, your comments?
See, I don't think PE or price to book is actually a good way to look at the market. I think over the long term, if you see, equities tend to return about 5 to 7% above inflation. And if you take a 10-year or 20-year period, we are somewhere around 6.5%, 7%. So we are perfectly in the fair value zone. I don't think we need to be very greedy. I don't think we need to be very fearful. Having said that, I do think that while valuations are not cheap, we have to remember that globally government debt is at all-time high level, which is usually a precursor for very, very easy monetary policy, because when the biggest borrower is setting the interest rate, there is incentive to keep the interest rates very low versus inflation. So we've seen it in Japan, for example, which has been running negative real rates for a long period of time. So I'm actually not very defensive about equities. I think on a 3-5 year basis, double-digit returns are my base case for returns.
Okay, Mr. Mishra, your thoughts is caution the better part of valor, or
No, I mean, I have a constructive outlook. Of course, it depends on the horizon we're talking about, but for investors who are looking at the markets with a 9-month, 1 year and beyond sort of horizon, I have a very constructive outlook. First, of course, is the health of the market is very robust. It's a diverse market. There are, buyers, but there are also a large amount of sellers. In recent times, we know the FIs. So it's a diversified market. It's not a one-sided market. Of course, within that, there'll be sectors, but on an aggregate. Then additionally, the markets have not given returns in the last 1 year, but it's because there were excesses earlier. And when you think of it in the recent 1 year, for instance, the markets around the world, whether it's leaving aside US, but if you think of, the other emerging markets, Europe or Japan, all of them have had returns clearly superior to India, but it's been driven more by re-rating. So for a change, India has had just a little bit of returns and mostly led by whatever earnings growth has come by. But the reason I'm really more constructive going forward is these cycles I'm seeing, sort of the growth outlook, which should be getting better. We've had enough policy measures put in place, whether it is direct tax, indirect taxes. And therefore, on the back of that, I would think, whether it's the credit cycle, even, the automobile, it's a big part of the manufacturing, so that cycle should kind of restart. Real estate, as long as the builders don't get too greedy with price increases, should also be on a slightly, continued upward tick, I would say. So, yeah, we've got some big parts of the economy which should be looking up, and therefore the earnings growth, while we've had a bit of a lean patch last 2 quarters, but should start getting better as we progress into the quarters ahead. I think earnings estimates for next 2 years on a CAGR basis would be clearly in, mid-single digits. There would be some cuts, but still we're looking at healthy returns from this asset class over others. And valuations, where we are right now as a starting point, are around average at an aggregate. Of course, so therefore, it's going to be more about stock selection at the bottom of bases and all that. That will matter.
Mr. Shamsundar.
I echo a lot of what has already been said, but to set the context on why we have underperformed in the last year, first, the context is that there is a global equity bull market happening right now, and we have not participated. The reason for that, of course, we had done well last year, but our earnings disappointed very materially in the last year. What we're seeing in recent times is that maybe that extent of disappointment is reducing, and the catalysts are in place for an economic recovery. The policy support has been tremendous. Fiscal policy support and monetary policy support. The RBI has come out with aggression which we haven't seen for a long time. That sets the groundwork for a strong recovery in the next financial year. We have already got, the current estimates are very healthy. Unlike, normally they get cut a bit going into the year, but even if it doesn't get cut to the extent that, we've happened this year, we're setting ourselves up for a good next year.
I want Mr. Gopi and Mr. Gunwani to your take on earnings, and after that we will come to, we also had this last 1 year or so, we had a number of measures to boost consumption and to make, the impact of tariffs, etc., bearable. Like we had the income tax exemptions being raised, the GST rationalization, and as Mr. Shamsundar said, RBI has been cutting rates. So how is this going to sort of play out in the markets? How is it going to trickle down at the ground level? First, your take on earnings, and then about these measures. Mr. Gopi.
Yeah, so earnings, I think we're pretty much at the bottom of the earnings downgrade cycle. If you saw the last 2 years, pretty much 6 to 7 quarters, consistently analyst expectations have been missed, and we've seen the downgrades. This is perhaps the first quarter where we'll see fewer downgrades coming through. I'm not saying the earnings growth has recovered dramatically, more like expectations have come down. Now we are pretty much looking at FY27, possibly a mid-teen sort of an earnings growth. To that extent, I think we are in a sensible position, because at the end of the day, markets work on expectations. As though disappointments which led to the modest returns that we've seen in the last year, if expectations have been beaten down, I think we need to be a lot more positive in terms of the markets. As far as the effect of GST and consumption, I think on the ground feedback is pretty good across consumer durables, auto. I think the consumer has responded positively to these cuts. As it is, I reckon the consumer was bottoming out in terms of the cycle. Given the excesses post lockdown opening up, we saw boom in retail borrowing and then eventual clampdown by the RBI. The consumer went through 4 to 6 quarters of tightening purse strings and repayment of debt, lowering of EMIs. We reckon we are at a stage where these cuts, both the income tax cuts as well as the GST cuts, plus the fact that the consumer balance sheet is relatively better compared to, say, a year ago, should result in both economic recovery through consumption, which is a large part of the GDP, as well as top-line growth for many companies exposed to these drivers.
Mr. Goodwani, your thoughts?
Actually, I'm not very bullish on large cap earnings. My sense is that if you take long cycles, there are periods where corporate earnings of Nifty 100 outperform nominal GDP, and there are cycles where it underperforms. So if you see 2002 to 2011, 9-year cycle, corporate earnings of Nifty 100, they grew very fast versus nominal GDP. Then for 9 years, 2011 to 20, they grew much less than nominal GDP. Now the thing is, 2020 to 25, you've had 5 years where Nifty 100 earnings has grown at 20% CAGR roughly versus nominal GDP of 11%. Now, when you're sitting on such a high base of 5 years of earnings outperforming nominal GDP, I think the best you can hope next 3-year CAGR will be nominal GDP, which will be 10-11% for Nifty 100. But I think this market is actually, personally, I feel, a small cap market actually, because there is so much technology change, there is so much of geopolitical change. The real growth is going to be beyond Nifty 100 or Nifty 200 also actually. So I do think that if you want companies which can grow at 20-30% CAGR for next 5-10 years, I don't see very much in the top 100, 200 companies which can deliver that.
That's interesting. Mr. Misra, your thoughts, do you agree with Mr. Gundwani's assessment that, we have to look beyond the top 200 companies to spot the real winners? And also both you and Mr. Shyamsundar about how all these reform measures, when will it trickle down and how is it going to play out in the equity markets?
Okay, so first, in terms of the reform measures, I think we have seen some signs clearly on the discretionary part, the automobiles, etc. But surely, when you add up the tax breaks, both direct and indirect, there will be more disposable income. There are differing elasticities of demand. So, some of these segments have seen that already play through, but net, because there will be more disposable income, depending on the propensity of, but there will be demand for even, at the extreme end, staples, select categories where maybe penetrations aren't, still there in the country. And then, upwards to maybe residential EMIs will become more affordable as rates are also coming down, and maybe into savings. So it's going to be a blend spread across, the whole spectrum. And therefore, we have to monitor and watch, how it's panning out. Initial signs, at least in a few categories, are known. So I'm kind of, comfortable with that playing out and looking forward to that. Then we know that next year there'll be the pay commission also, which will help. To the question on what categories will do well, see, I mean, India, where we are, a $4 trillion economy, it's a given. This year, no doubt, inflation's been very low, so we're looking at a sub-optimal, a sub 10% nominal growth. I think as the base sets in next year, calendar year, we should be back to that, 10% plus nominal growth. And, with that kind of growth and a GDP, which is where it is, I think it's going to be the whole corporate sector which will participate, because you've got the big entities, whether they're the automobiles or banks, they can't be left behind if India is going to become a $5 trillion and a $7 trillion economy. So the trick would be to capture, good companies which are going to, partake of this opportunity in a profitable manner. And of course, you want to get them at the best valuation. So I think opportunities will be there across the market cap curve. Having said that, the composition of the market caps also vary, right? The large caps have a certain dominance of, say, the larger IT or metals or even the banks, maybe staples. So not all of them are going to be equally attractive, but and vice versa. The small cap, mid caps will have their share of maybe more hospitals, more chemical companies, more engineering companies. So you've got to be present across, because my belief is that the India opportunity is a structural one, it's a decadal one, and it's going to be spread across cohorts, across market caps, across industries. So it's just that nature of the indices are such that you have the compositions vary. We have new IPOs, some come into the mid, some are coming into the large and small as well. So, and there'll be winners across. So I think it's going to be a very, very promising sort of market across the market cap. So then the question is how to participate. That's more an allocation issue between how do you want to do it between these various market cap cohorts.
Since you mentioned valuations may not be at our desirable level all the time. So how does one take a call, like when valuations are not that great or it looks, slightly elevated, but the company looks promising. So how does an ordinary investor take a call or whether to buy that stock or not?
No, I mean, if valuations are not comfortable or they seem to build in all what is the growth, valuations also got to incorporate the quality of that business, the character of that business, your comfort with that character being resilient, under all periods of stress and so on, and also the growth. That's a function of the opportunity that business is addressing, the TAM and all of that. But if all of that is still suggesting that there's too much of growth built in, the price is building in growth which just can't be reached, done on a year-on-year basis, then it's best to stay away, of course. But it's a good market because you have a lot of sectors, right, across, and companies within sectors. So you have to pick, you have to pick and choose. And I'll just add one thing, I think as we speak now, clearly, as was being mentioned, that the earnings growth outlook for mid-caps may be better, slightly lesser for the small and the large caps. But yeah, then you've got to incorporate valuations in.
Yeah, since you mentioned mid-caps, even their valuations, I'm talking about the mid-cap 100, it's slightly above the 10-year averages. The Nifty is, little 1% or something, but the mid-cap 100 and small-cap 100, it's a bit more elevated. So how does one play the mid and small-cap space? When we are confronted with this dilemma, when the valuations are looking steep, but maybe the company is looking promising. So how does one play that?
See, I mean, it's a function of the comfort one has, first of all, with the business. Okay, and I'll just add one caveat here. Small caps tend to have greater fatality historically. There'll be more dropouts from the small cap for whatever inherent weaknesses, which would be more, management, lack of management bandwidth and all of that. Typically the small caps. With the mid caps, that's not the case. So that's a good fertile hunting ground. So as far as, the valuations, yes, at an aggregate, they may be higher right now for, say, some of these indices, but it's really a bottom-up, effort where you've got to incorporate other attributes you want in that, in that business. And for a retail investor, either you're tracking it closely and you're comfortable with management attributes and, that business, else you want to, give it to professionals who are doing a, job of it day in, day out. And in any case, keep allocations kind of done nicely, and you have to review them so that you're not, especially if some part of the market isn't very well. So you want to, at some stage, as valuations have gone to an extreme, then reduce your exposure there. Your weights to that sector, say small cap, might have gone above what is an optimal desired threshold. Then you'd want to reduce it down, right? So yeah, it's an ongoing thing. You, as a retail investor, if you're doing it yourself, then you have to really dirty your hands, be completely involved in tracking it. But if you've left it to a professional, even then you should review your allocations, periodically, maybe 6 months, a year, and then take it.
Yeah, Mr. Shamsundar, I also want to ask you, since you mentioned themes and all, we had this thing called the momentum stocks, when something will run up and everybody will chase, and those who start at the fag end burn their fingers. So how does one sort of insulate oneself from the market chatter? And also, since valuation is being mentioned in social media now, there is a lot of noise about valuation of one particular stock, one IPO. So how does one keep oneself independent-minded, if I can put the word, when there is a lot of noise all around?
Valuations is a separate, it's a full topic itself. There are books which are written on it, so it's a bit hard to capture that in, in a 15-minute discussion.
I'm just asking you for, ordinary investors like me.
Sure.
So, for the ordinary folks. So how does one take a call?
So, momentum, FOMO, all of those are real effects which play out for not just retail investors, but even professional investors continuously have to fight it. So for us at least, it's about anchoring ourselves into growth expectations. See, valuations, in the end, if I had to simplify it, three parameters matter: growth, return on equity, and cost of equity. I mean, those are the three things you can create a full valuation framework using these three parameters. Now, the assessment which becomes difficult to do is to estimate how much the sustainable return on equity will be, or return on capital is going to be, or how sustainable is the growth. What is the longevity of the growth? What is the growth pipeline? What is the management's ability to tap into adjacencies and unlock growth rather than just the current line of growth? So it is a very challenging art. It requires a lot of deep work, and I don't think there are any real shortcuts which can be used, because I mean, nowadays many of the IPOs, without getting into names, are not profit-making. So and they're not necessarily stable businesses. They are coming at a point where there is substantial growth which is still being unlocked. For example, the food delivery companies. They moved into adjacencies and they have unlocked a new paradigm of growth for them. So these are not stable businesses, and their returns as well as sustainable cash flows and growth potential are not stable. And so it is a very challenging art to do. No easy answers, but just giving a flavor of what the complexities in it are.
Fair enough. We have to give the audience a chance to ask questions. Please raise your hands. I request the audience to keep your questions concise. Yeah, volunteers. So.
Hello, myself Keval. Since last 2 years, mid-cap, small-cap companies are not perform much better than the large cap due to global scenarios, markets being down, range bounds, and even some of the tariff outcomes and everything. So how you diversify your risk, and even side-by-side unlisted companies are coming up. Lots of IPOs are coming up. So how you diversify your risk management?
Yeah, any one of you wants to take that question?
I think from a retail investor perspective, your best risk management tool is asset allocation, coupled with systematic rebalancing. If you figure out your risk appetite, and obviously you're investing for a reason, you need to know the why, which is what's called as goal-based planning. That drives your asset allocation. You got to be disciplined about sticking to that asset allocation. So if you've had a period where small caps have done really well, for example, 2020 to 2024, for example, your small cap allocation would have gone up significantly higher than their justified allocation. So the right thing to do is to take profit off small cap, bring it back to the relevant allocation. It's easier said than done, which is why I say you got to be systematic about it. If I had told anyone the summer of 2024 that you should be selling small cap, I would have been the most hated person in the room. But which is why this is a little bit of a behavioral job than intellectual. So you need to be able to take those tough calls, selling at the top and buying. This is the most cliched word that Buffett used, but it's the hardest thing to implement. Like Hari said, it's not just for retail investors, even professional investors like us struggle with that. So risk management through diversification and asset allocation is the most important thing for retail investors. Risk management at the asset manager level for us is valuation, because we're dealing with inherently unpredictable events in the future. Unless and until we factor in a margin of safety in those valuations, we'll be exposing ourselves to that risk. And at the end of the day, most people like to talk about returns when this job is all about risk management. Returns without the context of risk is a meaningless conversation.
Yeah, anyone else? Yeah, Mr. Shamsundar.
I mean, just to add a bit to that, since you spoke about mid caps and small caps and not having done well recently, there is no rule that they have to outperform large caps every year. They are riskier investments. Part of the reason is what has already been spoken about, which is the mortality which is there in small cap stocks as well. There is an element of us having to spread our risks. And also, one of the things which I think many, let's say, new investors struggle with is that risk appetite is different from, everybody likes to say, I have a high risk appetite. But until you have a sharp drawdown, you don't really realize what your risk appetite is. So I think it's important to always assess the risk appetite and then accordingly gauge how much you can actually tolerate in terms of drawdowns and accordingly size your portfolios.
Okay, any other questions? Yeah, the lady over there. Please give her the mic.
Hi, my name is Reni Chakravarti. So we heard a lot about the top 3 sectors, for the next 3 years, 5 years. What would you guys think about that? What are the top 3 sectors in the next 5 years or 3 years?
Yeah, who'd like? Mr. Gunwani, can you?
So, not sectors, but the 2 or 3 themes we like. One is this whole tech platforms. We think that they can grow very fast. And usually what happens with tech platforms is the margins at the end, when the winner-take-all kind of business configuration finally happens, because initially they're acquiring customers, they're loss-making, but the margins at the end are usually very, very healthy. So if you're a long-term investor, some of these tech platforms are worth looking at. The second theme we like is basically movement of savings away from banks to capital markets, because I think clearly on a post-tax basis, a fixed deposit or savings account is not a very optimal way for people to save. Now, capital markets, again, are a very cyclical business, so I'm not saying capital market stocks, you should time your entry, but I think, again, from a 5-10 year perspective, these are the themes we are excited about. The third is, we think, while it has gone through a bit of downturn with this US-India relationship, but we do think China plus one in high-end manufacturing will happen. So complex stuff, whether it's in pharma, auto ancillaries, defense, specialty chem, if you can find a stock where the management is aggressive and valuations are okay, we do think India has a right to win in anything where engineering or scientific input is very high.
Okay, anyone else would like to add?
Yeah, just one other theme, we are talking about themes rather than just sectors, is the changing consumption habits. Right? So premiumization is a theme which, at least at FT, we are very positive on. It's even yesterday, I mean, one of the companies put out a press release saying that in this, even after the GST cuts, what was stark was the premiumization of consumption which is happening. So the customers are going for more premium variants. Customers are moving up a model. So the consumption shifting from needs to wants is a powerful driver which is going to endure. As India becomes richer, we are going to see new categories being created. And it's the companies which can really address those changing tastes, which is going to really become the successes of tomorrow.
Okay, we have time for one question. Yeah, sir.
Hello. I have small questions. Can I ask a couple of them?
No, yeah,
Or
one.
Okay, one. So if I have one question, then I'll ask.
We are available offline, so you can ask
Okay,
them.
no problem.
One question, please.
Can I have an expert advice on a thumb rule for holding a particular stock? What percentage if I have gained, so can I quit? Because holding, there is no limit to hold. So if I hold it...
Yeah, understood.
Yeah.
So when do you sell, when do you exit a stock? That's
A particular percentage range.
Yeah. At what percentage should you book profits? That's what he's asking.
I don't think there's any thumb rule. There shouldn't be any thumb rule. The most commonly accepted mistake by some of the greatest investors is not about buying the wrong stock. It's selling a great compounder too early. So if you've done all the hard work in terms of finding that compounder, as long as the reasons for buying that hold, I think it should be like Buffett says, permanent ownership. If the promoter of the company is not going to sell because the stock has gone up, right? If you behave like the owner of the business, the ideal holding period, Buffett has always said, is forever. Of course, we go wrong with assessments. Not all stocks are great compounders. There is some, short-term trade to be done. By all means, as soon as the gap between the price and value closes, you should sell it. But for most great compounders, it's an infinite time horizon.
Okay, we'll have to wrap up now. Thank you, gentlemen. That was a fruitful discussion. So, the takeaways, at least for me, are, as Mr. Shamsundar said, we have to figure it out ourselves by, burning our fingers, assessing our risk appetite. Look at it, it has to be a stock-specific approach, and we have to, as Mr. Misra said, we have to look beyond the top 100 or top 250 and really analyze the stocks and make up our minds. Thank you all. I hope you got some food for thought here. Thank you, everyone.
I would request the panelists to stay with us. And I'm sure we can have another round of applause. So, word to the wise. Investing in equities is something that even professionals think is difficult. As they say, it's not just an intellectual job, it's a behavioral job. And if you're a retail investor looking to go it alone, you had best be ready to get your hands dirty. Before we begin the next session, there's a panel discussion on the broking industry, which has just commenced at the Narayan and Vaghul Hall on level 2. Those who wish to attend can proceed there now. For the rest, our next session here will commence shortly. Now we bring you a panel discussion with the country's leading mutual fund CIOs. Once again, I invite Mr. Sami Modak, Business Standard's Senior Markets Editor, on stage. And may I also invite the panelists to join us as well. We have with us today Shailesh Raj Bhan, CIO Equities, Nippon AMC. Mr. S. Narayan, CIO ICICI AMC, Mr. Mahesh Patil, CIO Aditya Birla Sun Life AMC, Mr. Rajiv Radhakrishnan, CIO Debt SBI AMC, and Mr. Rajiv Thakkar, CIO Parag Parekh Financial Advisory Services AMC. Over to you, Sami.
Thank you, Baswar. Good afternoon and warm welcome to all the panelists and those in the audience. Over the last 1 year, India's equity markets have been through a phase of relative underperformance after several years of strong gains. This shift has naturally influenced investor sentiment and has called for both caution and introspection. Today, we explore how the investment leaders are interpreting this phase and what it means for valuation, risk appetite, and long-term investing mindset in India. So I'll start with Narayan. Sir, you have been cautioning investors last year when markets were at their peak, and now we have seen some 13-14-month period of consolidation or stark underperformance to global peers. Do you think now is the reason to cheer, or one should still be more guarded?
I think India has now meaningfully underperformed all the markets in the world, actually. And, earlier we used to think India was overvalued and all other markets were undervalued. Now, when you look at it, all markets look overvalued, actually. And so the way it looks like, it doesn't look like you have a situation where you can have India doing badly and the rest of the markets doing very well from here. So our view at this point of time is if US market continues to do well, India also has to do well. It can't be like last year where US did well and India did badly. However, at some point of time, I think global markets also should see a correction, because when you look at valuations, particularly of US artificial intelligence-based stocks, you can clearly see that they are all very, very costly. And today, many companies are worth $1 trillion. One stock is worth $5 trillion. Another is worth $4 trillion. And therefore, I think at some point of time, there should be a US AI stock-based correction. But till that point of time, India should also do well from here. So our thought process last year was maybe more caution dependent on India. Now we tell people do asset allocation, but maybe a bit more positive than last year. But we no longer worry specifically on India, because I think India has very good macro, much better situation in terms of long-term growth story. People have realized that you can't make money too easily in secondary markets. So that level of extreme buoyancy in secondary market doesn't exist except in the IPO market. So I believe that we are in a better shape for, but at the same time, when we tell people you can't make mega returns from here, people don't tend to believe us. So we are in a moderate return situation, but safer than 1 year back.
Thank you. A lot of investors come to the market with expectations of huge returns. And we have seen, those who have, such investors have been left disappointed. Shailesh, do you think this reset that we have seen over the last 13, 14 months was required? And now will it help recalibrate expectations?
See, expectations are not getting recalibrated, because when we meet people, we realize return expectations haven't shifted down, because they are making money somewhere else. Gold is giving them silver. Something or the other is moving. And every Indian, I'm sure, is feeling left out seeing US markets, right? So I think the excess money, or you call it, or the euphoric expectations are shifting from market to market. Indian markets by themselves, especially the large cap space, is getting more sensible. It's delivering possibly earning-led returns. And we think earnings should improve, allowing for much better outlook for larger, at least Indian equities. Was mentioned on terms of IPOs and all. Clearly, there is a lot of euphoria shifted from public markets to private markets and, or IPO markets. And we are finding their valuations higher than listed companies already. So it's like relatively something is better priced. But on an absolute basis, can you make large returns? I don't think that is the case anywhere. So expectations have to still tend very moderate earning-led.
Since we peg India's performance to other global peers, this year India has been a stark underperformer. Like the MSCI emerging market is up some 25-30%, led by China, South Korea, and we are largely flat in dollar terms. Mahesh, what do you think has led to this underperformance, and does India look better compared to peers now?
Yeah, so if you look at a year back, right, India market was doing well. Right, valuations were high at that point in time if you compare with the other market. In fact, India's relative valuations to the other emerging markets had reached a kind of a peak level, what we had seen last 10 years. This is around 1.5 years back. But more importantly, I think why foreign investors come to India, FIIs, is for the growth, right? Relative growth in India is better, and they are willing to pay a premium for that. Now, that really faltered last year. If you look at last 4 quarters, the earnings growth for corporate India has been in the mid-single digit, which was kind of prior to that growing at somewhere in the high teens, right, for almost 2.5 years. So clearly, the fact that the growth slowed down, so that was one of the reasons why the markets underperformed. Also, in the initial part, we had seen some kind of a fiscal contraction which was there, right? Government spending was low because elections. Monetary policy in the initial period was slightly restrictive, right? At a time when we have seen a growth slowing down. And all that factors actually led to the underperformance, I would say. And then more recently, somewhere in the mid of this calendar year, the trade policy, right, which was also impacted, and the uncertainty on the trade deal led to the underperformance. And also, somewhere down the line, we saw rupee itself, right? Rupee, which was one of the strongest currency, right? Prior to that, if you look at a year back prior to that, Indian currency in terms of volatility performance was really strong. So that also came under pressure. I think all these factors led to the underperformance. And I think a lot of these things are now reversing, at least are not negative at the margin now, right? Whether you're looking at in terms of growth itself, I think now with the stimulus which has been given in the budget, the GST rate cut, consumption, which was one of the pillars of the GDP, which was weak, which was lagging. Since COVID, I think that has been lagging. That is, I expect to get some kind of a boost from here. So you should see monetary policy is now pretty easy. I think RBI has a lot of steps, okay, to ease liquidity. Even for the banking system, I think a lot of things have given so that we can go out and lend. We have seen rate cuts, 100 basis point, probably more you could see down. So that should start, as the impact of that translate, you should see now growth at least improving. And one should expect that in the next few quarters or next year, at least the growth should be in the double digit, at least for the earnings growth. And I think all that, I think should, as I said earlier, I think the outlook at least looks better than what it was a year back. Valuations also of the market, this thing are now more reasonable, I would say, both relative as well as in absolute terms. So yeah, I think, and most important thing is the trade deal, right? Which was the last kind of salvo which hurt our market sentiments. I think we are also now progressing over there, seems to be in the right direction. So once that happens, I think the sentiment will improve, and most importantly for a sustainable recovery from here require the capex to come in, the private sector capex, and that will come only when there is more clarity on the trade deal.
Thank you. Rajiv, valuations are now more reasonable, growth should pick up. Do you also share the same views? I'll go to Rajiv Thakkar first, and then I'll come to you.
Things are better than last year, surely. 12 to 15 months have gone by without stock price moving up. Earning growth, although has been anemic, still earnings are higher than what they were last year. However, on a relative basis, if you look at some of the newer listings, especially MNC companies, now the Indian company earns a fraction of the global revenue, whereas the Indian market cap is equal to the global market cap. Clearly, there is some disconnect. One can argue India is a growth market, all of that. But if you buy the parent at the valuation of the Indian company, you are getting the global business for free. So clearly, all excesses have not gone away. Headline multiples, you can look at 22 times earnings, 23 times earnings, whatever is your favorite number one can pick. Doesn't seem too excessive. But there are pockets which are clearly exuberant where excesses still have to be worked out. And growth, increasingly, I think the country of listing does not matter so much. What matters is the underlying business. So let's take tech, for example. Our companies are mainly services companies which have shown flattish kind of revenue growth. Whereas you look at the Mag 7 reports coming in. Now, these companies are growing 15-20% in dollar terms and growing bottom line at 30%, even on such a large base. Whereas our large companies are not showing that growth. So unless growth comes back and we have valuation parameters which are comparable, you won't see explosive returns from here on. Still, I would think from a 5-year perspective, equities will deliver better than bond kind of returns. So people should stick to their asset allocations, but don't expect hyper-normal kind of returns. That's the message I would like to convey.
Thank you. Valuations have cooled off, but there are pockets of exuberance, so one has to be careful. Now let's get some views from the debt side. Amidst the sort of turbulence in the equity space, how has the debt space looked like? Have returns been better than normal? I mean, how are things played out there?
In fact, unlike equities where we always debate about the valuations in the market, I think on the debt space where we are today, and at least on a forward-looking basis, the valuations, if we were to look at, they are very favorable, because after a long period in time, you have a phase where you're not really worried on inflation. I think that's a big narrative change that has clearly happened, right? And of course, we've seen the RBI being accommodative to the extent of policy rate actions, more so on the beyond the headline policy rates. there's been significant amount of liquidity infusion measures that they have done. So standing today on a forward basis where inflation is expected to be, I think this financial year, we're looking at an average of something like 2.6. And even on a forward basis, you are anchored close to the inflation target of around 4. That clearly is a very favorable backdrop from a debt market perspective. I think there is some more elbow room for the RBI to ease policy, but we need to be realistic to the extent of additional rate cuts that you may get in this cycle. So where we stand today, it's clear that there is space for them to ease, but we need to recognize that a large part of policy easing is already behind us. And I think there's a lot of comfort in the fact that we are not staring at a reversal of the cycle anytime soon. So my sense is that we possibly see one more rate cut from the RBI and a long period of pause alongside favorable liquidity conditions. So I think that's a very significant, sufficient impulse to revival of economic growth.
Yeah. So you said conditions are favorable for fixed income, but where do the opportunities lie?
So I think that's a very interesting question. So even in a very, even when you look backwards over the last 1 year, most of the short-end fixed income funds have done very well in terms of, returns. But have you really seen flows there? No, not really, right? I think the bigger challenge clearly is that the way our taxation is something that we keep, I think that has come in so many discussions that we've had in the past. And the reality is that, yes, that is impacting allocation into fixed income products. But on an encouraging sign, we have really seen a lot of flows coming into fixed income through hybrid and asset allocation type of products. So I think going forward, these are the type of products where one would possibly see the fixed income play or the fixed income allocation being made. It's very challenging, honestly, given the existing tax regime, even in a very favorable backdrop of policy rate easing, to anticipate flows coming into these products. So I think that's a big challenge that we clearly have.
Right. Most of you all touched upon the IPOs. This last year, we had a record run, I think 1.6 trillion, which is close to $20 billion. US dollars got raised via IPOs. This year, we are set to surpass that tally. This momentum is also underpinned by participation of domestic mutual funds. So if I have to ask you, there is one narrative that the kind of flows that are coming into the mutual fund schemes, we need this kind of paper supply to ensure that the secondary markets don't heat up too much. Do you also share this view, and how do you approach when it comes to investing in IPOs or block deals?
See, we have to be choosy, right? Our job is to select, allocate capital appropriately. And in any bull market, there will be supply, because bull market by design creates an opportunity to sell. So today, anybody who wants to sell his stock, whether it is a promoter, whether it is a private equity investor, because these kind of markets with such good valuations are not available in the dreams of a lot of the people who have invested in earlier. So I think that is the nature of the market. For us, it's very simple. Are we buying the right business? Are we paying the right price? I think when you don't get these two things ticked, we are generally careful. And like you said, IPOs or new companies are generally, especially new age, new category businesses which are being formed and which have a right to win. Those businesses, we would welcome them in the markets, right? So any business which will allow us to buy a sensible long-term opportunity, we are okay.
Sure. Mr. Narayan, right price, right business is the same approach or same mantra that you follow. How do you go about looking at IPOs?
The thing is that we have today a lot of money, so that money has to be deployed. So as you pointed out, if IPOs and blocks and QIPs had not come, I think it would have been a problem. Markets would have rallied a lot. So I think from that point of view, it's good. The challenge for us is that we should allocate, but if I go back, and I said this in another meeting, that if I go back to the 2006 to 2005 to 7 capital cycle, the principal allocator of money was banks in that cycle. So all the decision on who funded capex happened through banks. And when things went bad, it was the banks which were sitting on non-performing loans. In this cycle, the entire burden of capital allocation is happening through direct equity investors, mutual funds, PMSs, AIFs, etc. So if the capital allocation happens wrongly, the investor is going to get directly affected. Unlike the last time where actually banks made the mistake and then there were non-performing loans at that point of time. I don't know whether investors recognize that they are taking all the risks in this cycle. We are all agents. So whether it is a mutual fund or anyone else is an agent in this cycle. So the entire burden of risk transfer is now transferred to investors. And while we are agents and we have to do the job, it becomes, therefore, the responsibility becomes tougher on us. And investors don't recognize, they're so fond of equity today because the cycle has been now in the 13th year that they think equity is riskless. Then they think micro-cap equity is even more riskless. So what happens is you've created a condition whereby they are willing to take risk. And that risk ensures that almost anyone and everyone gets funded through these IPOs. So this is a risk finally the investor will bear. Like at some point of time when the wrong company raises money, the investor will bear. And if investor invests in a small cap fund, the investor is investing in small cap fund. So then the small cap fund has to invest in small cap stocks. So if the small cap companies raise money stupidly, the small cap investor will lose. So this is something people haven't understood in this cycle. So effectively, it is the investor who's taking all the risk. In the last cycle, banks took all the risk. In the early 90s, when I started my career, the risk used to be taken by the development financial institutions at that point of time. So over different cycles, different people are taking the risk. And this is something I hope investors recognize. And they recognize that they are taking all the risk in this cycle.
This is a very important message. When we invest in a mutual fund scheme, we are essentially asking the fund manager to invest your money in a particular cohort of the market. Fund managers, of course, will use their discretion, but you're not giving them money to sit on that or sit on cash. Mr. Patil, I would like to ask you, despite the volatility, flows have not seen any sort of deacceleration. So does it make the job of fund managers challenging? There is so much money that is coming in, but valuations are not where they should be. So as a fund manager, how do you tackle this?
Yeah, so it can be a challenge, in certain categories, right? Because if the flow come in a particular categories, like for example, say mid cap or small cap, right, where the free float is limited, and also the new supply coming in also is limited, then clearly I think there is a challenge in terms of deploying that. And again, earlier we also had some option of investing into overseas market, right? And some of the funds have done that in the past. So that option is also no longer there. So you have to be restricted to the Indian market. And that at times can be challenging. We saw that actually it was acute a year back or 2 years back, right, where we saw big money come into the small cap and the mid cap schemes. And that created that kind of a bubble. And we've seen some kind of a moderation of that happening through. As a fund manager, clearly I think in that scenario, it either comes to how to manage that, right? So you will see a lot of funds. The number of stocks in the portfolio has gone up quite a bit, right? Especially very large schemes where the money flow has been large. Then you need to necessarily diversify more than what you would normally like to have in a portfolio, right? So that's one way to mitigate and disperse that flow into liquidity into a large number of stocks. But I think the flows have now kind of moderate, and in fact now the supply is more. In fact, in the last couple of quarters, we've seen again, as you rightly said, the supply is not only coming from IPOs, but it is also coming in from QIPs, promoter sellings, a lot of MNC companies, global, they have also used these high valuations to really liquidate. So I think there is enough supply now which is coming. In fact, I'm slightly worried now in the supply which is lined up, right, in 1 or 2 quarters. And the flows, I think there is a right balance. And in fact, especially in the large and the mid cap, there are large ticket IPOs which are coming in. So to that extent, I think that is also going to be a reason why the market growth also now will be slightly more sluggish, because you will see a good amount of supply hitting the market.
So one way to tackle the problem is having more stocks in your portfolio. Mr. Thakkar, I would like to pose the same question to you. I mean, there's so much liquidity that is coming in, and valuations are not as attractive as they should be. How do you sort of approach the market?
Sure. So thankfully, one advantage that we have is we don't run too many sectoral or thematic schemes, or we don't run market cap based schemes. We run only diversified funds. So that helps us to go where we see opportunities. In every frenzied market, in the current one or even in the past, there are pockets of excesses, and there are pockets where people have lost interest or people ignore those spaces. So in late 90s, there was a bubble in TMT stocks, and what was called old economy was ignored. Ironically, 2007 bubble was in real estate, infra and commodity, whereas you could actually buy IT services or FMCG kind of names in 2007 and still do reasonably okay. So what we do is, one, focus on areas where the valuations are not excessive, or where past returns have been moderate, where no optimism is priced in, people are generally pessimistic. That is one thing that we do. Secondly, if we don't find something compelling, we don't force ourselves to be fully invested at all times. So different fund houses have different thoughts on this, but at our end, we say that we will deploy when we really are excited to deploy.
Mr. Narayan and Mr. Bhan, would you also like to share your strategy as to how does one tackle this problem where there is so much money coming in and opportunities are few?
In the last 2 years, almost continuously, we've been marketing only asset allocation strategies and telling people to focus their entire investment, new investment on products which are asset allocation oriented, which are hybrid products. Because those are products which are not fully invested in equity because of currently the investors' belief that only equities are the only asset class. So frankly, luckily, investors have responded well and focused on investing with us in asset allocation products and hybrid products. Because we feel that that's the only way to ensure that at some point of time when the market's correct, they would have had a better investor experience, and that is the only way. And other products, we have closed our small cap and mid cap for subscription for quite some time. And it's not an easy decision for us actually, because both investors and everybody have been trying their best, telling us to open it. And the other products we recommend substantially on systematic investment plans. We do have thematic products, but in those thematic products, many of the new, we try to run it with as defensively as possible at some points of time. Within the requirements of the SID as per Sebi. So, you try to do all these things. These are not capital protection strategies or something like that. But these are the methods that we have tried to do. But, none of us can predict markets. We keep telling people investing is not arithmetic. If people had asked, even 1 year back, we thought some of the US market was overvalued along with India. But if you were a US fund manager, you went totally wrong. US markets continue to zoom, only Indian markets corrected. So frankly, we all think that we can predict markets correctly, but we can't predict them correctly. And so that's why I think we shouldn't assume that we'll get the market call correct. So that's why you have to do it somewhere in between and focus on hybrid and things like that, where you have a little bit more leeway and have more unconstrained products like multi-asset and all that, so that you try to give investors a better experience and hope you get it right. That's what is the process that we have tried to follow.
Thank you, sir. Would you like to add to that?
See, there are many ways to do it, like, asset allocation being a prime way. As a fund manager, you have to deal with all kinds of market, and nobody can predict what's going to happen. So in that, there are times where you have to choose the risk you take, right? For example, this is possibly last year was the time to buy possibly the best quality businesses, even if they were expensive, right? and not possibly put large amounts of money in fragile businesses or micro caps or blah, blah. Our idea is very simple. We take only or attempt to get only as much as we can deploy. For example, in small cap, 2 years back, we have stopped taking money lump sum and we are taking SIPs. And the idea is very simple. We have enough research and support to back select pockets of the market with their opportunities. And second, we have clear in communication. The controllable is what? We can communicate what we are doing and we can communicate the risk in the market which is there. So our communication has been less than 5-year money, don't come to small cap, come to small cap only in an SIP structure. You have 3-year, 5-year money, choose large caps over small caps as a category, and that's been the way it is. So, and please understand, if I like the market or don't like the market at a particular point of time, my communication, one, getting it right and wrong every time is not easy. And second, reaching out to, we serve about 20 million investors. So it's not easy to keep changing your strategy based on what you think in the next 6-12 months. And a lot of the people are coming for 5 years, 10 years, 15 years, right? So the idea is to make sure that you tell them about if you want to put money for 5-7 years, only that portion of the money you put into this and put it in a SIP format, which I think has worked well, and then choose asset allocation also as a tool to manage it.
Sure. So it's very important that you understand the product that you're getting into and not essentially look for short-term gains. As Mr. Narayan said, equities is not the only asset class. Sir, I would like to ask you, you said money has not been coming into debt schemes. So what are the key enablers that would drive flows into this segment? Because at one point, the debt AUM was much more than equity. Now I think if you look at the mix, it has changed in favor of equity. So what would it take to get back investors on the fixed income side?
No, I think clearly the amendments in taxation have played its part, right? I mean, when you look back prior to this, you had a phase when very simple, easy to understand debt products were gaining a lot of traction. I mean, and these are the target maturity products. And there was a reasonable amount of money that had moved into those products. I'm just talking about the few years just before the tax amendment came, I mean, 20 to maybe 23. Clearly, after that, and I think it's a reality that the flow of money into most debt products, especially from retail and the non-corporate investors, that is clearly tapered off. So I think very clearly at some point in time, that possibly needs to be revisited. You could possibly have a slightly longer term, I would say, lock-in. Earlier we used to have a 3-year lock-in to qualify for a indexation or a much favorable tax benefit. Today you have equated a risk-free, I would say, known return product, which is like an FD, which is basically the asset class that people typically are comparing a fixed income fund with, and you're equating that with a capital market product where the investor is taking very active interest rate and credit risk. So I think at some point that distinction needs to be made between a capital market instrument underlying product and something where there is a deposit guarantee or there is an assurance of return. So, I mean, that's completely the domain of fiscal policy. So possibly if that were to be relooked, I think that will possibly bring back interest. The second is clearly, I did mention about flows coming in through asset allocation products or hybrid. And I think that is a little bit more structural, where there is an element of equity and the taxation is a little bit more favorable. So possibly if this part of tax treatment for pure debt fund is not addressed, I think the hybrid and the allocator products are the way to go for investors to have debt exposure based upon their, I think preference in terms of how much of exposure you would want to have in debt.
Right. Mr. Thakkar, you said there is a case to look at overseas, assets. Given that we are constrained in terms of how much we can invest in overseas markets, is gold and silver, which are essentially dollar-denominated asset classes, does it make sense to look at them, or they can't substitute, like, say, investing in the US market or something?
So overseas route is available. It's just that mutual funds don't have the leeway to invest overseas. Individually, every financial year can take out $250,000 US. And I think more than 50% of the asset management companies have already set up entities in Gift City, and more are on the way. BFSI event itself had a gift city session earlier. So I think people should actively look at that. Gold and silver largely have gone up based on central bank buying. So typically after such a sharp run up, I would be generally cautious. But otherwise, these are assets with no inherent cash flow. So very difficult to form a view on what is the outlook.
True, yeah.
Basically is a guess on what two individuals will trade at 5 years from now. So that's inherently unpredictable. I would still recommend people use the LRS route to have some global diversification outside of the domestic mutual fund products and maybe through the gift city domiciled entities.
There is one very popular view that the kind of money that is coming into mutual fund schemes is giving a flow to the market, or it's not allowing the market to come down to reasonable levels. Do you believe in that theory that, the domestic liquidity is sort of cushioning the market from falling?
If that was the case, markets wouldn't have corrected in Jan, Feb, March, right? So I don't think, this is a narrative in the mind. I am investing because somebody is putting, because SIP money is coming in. People are saying markets won't come down and others are investing. So it's more a narrative driven by that. I have seen a lot of people just wanting to know if the SIP money is going up or down on a monthly basis to be able to take decisions of their investing. So it's all a narrative which is there. If you have bad earnings, a seller will come from anywhere. Right? A seller has come from foreign investors selling so much when we thought, where will foreigners go? This is the only market to be there, right? So they've gone away and they've actually sold. We've got promoters selling. So markets have their own way of balancing. Only flows matter for 6 months, 7 months, 9 months, or maybe it's there. But beyond that, I think it is fundamental cause. And yes, they keep it a little elevated, but I think they cannot determine what returns investors will get over a period of time.
I have one last question, then we can go to the audience. I think identifying themes or sectors also is a key to sort of making good returns. So are there any sectors that look attractive at this juncture? Anybody can take this question. Mr. Patil, would you like to take that? I mean, any particular sector that attracts you?
Yeah, so I think, compared to what we had seen around 2-3 years back, we saw big tailwinds which were there, right, for sectors like, for example, the real estate sector, or prior to that, we saw in the investment-led sectors, right, there was a big tailwind, PSUs. I think we're not seeing any big tailwind, but clearly I think the one framework which one would look at is the sectors which have underperformed, right, or which have been the laggards, right, of the last 2-3 years. To look at if there are any drivers over there, okay, which can do well. So from that construct, if we look at obviously there is some of these consumption-oriented sectors. Auto is one sector, okay, which has received some kind of a boost last year. Okay, was not such a great year. But other discretionary sectors, consumer durables, again had a pretty bad year. Urban consumption was weak. So with the rate cuts, okay, with the stimulus which has been given and the pay commission, okay, which would be there, right, 8th pay commission next year, I think there could be a more sustained recovery in some of these sectors. So clearly, discretionary consumption is one sector which I think one can look at. Obviously, from a structural long-term perspective, also there are enough drivers over there, like per capita income going up. And another sector which, again, from a contrarian point of view, one can look at is that IT sector. Again, no immediate drivers over there. But if you look at the slowdown what we saw last year, with the AI now coming in, I think the implementation of AI will drive probably the services companies also will require to do that. And I think now with US also with rate cuts coming in, I think some discretionary consumption could come back over there. Valuations are reasonable, dividend yields are very good in the IT sector, right? And again, we are not looking at any very strong growth, right? Again, broader market itself, economy itself, it's not like the earnings growth is going to again go back to around the high teens, it will be probably in the low teens. So as a contrarian, as a defensive, I think IT sector can look well. Again, when you look at from the relative performance, again, vis-a-vis IT sector, vis-a-vis the broader market, I think it shows that it is at a level which is looks to have kind of bottomed out. So that again can be a contrarian sector to look at. Apart from that, again, chemicals, again, a sector which was in a boom earlier, went through a bad phase for the last 2 years. We saw supply coming in from China. again, there are signs, a lot of capacity addition which has happened in the last 2 years. I think it is now coming in where you could see that now flowing through and coming. So again, that can be a sector again to look at, where you could see things improving.
Thank you. So, IT, chemicals, auto. Mr. Shankar, do you have any view on the banking sector? Because that accounts to almost third of the market. So that's the biggest sector. So any views on the banking space?
Near term, there could be some small challenges in terms of the timing issue where the loans will reprice faster than the deposits. But otherwise, I think things are broadly fine. The asset quality is under control. Growth has been something of a challenge, but I think it will come back. If the overall car sales go up, there's no reason why auto loans will not go up. If home sales pick up, there's no reason why mortgage lending will not pick up. Or if corporate capex has to pick up below the AAA rated names, those people will come to the banks for debt financing. I think the sector hasn't participated in the big run-up and it's been a laggard. I think there are some good investment opportunities out there.
Thank you. We had a very stimulating discussion. I would now like the audience to ask some questions. Yeah.
Hi, good evening. Could you comment on a couple of asset classes? One is REITs and the other is InvITs. So InvITs, if we look at either road or transmission lines, does the fund manager within the purview consider these?
REITs is something we have been investing and we have a large exposure to REITs, but they've done very well. So now we are trying to see how well will they do from here in terms of returns. You know, when a few years back REITs were really cheap relative to what we thought. But if you look at the kind of returns REITs have given, they've actually delivered extremely good returns. In InvITs, frankly, you have to go stock, you have to go specific. And I would say as individual investors, these are complex instruments to actually research. And even for us as institutional investors, I would say that these are the ones which take quite some time to actually do. Because in each case, we have to understand how's they getting the income, how sure are the incomes, how long the incomes are. And in some cases, you'll have to remember the incomes that you're getting are actually capital return. And people didn't realize it and they lost money. So frankly, I would advise that when people are investing in InvITs, they have to think very carefully about this, whether they're getting their capital back or they're getting their interest or dividend back. So I would say that easy return phase is over where, you know, people saw these instruments as very easy ways to make money. And I would say one has to be more careful. But if I take a 10-year view, I think these instruments will be very good. And at some point of time, I think maybe the industry will have so many InvITs and REITs that a separate InvIT REIT fund will come up. That's what I'm thinking. And these are instruments where actually a lot of work is required at the level of a mutual fund to look into it deeply. And that is what I think.
Yeah, I think it's a new asset class which is shaping up quite well. There's one gentleman there.
Yeah, thank you. This is Sachin Seth from Criff Highmark. Just quick question. We have seen in the last 5 to 6 years, a lot of companies coming with offer of sale, which are basically typically private equity funded or buyouts of private equity, right? Even today also, Lenskart is there, right? But we also have a similar industry companies coming, which are typically bootstrapped or built by promoters themselves over a longer period of time. So as a fund managers, when you evaluate, do you give any kind of a premium to companies coming with private equity governance, etc.? Because when we, as an investor, look at market, we generally tend to see that these companies come as a stretched sort of probably investment or the price. So just comment on that, and you know, how do you look at it when the same type of company comes from two streams? Thank you.
So, okay, let me take that. So I think, I mean, there are clearly, I think, a promoter led company coming to the market, okay, who has a long-term commitment in that. And this thing is something which normally one would give a, if the promoter is good and if you believe in the vision of the promoter, then probably will be more comfortable. See, private equity is normally when they come in, they try to max out because they have invested and the idea is looking at an exit. And most of these companies which are coming in, they don't have a promoter as such, right? In promoter, any initial promoter, the holding will be very, very minuscule. And there are a lot of supply, okay, which is likely to come in because initially you will see some exits, but there will be more exits coming in down the line. So that is something which we normally need to factor in. And then what happens, right? When most of the private equity investors are out, then whether that company has got a proper governance or a board really to really take it forward from there. So all these factors, I think we need to look into it when we are evaluating these companies. The good thing is that a lot of the company with private equity, they have already have a certain governance structure in place, and that has been in place. But clearly, I think the supply and the commitment of the private equity, how long their tenure is, right? Okay, is something which all these factors are factors which we look at when we decide in terms of what kind of a premium one needs to pay over there.
I have one follow-up thing. So, I mean, there are these private equity companies where have to be an exits after 3 years, 4 years. So that creates some supply overhang. Is that something that sort of impacts pricing, and that's something that plays out on your mind when it comes to looking at such companies, or?
No, actually, one of the things we worry about after the last supply is now there's no owner. And then we think, like, how do we handle a company where there's no owner? Yeah. The CEO without a stake also becomes the owner. Right. So we are grappling with all kinds of issues, and we don't know how much the PE has actually, as Mahesh also pointed out, how much he has underinvested and created higher earnings in the near term. A lot of challenges we are facing. Right. I mean, actually, if you ask me, and these are the ones where the maximum number of blocks come these days. Correct. So we're having a lot of challenges, and you have to remember we are handling other people's money when absolutely. We are investing. So frankly, all these PE companies, all these new age IPOs, they are all forcing us after many years to actually rethink many things, and every day we worry, are we doing the right thing? And and it's worrying. Absolutely, do we have all the answers? No. If we sometimes stay out and then find that the stock is going up, we would have error of omission. Right. By investing and then losing money, we will have error of commission. Do we have to worry about error of omission or error of commission? That is the debate we have internally in our company. I would say we are not going through an easy phase today.
Absolutely. What you said is right, because a lot of times you see like a large block and after which stock sort of runs away. So it becomes difficult to understand why.
This point, which is very, the difference in character of markets has changed, like you're saying. So previously a promoter company, the promoter would have 75, 50, 60% stake, right? Today an IPO is just say 10% of the company. But after that you have got 75% of the float available immediately. Okay. And it does play an overhang because at least for a period of time it does have a, I would say, pressure on the stock. And so it's very different from a promoter-led company where he intends to hopefully stay for a period of time and have more than 51% and all that. Second is this is happening more or less for the first time or, in the early stages. Okay. I think institutionalization truly on corporate boards is just starting to happen. I mean, right. So it will take 5-10 years for us to really get a sense on whether it really works or not.
Interesting. One last question, please.
Hello, I'm Harish Vora. I got
Sir, speak into the mic.
About arbitrage funds.
Sir, speak into the mic. We are not able to hear.
Hello. I'm Harish Vora. I just want to add, suppose a fund is for... Okay. Suppose a fund is for 3 months, I want to park it, then arbitrage fund is a better or money plus is better, number one. And secondly, arbitrage fund anytime give a negative return, what are the negative side in arbitrage fund? Second question, suppose long duration fund is a better or this gilt fund is better? Third question, recent amendment about recent introduction of...
Sir, I think 2 questions should be enough.
No, arbitrage funds on 3-month basis have never given negative returns to our knowledge. Even on 1-month basis, they have never given, so that's fine. So arbitrage is a good product to invest in if you're in the high tax bracket and to want to invest for 3 months. I mean, in our framework, long duration and gilt funds are, long duration funds are, if you believe yields will go down, it's a good idea. And gilt funds are also a good idea if you believe yields will go down. Both are similar in our framework. I don't know, Rajiv, you can add.
You can take the second question, yeah.
No, I agree with what you have said.
Thank you. One last question.
Hello, panel, and thank you for your time. As many experts advise to retail investors to us, that mutual fund is the best way to go ahead. But today, if you see, there are many schemes are running. Many experts are suggesting us to have a diversified portfolio. So why we are running so much schemes if the experts are saying that we should have a diversified portfolio? And the second question, why there is each month NFOs are coming and making more confusion to us as a retail investor?
The second question I want to answer. See, basically the first let someone answer. See, we manage 6 lakh crores. I don't think we want to manage 6 lakh 20,000 crores in hybrid and equity in one scheme. Frankly, just imagine if you had one scheme with 6 lakh 20,000 crores. I don't think it's good. I think having a large number of schemes is useful for us. You, at your level, having having a certain amount of money, it's useful to have a few schemes. But for us, it's useful. On the first question, I leave it to others. Diversification.
Yeah, I know. So I think you have addressed that question to a large extent. I think. See, again, as a manufacturer, our job is to give a different product, on the risk appetite, right? And see, I think to simplify that, I think there is a beautiful way of trying to do that from an investor perspective, right? To go with the complication of which fund to select. The fund of fund route, I think is now a vehicle, I think, which can become more popular, or because now the taxation issue, which was there earlier, impediment, that has been taken away. So that becomes a good vehicle for an investor perspective to invest only in one fund and let the asset manager or the fund house decide, how you allocate that. Like, for example, we have this thematic fund of funds, right? So you can decide in which sectoral thematic fund to invest into depending on which theme is likely to do well based on internal processes. So I think that is, a solution going forward where the plethora of schemes which are there from investor perspective to solve the problem, and the fund of fund will be a great route, to really solve that problem.
Thank you. We have exceeded our time. Today's discussion highlights that investing, one has to stay informed, stay disciplined, and wealth creation is not a sprint but a marathon. Thank you, everyone.
We can have a louder round of applause than that. We had quite a bit of information shared for everyone's benefit. I request the panelists to stay with us for a bit longer as we present them with the mementos. And for mutual fund investors, one of the key takeaways was that we are in a moderate return situation, but it is safer than 1 year back. Before we announce the next session, just a brief announcement for all audience members. Once the day's events are over, there will be an activity and a quiz at the Ignite Square, and those who wish to experience it can go there once the coming session is over, not before. And I would request all audience members to take their seat and not leave the hall. We have now reached the final session of the day and of the 2025 Business Standard BFSI Insight Summit. A fireside chat with Mr. Anant Narayan ji, former whole-time member of Sebi, whom I now invite to join us on stage. May I also request Khushbu Tiwari, Business Standard's special correspondent, to join us as well. I request all audience members to please take their seat as the session is now beginning. Over to you, Khushbu.
Thanks a lot, Bhaswar, and we have had a lively audience throughout the day, and thanks for staying so long for us. And we have with us Anant Narayan ji, and it's very special session with us because this is his first time addressing the public after demitting the office. So I think we can be more candid today, and we can have a more open conversations, even from the audience side later on. So because it's been 3 years for you, and you had handled so many different kinds of segments and the kind of experience that you brought in. What was we usually ask the takeaway at the last, but I think for you, this meant to be the first question of what was your takeaway from the regulatory experience as a policy maker, from first being the impacted one and then being the one who's making those policies?
No, thank you so much, Khushbu, for having me. And first of all, congratulations to the Business Standard family and community on a very, very successful and I've been tracking this BFSI event for the last 3 days and it's been remarkable. So thank you for making this an annual affair and I hope you continue doing this for many, many more years. So Khushbu, on my takeaways, look, I was incredibly lucky. Remember, my career has been largely as a foreign banker, and that too, most of my years I was in trading in currency markets, in interest rate markets, and in derivative markets. So essentially, I was like the dregs of society as far as a regulator is concerned. To be able to get the chance to join a regulator and in a small way make an impact over a larger canvas was an absolute privilege. And I will probably look back upon these 3 years as possibly the most meaningful 3 years of my life compared to all my trading career so far. I'm not sure everybody else will agree who has been impacted by some of the things that I've done, but at least from my perspective, it's been great. I think one takeaway for me is the following, and if I could pass one message to everybody, those of you who are in frontline businesses in the capital markets ecosystem, it doesn't matter which part of the capital markets ecosystem you are in, please do consider joining policy as a feasible and reasonable alternative. If there is one takeaway for me, we need far more practitioners to make the transition, even if temporarily, to come over to the policy-making side and experience this side. I can tell you from personal experience, the experience was absolutely gratifying for me. The people are fantastic. The team members within Sebi, many of whom you interact with, they are fantastic, very, very talented. It was extremely enriching for me. On the flip side, for this ecosystem to grow, I have no doubt that we need more practitioners as policymakers. So it's not just for the good of you as a policymaker. I think the policymaking ecosystem needs practitioners to come on board, particularly in a place like Sebi. Look at the vast area that Sebi covers. From primary markets, from DRHPs, from merchant bankers, to secondary markets cash, to derivatives, to mutual funds, to brokers, to exchanges, clearing corporations. The list goes on. And each of these areas are very, very niche with a lot of depth required. So imagine making policy if you don't have expertise in each of these areas. And the need for, therefore, people who are experts, who have been there, done that, to be part of the ecosystem is extremely high. So one takeaway for me, please, if you're a practitioner, think about coming to the policy side as a career, even if it's for a few years. And I think for policymakers, it's extremely important that they continue to attract good quality people from the practitioner side to be part of this ecosystem.
Yeah, I was exactly going to ask around that specifically, because you are one of the few voices from the private sector, as we call it, not from the rising within the regulator. We have seen how that is also one of the important aspects. It brings in institutional memory and the experience. But do you think there will be more need for, at the top level, to bring in more voices, more experience from the private space, and how open that hiring could be?
I think it's very important, and let me try and give you the full picture as I see it. And you've heard me saying this several times, Khushbu, so you can yawn if you want. There are two errors that regulators can make. The first error, which I call the type 1 error, is when we let bad things happen. So when a Harshad Mehta happens, when a Ketan Parekh happens, when a Karvi broking happens, then when a regulatory ecosystem looks terrible. Everybody looks at a regulator and says, you guys were sleeping at the wheel, tumko kuch pata nahi hai, whole world knew something is going wrong and you guys are sleeping. So regulators hate type 1 errors. The second error that we can make is, in our zeal to prevent type 1 errors, if we come with a 10,000-page master circular that makes life miserable for the practitioner and comes in the way of genuine capital formation by the good guys in the ecosystem, and there are plenty of good guys in the ecosystem, that's a type 2 error. So for a genuine policy-making ecosystem, you need to be able to minimize both type 1 and type 2 errors simultaneously. Now, those of you who know statistics know you cannot minimize type 1 and type 2 errors simultaneously. It's impossible. But this is not statistics. This is regulation framing. So the way which Sebi does it, actually, they do it pretty well. They do a lot of consultation, right? They come out with public consultations. Before that, they have advisory committees. Then they have standard forums. There are plenty of forums on which they consult. But to sift through the feedback that comes through the consultation, you need expertise because of a couple of reasons. The first reason, not every stakeholder is adequately represented in the consultation. For instance, I was part of the Mutual Fund Advisory Committee, and I see Rajiv and others here, part of the mutual fund system. When I was a part of the Mutual Fund Advisory Committee, I would always wonder who's representing the mutual fund investor. You hear the voices of the AMCs, you hear the voices of the distributors, you hear the voice of the regulator, but in these advisory committees, who's representing the investor? That is point number one, that you tend to get feedback from the big, the powerful, those who have a voice, and not from every single constituent. The second problem is there is a natural conflict of interest. Take the case of derivatives, your favorite subject. Now, people whom we would get feedback from, brokers, exchanges, clearing corporations, they make 50, 60, 70, 80, in some cases 90% of their revenue and their bottom line from derivatives. Now, even if they're giving you good, honest to heart, good, feedback, the fear in our mind always is, oh, you have a conflict of interest. So when you get incomplete feedback, and when you get feedback that you are worried about conflict of interest, you do need expertise at the deciding level to be able to come up with a rational framework which minimizes type 1 and type 2 errors. It's not easy. It's one thing to say, I will get feedback from experts. But to make sense out of that feedback, remove what is based on conflict of interest, and actually figuring out what is minimizing type 1 and type 2 errors, it requires expertise. And we were discussing this before I came in. You have very, very smart people at policy making and at regulatory levels. But you can't become an expert by purely being a very smart person. You can read every theoretical book on swimming there is to read. But unless you get into the swimming pool and actually start swimming, you cannot be a swimmer, right? So the reality, therefore, is we do need a good mix of practitioners and, of course, people with common sense to be able to sift through the feedback so as to minimize type 1 and type 2 errors. Now, let me come to the other side. The reality is you also need some checks and balances on conflict of interest. So when practitioners like me come into a regulator, of course there will be questions, and there should be questions about what about conflict of interest? Because I've been in private entities before me. I will probably join some private entity later on. So how does one control conflict of interest? There, I think what Mr. Pandey has put together, which is this high-level committee, which will decide what should be the disclosures, how should recusals happen, etc., for code of conduct for whole-time members, for the chairman, for employees of Sebi. I think that is a great step forward to bring in some clarity. Net-net, if we have good ecosystem to manage conflict of interest, if we have a good ecosystem comprising experts as well as generalists who can, sift through the advice coming through and arrive at a framework, that is your best bet to minimizing type 1 and type 2 errors.
So you talked about the thin ice that the regulators are walking to not stifle the innovation and everything. And you also mentioned the high-level committee. And earlier in the day, the Sebi chairman said that by November 10, the committee will be submitting the report. So we'll probably get to know how the framework is being shaped about. You called derivatives to be my favorite subject. But yes, one question on the same thing. The data shows that out of all the active traders, investors, only 1.8%, rather less than 2%, are only trading in derivatives, which means even if somebody had certain losses, they could have been offset in the cash market. So how is the data skewed that the survey that we are doing? What more is required? Do we require, what kind of data crunching do we require? Because that has been a constant statement that we really need to look at more data to decide on the derivatives.
So thankfully, I'm answering not as Sebi now, but as a private individual, and this has no bearing whatsoever on what Sebi will do going forward. I think this point I made about trying to minimize type 1 and type 2 errors, I had the privilege of being part of the team in Sebi on multiple areas, on AIFs, on foreign portfolio investors, on derivatives, and on market infrastructure institutions. All these areas was all about minimizing type 1 and type 2 errors. Now, let's take a look at derivatives. Now, what are the data points that got us thinking that we have to do something on derivatives? First and foremost, of course, there were enough statistics showing that retail investors were losing out far more than was reasonable. So, for instance, on 1.8% data point that you mentioned, in FY25, more than 1 crore unique individuals traded in derivatives, largely in index options on expiry day. More than 1 crore individuals. Each of them, on average, lost 1 lakh rupees. The total losses made by the retail investors in F&O in FY25 was about 1.05 lakh crores. Imagine if that money had gone into proper capital formation rather than going into filling up some high-frequency traders' coffers. Now, that was one data point. I'm not saying that's necessarily a data point that we had to act on, but that is one data point. The second data point, which again I've spoken about, was that the volumes that were being traded in the derivatives markets, particularly in index options on expiry day, were several times the volumes in the underlying cash market. For instance, even now, in August, data shows that the volume in terms of the delta equivalent or the cash equivalent being traded in the, let's say, the index options on weekly expiry day is 600, 700, 800 times the volumes being traded in the underlying constituent cash markets. Now, this is simply not sustainable. And it gives rise to lots of questions about market stability, about what could happen potentially in terms of volatility and possible manipulation fears. So these were two large areas of concern that we had. The third area was, look, derivative markets, and I've said this repeatedly, is absolutely essential for good quality capital formation. You need derivative markets for price discovery, for market depth, for hedging, for good people, and so on and so forth, right? But there is enough research globally and locally to show that a good quality derivative ecosystem typically has a lot of long-term contracts. 60 to 70% should be beyond 1 month, ideally. In our case, a vast majority of the contracts expires the next week. Forget about, beyond 1 month. So all these were areas of concern. What I want you to, on the flip side, let's go to the flip side. What are the arguments against SEBI intervening? If there are willing buyers and willing sellers, who the hell is SEBI to come and say, no, we should change the rules of the game? And that is something we have to be extremely conscious about, that we cannot play God. The second thing to keep in mind, and it's a real thing to worry about, is that whether we like it or not, the ecosystem depends on derivatives for revenues. Brokers, exchanges, clearing corporations, a whole bunch of intermediaries make 50, 60, 70, 80, 90% of their revenue and their bottom line based on the derivatives, particularly index options trading. Now, we had to find a balance between all this. Again, come back to the point about managing type 1 and type 2 errors, balancing and reducing type 1 and type 2 errors. I would argue that if you look at what we have done over the last year, we started the first consultation on derivatives in July 2024. So it's been a year and a few months, almost 1.5 years, since we started acting on derivatives. Very, very consciously and calibrated fashion, right? First circular came out in October, second circular came out in July, or rather in May. So we've taken a very, very incremental steps trying to minimize both. What is our intent? Our intent is to manage the 3 risks which I mentioned to you, which is retail losses, the instability in the market with very, very high derivative volumes, and the quality of the derivative curve, while managing the fact that this is a free market where innovation should be allowed and where revenues depend upon derivatives. We have to balance all of this. I would argue that over the last year and a half, actually we've taken very, very calibrated steps. The data point we will look at, how are retail losses looking at? How is the market stability looking like? Therefore, is there anything more to be done? And again, it will be on a completely consultative fashion based on the last set of steps, I think, kicked in on 1st of July. There is some more which will happen till December. I'm sure Sebi will probably look at what the impact of all of that is, and then put the data up front and then have a discussion on what do we need to do next.
So fortunately, I think the credit will go to you and your team when India shifted to a future equivalent measure in a more measured way to measure risk in the derivative segment and overall positions in the market. And you talked about capital formation. So earlier, in one of your speeches, you had highlighted the gap between supply and demand in the primary market. So which means the number of IPOs coming and the kind of demand that we have seen. This year is stellar again in terms of the IPOs. But do you see the concerns on the valuations? Obviously, during your tenure only, I think Sebi had taken that approach of allowing loss-making companies to get into the listings. Even if the companies are now profitable, do you see the concerns on valuations as voiced out by many investors?
I'm no expert on valuation, but let me tell you what the data that at least I saw shows. In FY25, the net demand for equities, both in primary and secondary put together, through mutual funds, was 6.1 lakh crores. This is almost twice as high as the previous high that we have seen as demand from mutual funds. If I include beyond mutual funds, also other DIIs, your pension funds, your insurance companies, etc., and individuals coming and buying directly both in primary and secondary markets, that's another 2.7 lakh crores. Put together, the total demand for paper from mutual funds, from pension funds, from insurance companies and individuals was 8.8 lakh crores in FY25. That's $100 billion equivalent. Okay? Now, this is far higher than the net demand we have seen from these constituents any time else in the past. The net supply in terms of fresh paper, IPO, FPO, rights issues, QIPs, and so on and so forth, all put together, was 4.6 lakh crores. That was also a record. That is also 60% higher than the previous year's record. But the gap between this 8.8 lakh crores and 4.6 lakh crores is also the highest we've ever seen. That's clearly what the data shows. Now, my limited point is, I think particularly in times like this, there is all the more reason that we have to be cautious as an ecosystem. You know, there is Warren Buffett who says that when everybody is greedy, you should be fearful. And when everybody is fearful, you should be greedy. I would argue a policymaker and a regulator should have a similar outlook. When everybody is looking greedy, you should be fearful. So to me, investor education, and I credit to Sebi and Chairman Tuhin Pandey, I think they're absolutely focusing on the right thing. To me, investor education about risk, about asset allocation, about understanding what volatility is, about making sure you have an asset allocation which diversifies your portfolio depending on your risk appetite, all this is extremely important. You know, in the speech today morning, he mentioned 13.5 crore unique investors. I'm not sure how many of them actually understand market risk, actually do asset allocation which is appropriate to their appetite for risk, and have adequately diversified across commodities, across equities, across debt, across fixed income, across real estate, gold, and so on and so forth. Now, there's a lot of work to be done on that front. Now, unfortunately, we don't have a magic wand where all of this can be solved overnight. It's a process. My only request to you as the ecosystem, irrespective of which side of the fence you sit on, I think we have a good thing going on. The fact that so many people want to participate in our capital markets, 13.5 crore people is fantastic. That number can easily become 25 crore in the next 3-4 years, right? It's a great thing. But it is equally important that we should all talk about risk. We should all talk about the need to manage and understand volatility, the need to do asset allocation which is appropriate to your risk appetite. All that should happen. The less we hype up the markets currently, the better for all of us. Do not kill the goose that's laying the golden eggs.
So coming to the point of the kind of capital flow from the foreign markets that we've seen, and under your tenure, we saw relaxations in the registrations for FPIs, new portal, a single window portal that is now coming up. You were also the person who brought in the disclosure requirements, and then there were certain exemptions granted to it. What more is required on the FPI side, and how do we compare globally on the regulations for FPIs?
Look, again, for me, the last 3 years, FPIs was again a great example of having to manage type 1 and type 2 errors. Remember in Jan 2023, we had the Hindenburg report, which raised questions about the color of money coming in through certain FPIs. And it's not the first time these questions have come up. Over the last 30 years, we've often had questions about who's behind a certain P note and who's doing what and so on and so forth. So we had to solve for that possible type 1 error or risk of a type 1 error and have clarity on the color of the money coming in through the foreign portfolio investor regime. At the same time, we could not come out with a regime which was so silly that no FPI would ever come into the country. So we had to balance this requirement for disclosure with a risk-based metric, which was important, which is why we came with this point about only if you have more than 50% invested in a single corporate group, and if you're not a sovereign wealth fund, you're not a public retail fund, you're not a mutual fund, and so on and so forth, only then do you have to disclose, which is a very, very risk-based approach we used to try and address the perception of a type 1 risk, right? Thereafter, we worked hard, as you rightly pointed out, and in fact, Sebi is still working hard on seeing what can we do to make access easier. And there, a lot of things came to light, and we did work upon it. I'll give you an example of the need for expertise and the need for being able to sift through feedback. Do you know that in India, we have T+1 settlement? But FPIs would never get their sale proceeds on T+1. What would happen on T+1 is that their bankers and the custodians would tell them, oh, your money has come to me, but first I need a tax certificate to figure out how much tax I have to deduct before I can send you the money. Which means the FPI would get the funds only on T+2, T+3, in some cases T+4, T+5, after the tax certificate came in. One thing that Sebi worked on along with the chartered accountants and with the FPIs, was we made sure that the tax certificate would come into the custodian and the bankers by 9 o'clock in the morning on T+1. And we've told every FPI, if you want to take out money the same day, please go ahead. You should get it on T+1. And if your custodian or your banker is saying it's not available, call us. We will speak to the custodian and get it done for you. So the point is that a lot of simple things can be done to relax and to make life easier for FPIs. One thing we always, and again, credit to Mr. Pandey, ever since he's joined, he's done roadshows in the US, in Asia, as well as in Europe and in London. Fantastic set of meetings that we had where we interacted with several FPIs. A lot of good feedback. There's a lot of positivity, by the way, across the FPI community about investing in India for the long term. But we can definitely do things to make life easier for them. For instance, doing away with the need for wet signatures and apostling of documents. That's something that we are working with RBI to try and see, at least for the good guys, can we do that? Similarly, there are funds that are practically mutual funds globally. So you have funds which are under UCITS in Europe, which are practically operating the way our mutual funds operate, which means they have a blind pool, they have pari passu, pro rata rights, they have an independent fund manager. The question about the color of the money should not come at all for such people. Many of these UCITS funds, they practically have a passport to invest in places like Hong Kong or South Korea or other countries. If you're a UCITS in Luxembourg or in Dublin, you automatically get access to some of the other markets. India can do the same. We can try and give a passport, of course with certain checks and balances, based on a regulatory comfort that regulator gives us, saying that these are absolutely kosher funds, which are public retail funds in the nature of mutual funds in India. Why do we have to subject them to a lot of paperwork when we know they're regulated in their particular jurisdiction and we trust those regulators? Again, it's a risk-based approach that we can use to make life easier. One feedback that we did hear a lot was about capital gains tax for foreign portfolio investors. Now, I know it's way beyond my pay grade, even as a private individual, to talk about capital gains tax. But I do think we have to be very, very conscious of the fact that amongst the large jurisdictions, there is practically no jurisdiction that applies capital gains on foreign portfolio investors. To be a standout jurisdiction like this is something that we have to be very, very thoughtful about. Now, again, it's not Sebi's call, but as an ecosystem, we have to debate this. The Ministry of Finance, Department of Revenue, I'm sure has a lot more data points than I do, but it is something that we have to be conscious about and see whether we can make life easier on that front.
I think a very detailed answer on that. And I believe you mentioned that people may yawn because of your type 1, type 2 error statements multiple times, but I trust nobody has so far yawned as far as I see from here. But we'll open for questions from the audience, and I have a few more questions, but we can take them after the audience questions. So if you have any, you may raise your hand. We'll bring a mic to you. Anybody? That gentleman, please. Please state your name and if you want to state your organization, and please keep it brief.
Hello everyone, I'm Gyanendra Nahar. Being a practitioner, how can we strengthen the ecosystems, as you mentioned, to reduce the type 1 and type 2 error, apart from joining the policy making side, from this our practicing side?
Thank you so much. I think it's an excellent question. One sincere request to all practitioners, and many of you interact with Sebi or with RBI or with New Delhi, please be trusted advisors. And I'll give you a practical example from my perspective. AIFs, alternate investment funds, which I regulate, when I was in Sebi, I was looking after that. We had a situation when I just joined Sebi where we saw 25% of investments through AIFs being dodgy, being either structured to circumvent NPA regulations of RBI or FEMA regulations or SEBI regulations or IBC, IBBI regulations. They were dodgy. And none of these cases came to us to light because the industry told us about it. We came to find out either because we did some investigations or some people in the media alerted us about something happening or through other market intelligence. And instead, every interaction I would have with the industry, they would clamor about type 2 errors. That, oh my God, your regulations are so onerous, we can't do business. Now, to credit to the ecosystem, over the next 2 years, and in fact, over the next 3 years, there was a fantastic dialogue between the AIF ecosystem and Sebi, where we both became trusted advisors to each other. So much so that IVCA, which represents many alternate investment funds, came to us and said, you know what, here is another example of something that could be dodgy. Now, they were not snitching on anybody. They were simply pointing out something which they felt we should be aware of so that in case we have a problem, we address it. That gave us so much of trust that here is an ecosystem that seems genuinely concerned about type 1 errors. That gives us the confidence to then think about type 2 errors and how we can minimize them. So my request to you, if you're in the front line of a market intermediary or a mutual fund or whatever, please talk to a regulator about type 1 errors that you see happening around you. Again, this is not about snitching, but don't let the regulator find out something wrong happening from other sources. That just kills the trust. If you do that, I can assure you the regulator will bend backwards to try and address your type 2 errors. So my sincere request is, when you have conversations, do not only talk about type 2 errors, bring type 1 errors to the forefront, think like a regulator, and then you can ask us to not only talk about type 1 errors, but also talk about type 2 errors. Have the faith. Sebi actually listens very, very closely to everything that you say. Have the faith to have these honest conversations. This is not snitching. This is about ensuring that the goose that's laying the golden eggs continues to remain alive.
If there's anybody else, we can take. Yeah.
Hello, very good evening. Myself, Keval. So I just wanted to ask, how does the SEBI strike a balance between facilitating market growth and the investor protections since the increasing use of algorithm, AI-based tradings, fintechs companies, etc.?
So you've kind of summarized my answer in a question form. It is a challenge. I don't for a minute disagree it's a challenge. As I said, we have to minimize both type 1 and type 2 errors. The 3 pillars that form the SEBI mandate is investor protection, market development, market regulation. And it is a mandate given to us by the parliament, us meaning SEBI, to make sure that we balance across these 3. Now, how do we try and do it? I'm not saying we're always successful. I'm not saying I was always successful. But genuinely, we try and take a lot of feedback. So from market participants, if we get good quality feedback, that helps us try and strike the balance. And of course, we apply our own mind as well. Besides what we hear from the marketplace, we also try and apply that mind. To that extent, my own takeaway is the more experts we have within the policy making and within SEBI itself, I think it's better for us. I would strongly once again end by asking you, those of you who are up to it, who are up to trying to do a little more beyond, if you want to see the world beyond the well that you're in, and see and be a frog which sees the entire world, try and think about having a stint in a regulator. It can be very rewarding. It certainly was rewarding for me. And I think you can do a lot of good for the ecosystem as well.
Before I let you go and before you call it end, I must not let you relax before this question. It's one of your recent orders. How closely will you be monitoring that? Now in 2 weeks, it will be again in the tribunal. And what was your feedback? What will be your feedback to the regulator now that they'll be taking up the case? And any learnings from the same? So these 3 parts.
One innocent question is which order? I signed an order on 9:30 p.m. on 9th of October, which is my last day.
The name that starts with J.
Look, you know I will not talk about any specific order. That doesn't make sense. But to me, this reiterates the point about why we need expertise, both by way of feedback from the marketplace as well as within the policy-making ecosystem itself. Coming back to your favorite topic on derivatives, do you know that in March 2020, there was a limit which was set on index derivatives, in index options, which was a 500 crore net notional limit. Now, it was set with the intent of trying to minimize the amount of risk that a single person can take. Now, I don't know how many of you actually understand derivatives. By the way, it's a very handful of people who actually understand derivatives. By being within this 500 crore net notional limit, there were entities that were running 5,000 crore, 10,000 crore, 30,000 crore, 50,000 crore short on Bank Nifty stocks, while notionally staying within the 500 crore net limit. Now, that limit was set in March 2020. It was replaced with the delta-based limit that Khushbu mentioned as of July 2025. So for 5 years, we were going with a limit which, with the advantage of hindsight, we can argue was not correct. We need the ecosystem, to tell us that, boss, this limit doesn't make sense, because you know what's happening on the ground, rather than us finding out the hard way. And why am I mentioning it? Because when I talked about possibility of, or fear of manipulation or fear of risk, the crux comes down to this, the fact that there were participants who could take such large positions on expiry day in relation to the underlying market size. So it's a conversation that needs to happen. You have to be trusted advisors to us. We have to have the expertise to understand your trusted advice. And collectively, regulations are too important to be left to the regulator alone. Collectively, we have to co-create an ecosystem that minimizes type 1 and type 2 errors.
So I think every time you say type 1 and type 2, I'll take a water next time, and I'll be very well hydrated enough. So, but you did not still tell me how closely will you be monitoring now that you have demitted office. Will you be will you go in a relaxing mode, or will you keep your ears and eyes open for these particular kind of cases?
Look, one should always look forward. Sebi is a fantastic team. They know what they're doing. They will take care of what needs to be done. I don't need to worry about what I've left behind. I'll rather worry about what my future looks like and what I can do for the ecosystem going forward than worry about the past.
We wish you a great endeavor on that again. And thank you so much for being a very lively audience and engaging with us on this type 1 and type 2 errors. Thank you so much.
Mr. Narayan ji wants more practitioners to join the regulatory and policy space, and I would request him and Khushbu both to stay with us a little longer. As Business Standards editor, Mr. Shailesh Dobhal brings the summit to a close.
Thank you, Bashwar, and good evening, everyone. It's been very eventful 3 days where the country's almost entire BFSI sector came together, and like a newspaper where the nation speaks to itself, it was the industry speaking to itself these 3 days. Speaking of numbers, we had 41 sessions, including 14 firesides like this with Mr. Narayan. 27 panels. We heard over 120 speakers. The exhibitors outside the expo, we had 66. There are many, many insightful takeaways. For me, what stood out and what Mr. Narayan also spoke about, that everything looks hunky-dory, but I think we have to ensure the sector's strengths should not become vulnerabilities, at the national level, at the institutional level, at the personal level. To compete globally, I think India needs to think big in the BFSI sector. We need bigger banks. In terms of private investment, and that's been the bugbear for quite some time, we heard the Chief Economic Advisor, Mr. Nageshwaran, say that the direct and indirect tax measures that the government has taken in the last 6 months has clearly shown demand visibility to the private sector, and that would certainly kickstart a virtuous cycle of investments. We also heard that we need to make manufacturing jobs aspirational in order to grow at a strong rate, and for BFSI too. IRDA Chairman Ajay Seth told us that if you look at fiscal policy, the government has now almost equated the insurance sector with the food sector with zero GST, and that has a lot of implications for penetration of insurance. Again, Mr. Seth, speaking about the sector, also gave a call to the whole industry, and that was not true just for the insurance industry, for the entire BFSI industry, that we need to heed more to management guru C.K. Prahlad and chase the bottom of the pyramid. I think the early low-hanging fruit in a lot of cases is over. I think the hard work has to begin. RBI Deputy Governor T. Ravi Shankar explained how currency acceptance across borders go hand in hand with the country's developed status, so that will happen by and by. An interesting thing about the pension sector, and that's what Mr. Raman spoke about, he said we have to quickly find ways and means and mechanisms and products as a country and people to grow rich before we grow old. And all in all, how India's economic journey is very closely intertwined with the development of the financial markets and the capital markets. Across panels, there was this debate. So the model of the financial BFSI sector is changing, from a saver lender model, which was, you were putting money in a bank and bank was lending to the private sector. Increasingly, we are moving to an investor-issuer model where the capital markets are going to play a more and more important role. How do you reconcile that? Your regulatory structures, your administrative structures. Many, many takeaways. These were the key ones for me. I'm sure this audience would have many more for themselves. Thank you so much for being here and hope to see you at BFSI 2026. Thank you so much.
I would request just one more moment of patience from Mr. Narayan ji as we present him with the memento. I think we can have a louder round of applause than that.